In this 8-hour long course, I'm going to equip you with my trading methodology and my trading system that has made me hundreds of thousands of dollars and close to 7 figures in my early 20s. This course is going to cover everything from the basics to how to read price charts to all of my trading strategies, what separates a low quality trade from a high quality trade, my risk management system, my in-trade management system, and much, much more. It doesn't matter whether you're a beginner trader who knows nothing about trading or a profitable expert trader, I can 100% guarantee this course will open your eyes and will help you improve as a trader. First, let me go ahead and introduce myself. My name is Emmanuel. I'm a Georgia Tech graduate and I've been day trading stocks for 4 years. The way that I learned trading, and honestly, I got pretty lucky, was from my father. He's been a professional trader for close to a decade, and when COVID hit, everything was on lockdown and I found myself back at home without anything really to do. So my dad decided to encourage me to start learning how to trade, and he was able to teach me all of the basics. For about 3 to 4 weeks, he taught me his trading system and the methodology he trades. And then for the next 3 months, I was sitting next to him looking at his every move and really trying to understand what drove his decisions in the markets. And I was paper trading alongside of him. After watching him trade and practicing next to him, on my first day of trading with real money, I made $711. This completely changed my perspective about money because I always associated time with money. Working different jobs, for example, at a grocery store. I also worked for a landscaping company. I was paid hourly, so I always correlated time with money. But when I made that $711 in literally 2 to 3 hours of trading, it completely opened my eyes. I owe it completely to my father to getting me into trading and to teaching me, and honestly, his mentorship was invaluable to me. 4 years later, I'm a full-time day trader today. I just moved into my dream apartment in Boca Raton, Florida. I was able to buy myself an M8 competition, and I can proudly say that I have the ultimate freedom. I've made hundreds of thousands of dollars and close to 7 figures with trading, and I haven't had a losing month in over 3.5 years. Keep in mind, I did all of this as a full-time 15-hour Georgia Tech student studying finance. I'm not telling you this to flex. In this video, we're going to be talking about trading and making money with trading, so it's important for me to share to you why I'm qualified to teach you in the first place. In the last 10 months, I also taught my 18-year-old cousin how to trade. I took him from zero, not knowing anything about trading, to now making between $8,000 to $15,000 per month consistently. He traded with me every single day, and he had his first $1,000 day only 3 months into his trading journey. I have dozens of other students who are in my one-on-one mentorship program who have seen incredible results just like Greg. The information in this free course truly has the power to change your life and help you take a massive step forward towards achieving profitability with trading. This course can be game-changing for you if you take it seriously. If you have a notebook, a pen, and you're distraction-free every single time you watch one of my lessons and you're truly absorbing all of the information I'm teaching you. Unfortunately, many of you are going to take this course for granted because it is free, and a lot of people don't put value on free information regardless on how good that free information is. It's really easy for people to look at this information and look at the course that I created, see that it's free, and just disregard it and not really take it seriously. And I don't want that to be you. So I want you to make me a deal. Imagine that you just paid me $2,000 from your own personal bank account into my bank account for all of the information that is in this course. As you're going through this course, I want you to keep in the back of your mind that you just paid me for the information that you are watching, and that's my way of guaranteeing that you're actually going to take this seriously and really digest all of the information. I've had hundreds of students watch this course, and I've seen personally them take tremendous strides in achieving profitability with trading, so I can't wait to see your results. All that I ask from you is to follow my socials on Instagram, TikTok, and YouTube, and that you provide me updates on your trading progress as you're going through this course in my free Discord. If you're watching this video from YouTube, I want to show you how you can get access into my free Discord so you can give me updates on your trading progress or to ask me questions if you have any, and to, of course, give you access to the other resources that I've attached to this course that I wasn't able to post on YouTube. So in the description of this video, you should see a link to my Emmanuel Trades University. You're going to want to click on that, and it's going to bring you to this page. It's hosted on whop, which is an excellent platform. I have a lot of my education on whop, and you're going to want to have the free course selected. I have other services as well, like the Trading University, which is the free course on steroids. It's about 4 to 5 times as long, way more detailed, way more thorough. And I also give you assignments for you to complete, and then I personally verify those assignments. So it's a much deeper learning experience. We also have my personal trades, where I give you the trades that I'm taking on a daily basis when I'm day trading, the stock, the entry, stop loss, target, and I manage the positions for you as well. And of course, I have the one-on-one mentorship, where this is a private group of students that I personally mentor one-on-one, and they trade live with me every single day. I stream my screen, and they're able to see me trade, and we make money together. So for this though, we're gonna click on the free course and just press on Get Access. You will have to put in your email address, and once you press continue, it's going to send you a code to your email. So go ahead, retrieve that code, put it in, and once you do that, you'll be able to have access to the free course on whop. Once you do that, it's going to take you to this whop dashboard area, and you should have also received an email where you can access the free course and access this dashboard as well. And the first thing that you're going to see is the free live training. This is a live class that I do every single Thursday, where I give you the framework on how to make your first $10,000 a month with day trading. I highly recommend that you register. It's completely free to go. Take notes in the class. You're going to learn a lot of valuable information, and make sure you stay until the end of the class, because I do a massive Q&A where I'll answer all of your questions, and I give you a massive opportunity to really take your trading to the next level. So make sure you register up for that, and make sure you attend this Thursday. The next thing you're going to see is my trade insights, and this is kind of like a forum where I give you my thoughts as a trader. I post some different information about trading. For example, here talked about boring trading equals profitable trading, and I posted a whole forum about that. And of course, I give you reminders to attend the free class on Thursdays. But this is where you want to really click on the free 8-hour course. It's a drop down, and then you should see education, and then you should see trading community. So once you press on education, this is where the course actually begins, and you could begin learning. And there's also going to be PDF or Word documents under some of the classes that are going to give you additional resources that is definitely going to be valuable for you. And in order to access the Discord, you're going to want to click on Trading Community that is under the free 8+ hour course. Click on that, and it should take you to this right here. So just put in your Discord account, press on Claim Access, and then you could join my Discord, and from there you can ask me questions, you can collaborate with the other students in the free chat. And I also post lots of announcements in there for any updates that I'm doing. So super great. I'd love to have you in my Discord. And yeah, make sure whenever you join it to tag me and give me a quick hello or give me a quick what's up. You can also personally DM me. I try to always respond to all of my students. So once you're in the Discord, you're good. And make sure you really start with the education here. All right. It's 8 hours long, so obviously it's a pretty lengthy course, but it's really going to be game-changing for you. So make sure you actually invest the time. Do not take it for granted, and I truthfully can't wait to see your results. And hopefully I'll also be seeing you in the free class that I am doing this Thursday. Now that you're hopefully in the Discord, you're also watching the course from whop, you've registered for my free class this Thursday, let's get started and let's start learning. What is going on, guys? Hope you're having a great day. In today's class, we're going to be talking about some super basic terms and some super basic concepts that you need to understand before you actually start with the trading section of my course. I'm going to be frequently referring back to these terms throughout my course, and you have to understand what they mean so you don't get lost and you're able to follow along. This is super basic information, so if you are already more or less experienced as a trader, then you could really skip this video. But if you're a complete beginner, I would really suggest understanding these basic concepts before you continue on with the course. Okay, so let's just get started. So the first term is going to be price entry or entry. It's the price you are entering the trade. before we enter into a trade, before we, enter a position, you always want to make sure you understand exactly where your entry price is, the precise price that you're going to be entering the trade. And we're going to be talking about entries and how to pick entries later on, but just understand that entry is when you're entering the trade. PT, or price target, is where you're aiming to take profits. Okay, so that's just once you enter the trade, you want to take profits at some point. The target price or price target, that's where you're aiming to take your profits. Stop loss, or you could say maybe you'll see a SL. That's the price where you're going to exit the trade if it doesn't go in your favor. So before you enter any sort of trade, you're always going to have a predefined entry price and a predefined stop loss price, right? And maybe you guys have heard of stop losses. Maybe you've heard that they're used to minimize risk, and that's exactly what they're used for. They're used for making sure you don't lose more money than you intend on losing, okay? And for every single trade that you are ever going to place, for every position you're ever going to enter, you are always going to have a predefined stop loss. So just understand, a stop loss is the price you're going to exit the position if the trade is going against you, okay? Because you want to minimize your losses. TP is take profit. That's where you're going to be exiting the position for a profit. So now let's go into long and short. So there's two ways to make money in trading, right? It's number one, you could buy a particular asset, stock, a crypto, and it goes up in value, and then you sell it at a higher price. That's when you buy something and it goes up in value and you sell it, right? Everyone knows that. That's called going long. When you go long, you buy. Okay, so whenever I say going long or you're gonna go long here, that means you're buying it in hopes to sell it at a higher price, therefore making a profit. Now, a lot of people are not familiar with going short. So going short is the precise opposite of going long. You are going to be making money if the stock or crypto drops in price. So just like you can make money if an asset goes up in value, you can also make money if an asset drops in value. And you're going to do that by going short. If a lot of you are a little confused on exactly, how that works, we're going to get into in a second. But just understand that going long is buying, and going short, well, when you're going short, you're technically selling. We're going to get into that in a sec. But when you're going short, you're making money if the asset drops in price. BTO means buy to open. That's just buying in order to open a position. And STC, it's selling to close the position, meaning selling to exit the position. Okay, so those are some key terms that you really need to know. Another one is, I think maybe I actually have it on this guide. But by the way, guys, I have here a beginner trading guide prepared for you. I'm not going to be going over the entire guide. My recommendation is take some time out of your day to read this and to really understand everything. This is super basic information. So if you don't understand this stuff, I probably wouldn't continue on with the rest of the course. So make sure you read this. But another term I frequently use is bullish and bearish. And maybe you guys have heard of those terms if you don't understand what they mean. So whenever I say bullish, right, bullish, that means that there's a lot of buying pressure, right? That word, it's used to describe the market or a stock or a crypto, and it means, having positive market strength, right? So if something is bullish, that means I think it's going to continue higher. There's buying pressure, right? My overall bias on the trade or on the stock or crypto is that it's going to continue higher. So whenever I say something, a stock or crypto looks bullish, what that means is it looks higher. It looks like it's going to continue higher in price. Excuse me. Whenever I say bearish, bear, so there's a bull versus bear. Maybe you guys have, seen stock market movies or Wall Street movies where they talk about the bull versus the bear. That's kind of where these terms are derived from. There's bearish. So bearish, that's when it indicates negative market strength, meaning market weakness, right? It indicates market weakness, where if something is bearish, that means you foresee it continuing lower in price. So whenever I say bearish, it means it's weak. I'm going to probably short it. Whenever it's bullish, I'm most likely going to go long, right? Remember, long is buy, short is, making money when it drops. So if something is bearish, I'm going to look to short it. If something is bullish, I'm going to look to buy it. And that's basically, I think that's most of the terms. Definitely go ahead and read this entire guide. It's pretty useful. It kind of goes over all of the orders. Yeah, just make sure you go over this guide. I'm not going to go through everything today. I'm just trying to see if there's anything specific I really want to emphasize. By the way, guys, if you're confused about going short and like exactly how that works, go ahead and read my explanation here. It'll be very helpful. But just understand that shorting means you're making money if the price drops, if the value of the asset drops. Okay, and I might make a whole separate video when it comes to orders. However, I think I have a really good explanation here on how all the orders work. I don't think I need a separate video for it. So make sure you just understand this entire guide. Make sure you understand these terms that I just mentioned, and you should be good to actually start the course and understand everything I'm saying. So you guys are about to get into the, meat and potatoes of the course. So really excited. Now that you guys have learned these basic terms, you're ready to start. So see you in the next video. Hey guys, the topic for today's class is the differences between technical and fundamental analysis. And we're still super early on in the course, so I figured it'd be very important to actually touch up on technical analysis and fundamental analysis. And if you guys haven't heard of those terms, these are the terms that describe how to analyze a particular security. It mostly applies for, stocks, and it does also apply for crypto, but I think it was coined mostly for stocks, right? And I'm sure you've probably heard one is superior to the other. So I'm here going to tell you exactly what they are, what to focus on, and how you can begin using them, okay? So let's start out with technical analysis. Technical analysis is focusing on reading price action, okay? That's what we're focused on. Reading historical price trends and price action in order to determine whether we're going to go long or short, or determine our outlook on the stock for whether it's, during the intraday time frame, whether it's, few hours, few minutes, or even, few days, even few weeks, few months away. Okay, so the two buzzwords or the two buzz terms are price action and price trends. Okay, and technical analysis for trading, specifically for trading, and that's what this course is about. We're here to learn about trading. Technical analysis is the only way to analyze a stock for the short term, right? Because as traders, we're operating kind of on a short-term basis. Even if we're approaching longer-term trades, trades that are, several months or, several weeks, that's still short-term enough where you're going to be using technical analysis, okay? If you're looking, 10 years out, 5 years out, trying to figure out the value of a stock, of course, then we're going to use fundamental. But I'm gonna get into fundamental analysis in a second here. I just want to finish up with technical analysis. So the whole point, the whole goal of this course is to actually teach you guys technical analysis, and that's only one part of trading, but it's one of the most important parts, because ultimately that's how we're going to predict, price action is by reading prior price action, the way the candlesticks look, the way the moving averages look. We're reading all of this to make intelligent decisions on where to put our money and what trades to actually take, okay? And that's why technical analysis is king. If you guys aspire to be successful traders, you must innately understand technical analysis. And this is what you should be focusing on, technical analysis, not, and we're going to get into it now, fundamental analysis. Fundamental analysis
is basically looking and reading the intrinsic value of a security, of a stock, of a crypto, the intrinsic value. So you're going to be looking at, macroeconomic trends. You're going to be looking at financial statements of the company. You're going to be looking at intellectual property. You're going to be trying to read the company's worth, right? And based off, how valuable the company is, what they offer, whether, their products are trending, for a longer term scale, or, just reading the actual value of the company, we're able to establish, if this is a good investment. But this is what you have to understand. Fundamental analysis is, for the longer term. It's for 5, 10, 15, 20, 25 years down the road, right? We can't read, shorter term trends using fundamental analysis. Okay, so for our purposes here, for purposes of trading, and actually before I get into that, I just want to give you guys a quick example. The reason why a lot of people, unsuccessful traders, a huge reason is because they actually pay attention to news, which at the end of the day, news about a company, news about a crypto. At the end of the day, that's fundamental information. That's not technical information, right? That's not about price action. It's about something the company did, something the company acquired, right? Certain news going on around the company. People focus on that, and they actually enter trades just based off the news, just based off recently heard fundamental information. And this is one of the biggest mistakes you can make. Why would you, buy something when, you're hearing about the news the last? We're the public. We hear about the news literally last. Think about all of the, shareholders or people, insiders in the company. They heard about this news weeks ago, months ago. The news that you're hearing on a day-to-day basis about stocks, companies, crypto, it's already priced into it. Okay, so stop relying on that information. Sorry for this tangent, but it's extremely important. Stop relying on this information. Okay, it is pointless. It will only lead to, bias in your trading and a complete lack of objectivity. Okay, and that's why, in order to have objectivity in trading, we have to read the price action. We have to read what the charts say, and the charts, like this one here, shows you price action. Okay, and those are the main differences. So key points here is focus on technical analysis, and you don't really need fundamental analysis for trading at all. I mean, I'll tell you the truth. I have never researched a company in my life that I'm trading. It doesn't matter to me, right? I've never looked at news. The only news that could be interesting is, like, let's say the Fed is having a meeting that could be impactful, or looking at news that could affect stocks, during the intraday time frames, meaning like during the day. Let's say some news comes out and a stock drops super hard. That might be interesting to you for a potential trade. But besides that, you guys should not be focusing on news or fundamental analysis. Divert, all of your attention towards technical analysis, reading price action. Okay, and that's what we're going to be teaching now. So I hope you guys found this helpful. Okay, hope you guys understand the differences and which ones to really focus on. And let's get on to the next video in the course. What's going on, guys? Hope you're having a great day. For today's class, we are going to be talking about the 3 different trends that exist in trading and with price action. Okay, so these are super basic trends that you guys should know how to identify, and you should know the implications of these trends as well. So let's get right into it. The 3 different trends. This is probably stuff that you've heard of already. So when we're looking at an uptrend, it's characterized by 2 different characteristics. Number 1, higher highs and higher lows, and number 2, a rising 20-day moving average. So we haven't covered how to use the 20-day moving average, but just always keep in mind that we want a rising and a trending higher 20-day moving average. Okay, so as you can see, we have higher highs, right? We're making new highs, and we're making higher lows, right? This low is higher than that low. This low is higher than that low. Same with the highs, okay? And as you can see, this line, the black line, which is the 20-day moving average. It's under price, and it's also trending higher. And we're going to be doing the 20-day moving average class next, so just stay tuned for that. Okay, so this is what an uptrend is. Very simple stuff. We're looking at a downtrend. It's characterized by, number one, lower highs and lower lows. Okay, we have lower highs, right? And lower lows. So low here, low here, low here. And as you can see, we have a declining 20-day moving average, which is this line. So as you can see, during a downtrend, we want the 20-day moving average to be overpriced, right? And we see that during the downtrend, it sort of retraces, right? It always rallies right to the 20-day moving average, drops, rallies right to the 20-day moving average, drops. But we're going to be looking at the 20 MA during the next class. So this is what a downtrend looks like: lower lows, lower highs. Okay. And we also have a sideways trend, which is characterized by relatively equal highs and lows, right? We rally, we make a high, we drop, right, to the previous low, we rally to the previous highs, drop to the previous low. Okay. And once we talk about support and resistance, this is going to make a lot more sense. But this is what a sideways trend is. So sideways trend, it's not, we don't have one particular bias. We don't have a bullish bias or a bearish bias, right? Overall, we're just sort of fluctuating between the highs and the lows. Okay, so this is what a sideways trend is. And usually sideways trends, they lack momentum, right? So with uptrends and downtrends, we clearly know what the momentum is, right? For an uptrend, there's clearly bullish momentum, right? We're rising. There's a lot of buyers, right? Over with the downtrend, there's a lot of bearish momentum. There are a lot more sellers. The sellers are dominating the move. But with a sideways trend, it's really, there's no clear momentum. We don't know exactly, are the buyers winning or are the sellers winning, just because we're kind of fluctuating between the highs and the lows. Okay, here's an example of a uptrend. This is a real chart with candlesticks, as you can see, right? We can see that we made a high here, we made a low here. This low was higher than this low. This high was higher than that high. Right here, also make a higher high, higher low. And as we continue going up, you can see that we're continuously making higher highs and higher lows. This blue line is the 20-day moving average. Okay, and as you can see, there's probably a ton of candlesticks that you're already able to identify, whether it's a topping tail, bottoming tail, narrow range bar, wide range igniting bar, which is really good, or doji bar as well. So if you're already looking at these candlesticks and you're able to identify the different ones that we've learned about, that's fantastic. Looking at a downtrend, or actually this is a perfect example of an uptrend, and that's followed by a downtrend, right? We could see here, this white line is the 20-day moving average. We could see we're making higher highs, higher lows, until we actually reverse, and now we make lower highs and lower lows, right? So we're uptrending, then we go into a downtrend. And this is actually a screenshot of the NASDAQ ETF, the QQQ. So this is a very recent snapshot. So you can see that we went from an uptrend to a downtrend, right? Uptrend is higher highs, higher lows. Downtrend is lower lows, lower highs. Okay. Hopefully that makes sense. So just make sure you're able to identify whether an uptrend or a downtrend or a sideways trend is occurring. Okay, guys. And during the next class, we're going to be talking about the 20-day moving average, which is this white line. And I'm really excited to talk about that. It's extremely important. And hopefully this all makes sense, guys. And so now you guys should be pretty familiar with identifying several different types of candlesticks, and also identifying different types of trends that are occurring as well. All right, guys, have a good day. See you in the next class. Bye. What is going on, guys? Hope you guys are having a great day. And I'm very excited that you're watching this video and that you have committed yourself towards learning this course. And today we are going to be talking about a very, very crucial element of price action. And remember, price action is the only thing we use to perform technical analysis and analysis for trading when it comes to trading stocks or crypto. Okay, these are the very fundamentals that you have to innately understand if you want to succeed with trading. This is the meat and potatoes of trading. It's the absolute basics. So my recommendation is get out a notebook, grab a pen or a pencil, and make sure you take some notes so you really can digest this information. You need to understand this to move forward with the course, okay? So I have the presentation ready to go. So grab the pencil, grab the notebook, and I'm gonna turn off this camera real quick. Very good. And let's get started. So we are going to be talking about candlesticks, okay? And why do we use candlesticks? And candlesticks are the bars that you guys see on all of the price charts that we're viewing in the community or that you may have seen in the past. And those bars are, they're candlesticks. And I'm going to give you guys a little bit of history of the candlesticks, why we're using them and what they mean. So number one, we're using Japanese candlesticks, and they focus on the open and the close of a bar, okay? And we have to remember that when we're looking at a candlestick, that represents a time frame. So we're looking at the open of that time frame and then the close of that time frame. It's going to make a little bit more sense in a second here. So Japanese candlesticks, what they present is they show a graphic representation of the supply and demand for each time period's price action. And we have to remember that's how a market operates. It operates off supply and demand. Supply meaning the sellers, and demand meaning the buyers. Okay, that's how a market functions. There has to be buyers and there has to be sellers. And obviously, if there's more buyers than sellers, then the price is going to go up. And if there's more sellers than buyers, the price is going to go down. This is how a market functions. Okay, and candlesticks, they give us a representation of that, supply and demand of those buyers versus the sellers, okay? And maybe a lot of you guys have seen bar charts and versus candlesticks, or maybe you guys have seen like Heikin-Ashi candlesticks. I always 100% recommend Japanese candlesticks, which are just the regular candlesticks on TradingView or whatever platform that you guys are using. They're way more visual. They give you a very clear picture on the price action that's occurring. And like I said, they emphasize the relationship between supply and demand. Okay, if we understand the supply and demand of what we're looking at, of the stock or crypto that we're looking at, then we could take advantage, of that supply and demand and make a profit. That's the whole point. And that battle between the buyers and the sellers, right? This supply and demand element that I'm talking about, it's the most important part of technical analysis. This is what makes technical analysis. That's why it's so crucial for you guys to really pay attention and understand how to read these candlesticks. So how are they formed, right? And depending on which time frame you're looking at, a candlestick represents the price action that occurred during that time. So if we're looking at a 5-minute chart, right? Each candlestick on that chart represents 5 minutes worth of time, right? So for example, we talked about kind of the open and close of the candlestick. Let's say it's 10 a.m., right? And a 5-minute candle started forming. At 10 a.m., the candle, obviously, the 5-minute candle started forming. And then at 10:05, the candle stopped forming. And then the next candle started forming at 10:05. And then at 10:10, that one closed, and then another one starts forming. So you can see that every candlestick represents, a unit of time. And obviously on 15-minute charts, every candlestick represents 15 minutes worth of time. And on daily charts, every candlestick represents 1 day's worth of time. You guys get the idea. And if you're asking yourself, why are we looking at different time frames? I'm going to be talking about that later in the course, but it's very important that we're looking at several time frames and reading the candlesticks that are on several different time frames. And we're going to get into that a little bit later in the course. So let's start with the absolute basics on how to read candlesticks. Like I said before, candlesticks emphasize the open and the close of a bar, right? So if it's a green candlestick, that means price went up in that time frame, right? In that candlestick's time frame. So if it's a 5-minute chart, that means price went up in that 5 minutes. If it's a 15-minute chart, price went up during those 15 minutes, okay? So the bottom of the candle, or the body of the candle, this is known as the body. The bottom of it is where price opened. The top of it is where price closed, right? And these little lines here, you can call them wicks or tails. They represent the absolute lows during that time right here. And the upper wick represents the absolute highs of price during that candle's time. Okay, so if it's green, and obviously it closed higher than it opened. So that's why this is where it's closing, this is where it's opening. And the wicks, like I said, highs and lows. If it's a red candle, that means it opened at a higher price than it closed, right? That means it went down during that time frame. So it closed at a lower price than which it opened. These wicks, they represent the same thing, the absolute highs of that candlestick and the absolute lows of the candlestick right here. Okay, so if it's red, it went up. If it's red, it went down. If it's green, it went up. Okay, and the one question we always have to be asking ourselves here is, who won the battle? The buyers or the sellers? Okay, so let's look at this diagram to have a better understanding of what different candlesticks mean and how different candlesticks can form. So first and foremost, we have this is called a wide range bar, and this is one example where the candle opened at this price and closed at the absolute highs up here. If you guys see, there's no tails, right? There's no wicks, meaning it opened at the absolute lows and it closed at the absolute highs. That's why we don't have any tails. This is a very bullish candle. Remember, bullish means indicative of strength, meaning there's a lot of buyers. So this is a buyer heavy or buyer dominant candlestick. If you look at this one, we have here what's called a topping tail. Okay, and we're going to talk about how topping tails are formed during the next slides. But let's try to understand how a topping tail is formed here. So we open at the absolute lows, we rally all the way up here to form a high, and then the sellers come in and they bring it all the way back down to close here, right? So we opened here, we went all the way up, then we dropped and closed here. So opened here, closed here. So, this is a green bar, right? And a lot of you guys might be thinking, oh, it's green, that must mean it's bullish. It must mean it's a buyer heavy candle, right? Buyer dominant candle. But in reality, what happened here is we opened here, we got bought, and then the sellers came in, right? And they brought the stock or crypto all the way back down to close here. So although it's green, right, it's a very seller heavy candle, right? So this is a topping tail. So if we go here, topping tail, it's a clue that the sellers have taken control, right? Because the buyers brought it up to here, and then the sellers are bringing it all the way back down. The sellers have taken control. If we look at this candlestick, excuse me, you could see that the tail is actually on the bottom. So this is a, excuse me guys, so this is a bottoming tail. And bottoming tails are a clue that the buyers have taken control, right? Because we opened at this price, the sellers sold it and brought it all the way down to here just for the buyers to come back here and bring it all the way back up, right? So the sellers tried to bring it down, but then the buyers brought it right back up to finish at the highs, okay? And then right here we have a doji bar, right, where it's kind of the battle between the buyers and sellers are even, right? Because it opened here, it went all the way up, then it went all the way down, and then it finished here. So a doji bar shows kind of a battle between the buyers and the sellers, and a battle that nobody really won. They kind of finished even, okay? Same thing with this bar, Obviously the buyers won a little bit, but it's kind of like a, the sellers and buyers were very even. So what I want you guys to ask yourself is, looking at this candlestick, right? We know that it opened here and closed here. In this case, it opened here, dropped, and then closed here. So I want you guys to ask yourself, and maybe even pause the video, which candlestick out of this one and out of this one is more bullish? Which one is more indicative of strength? So pause the video, think about it, and come up with an answer, and I'll go over it just in a second here. I'll give you guys a chance to pause it. Okay, very good. If you guys chose this one, then you would be correct. This one is a stronger candle than this one. And the reason is for this one, right? It opened here, the sellers came in, and then the buyers, then were like, hold on, you can't bring this any lower, and they brought it all the way back up. You can think of this bar as battle tested, right? The sellers actually showed up, but the buying pressure was so strong that it negated all the sellers, and it brought the stock all the way back up to make new highs. In this case, we opened here and we sold here, right? We opened here and we closed here. We don't know if there were that many sellers during this bar. Maybe the sellers were sleeping. They weren't there, right? But this bar is actually battle tested, right? We had sellers shown up, but they were irrelevant. Here we just kind of closed at the highs after opening at the lows. So this one is way more bullish. Something to the buyers have really taken control. It's very buyer heavy. Looking at the red candlesticks, guys, it's the absolute same idea. We open here and then we close all the way at the bottom. There's no tails, meaning we open at the absolute, we opened at the absolute highs, we closed at the absolute lows. Okay. If we have a topping tail here, what happened was we opened at this price, the buyers showed up, they brought it all the way up here, and then the sellers came in and brought it all the way back down. So a topping tail, guys, is a clue the sellers have taken control. So the sellers have really taken control. There's a lot of selling pressure during this topping tail. Here, it's kind of the same thing. It's a doji bar. The buyers and sellers are mostly even, right? There was a battle, but nobody really won the battle, right? In this case, what we have here is we opened at this price, we dropped all the way back down, and the buyers came up, they bought it down here, they brought it all the way back up, and we still closed under the open, right? So that's why it's still a red bar, but since the bottoming tail, guys, it's a clue that the buyers have been taking control. So even though this is a red bar, it's still a kind of a bullish bar. And although this is a green bar, it's still a kind of a bearish bar, because we know that a topping tail is where sellers take control, a bottoming tail is where buyers take control. Hopefully that makes sense, guys. And let's kind of go into how they're actually formed, right? So if we have a 5-minute candle, and this diagram really shows that the importance of looking at different time frames, because candles can form in different ways, right? This 5-minute candle is the same as this 5-minute candle, but they formed completely differently, right? Here, it's right. We have 5 1-minute candles make up a 5-minute bar, and here 5 1-minute candles make up this 5-minute bar. But in this scenario, we have 5 candles that are going straight up, right? One after another, right? While here we have a big rally and then kind of, consolidation up here, meaning the candles, they're just staying at the highs of this candlestick, right? They're just staying here at the highs. So this kind of proves the point that candlesticks form in different ways. And that's why it's important to look at different time frames, because these two setups are different, right? This has different implications than this does. Okay, and we're going to be talking about that later in the course, but I just want to stress the importance now of looking at different time frames, because if the candlesticks have formed in different ways, that's going to give you information of what it might do next. Okay, so that's really what I want to emphasize. They could form in different ways, and that's important. So if we look at, for example, a 15-minute candle, this is another example of how they're formed, right? Here we have 3 5-minute candles. Here we have 3 5-minute candles. You could see this one's a little different. it's kind of a, we have a rally and then we just continue higher. Where here it's, again, rally and then we just stay at the highs. We don't really, continue higher. So they're formed in different ways, okay? And you'll see later on, once we actually start talking about different strategies, you'll start to really understand the importance of how the candlesticks are forming and the patterns that they're setting up in and how they look on the charts on different time frames, okay? But I don't want to overwhelm you with all that information now. For now, just understand that different candlesticks form in different ways when you look at, the smaller time frames or the larger time frames, okay? So that's what's important. So let's understand how bottoming tails are formed. So like I said, we open at this price, right? This is where we're opening, and we drop. So this is a larger time frame, and by looking at the smaller time frames, we see more candlesticks. We see exactly how this candlestick was formed and what went into it. So we open at this price. Excuse me, guys. I'm just gonna grab a sip of water. Sorry, guys. So we open at this price. We drop all the way down to make absolute lows, and then the buyers show up and they bring it all the way back up to make new highs. So this is a bottoming tail, guys. Remember, a bottoming tail, it's a clue the buyers have taken control. And this, it kind of makes sense, right? The sellers came in, but then the buyers dominated. They brought it all the way back up to make new highs. So this is kind of how, this gives you insight on how a bottoming tail is formed. And at the end of the day, we see that the buyers have taken control. Even if it's a red bottoming tail, right? We have a green one here. Even if it's red, you could still see that the buyers have taken control, even though, it's still closed at a lower price than it opened. So we opened here, we dropped all the way back down to make absolute lows, and then the buyers take control and they bring it almost back up to the highs, but not quite. So you could still see that the buyers have ended the move. The buyers have taken control. If we look at a topping tail, we open at this price, we rally, the buyers come in, it rallies, we make absolute highs, and then the sellers come in, they dominate, and they bring it all the way back down to make new lows, and we close at a lower price than where we opened. That's why it's red. And we could see that the sellers have taken control. So remember, a topping tail, very important. Topping tail is when the sellers have taken control, okay? Another example, even when it's green, we open at this price, buyers come in, they rally, we make absolute highs just for the sellers to show up, and they end the move. And although it's green, we could still see that the sellers have taken control, okay? With a doji bar, we talked about how a doji bar represents a battle that neither the buyers or the sellers won. And in certain circumstances, the doji bar is a very effective reversal and entry bar. So that's really important. A doji bar is an excellent entry bar. And we're going to be talking about that a little later once we actually start going through the strategies. Okay, so that's the end of this beginner candlestick class. And if you guys are a little bit confused on what these candlesticks actually mean, how to read them in sequences, or actually applying this information, just stay tuned. It's all going to make sense as the course progresses. But please just make sure that you understand what a doji bar means, how what topping tails mean, what bottoming tails mean, right? And just understanding that candlesticks form in different ways. And looking at how a candlestick forms gives us a lot more insight on what's going on with that stock or with that crypto. But we're going to be talking and going more into detail as the course progresses. Just make sure you understand everything we talked about today. Okay, guys, let me put my camera up one more time. So I would suggest also rewatching this video if you don't understand it completely, guys. Let me know if you have any questions, and looking forward to seeing you guys in the next section of the course. Thank you, guys. What is going on, guys? Hope you're having a great day. During the last class, we talked about the basics of candlesticks, and we learned some of the fundamentals of what candlesticks are, why we're looking at them, and what they really signify. And just for a reminder, they signify and they show the relationship between supply and demand, between the buyers and the sellers. And if we can understand the relationship between the buyers and the sellers in the candlesticks, and we could see the patterns and the way that they form and understand what that means, we could take advantage of it and find, hopefully super lucrative trades. So during this class, we're going to be going into the advanced candlestick course. So I'm going to share with you guys some additional details and some other types of candlesticks that are important to recognize. Okay. My recommendation is, if you haven't watched the previous course, if you're still kind of confused on topping tails, bottoming tails, what candlesticks are, how they show different time frames, then definitely take a step back, maybe reach out to me, ask me some questions before you go into the advanced course. Okay, so I'm going to turn off my camera. Perfect. And let us begin here. So this is the advanced candlesticks course. So let's get right into it. So for mastering candlesticks, we have to really understand that some candlesticks are more important than others, and they give us different types of information that we could use to base off of when we go into trades. And there are very specific candlesticks that we are looking for when we time our entries into stocks or crypto, right? And later in the course, when we actually talk about different strategies and different ways the candlesticks, the different patterns that they can form, it's going to make a lot more sense, and you're going to really see why we look for specific candlesticks in certain situations. And there are also specific candlesticks that we look for when finding reversals. And there are also specific candlesticks that can enhance trading strategies and increase the odds of success for a trade. So something that we need to emphasize is the way the candlesticks form. Number one, they give you different information about what's happening in the trade, and they also make trades a lot more potent. Where if you find a specific pattern or a specific strategy, having some specific type of candlestick that we're looking for can greatly increase the odds of that strategy working and you actually making money. So that's why it's important to pay attention here and master the candlesticks that we're about to learn about. So as a reminder, topping and bottoming tail is really important that you guys know this. Topping tails, right here, tail at the top, suggests that the sellers have taken control, right? The sellers have taken control for both, the green and the red bar. For bottoming tails, it's the opposite. It suggests that the buyers have taken control. Really important that as soon as you guys see these sort of candlesticks, you know exactly what they mean. And these bars are going to provide you lots of insight on the price action that's occurring with stocks or crypto, okay? And it's really useful when we pair these sort of candlesticks with the strategies that we're going to be learning. It's all about pairing things together to create a more potent trading setup, okay? So now let's go into narrow range bars. And a narrow range bar, they are bars that have a small distance between the high and the low of that candlestick, meaning there really isn't all that much price action that's happening, right? There's not, we're going to see an example in a second here. It's going to make a little bit more sense. They're pretty significant when they occur after a multi-bar move because, they might serve actually as a reversal candlestick. It gives you kind of more evidence that a reversal might take place, right? And they're also especially useful for buy setups, 1, 2, 3 patterns, and reversal setups. And we're going to cover that when we actually start with the strategy section of the course. So let's look at what they are. Here we have normal ranged bars, right? You see a big bar like this opened at this price, right? Dropped to these lows, went all the way up to these highs, and closed here. Same thing with this. These are kind of normal range bars. These are what narrow range bars look like. Whoops. You could see that there's not that much distance between the open and the close, right? The open and the close. They're kind of smaller candlesticks, right? So these are what they look like. So if you see a bar candle like this, just know it's a narrow range bar, okay? Make sure you're able to identify that. Wide range igniting bars. Okay, this is also really important to be able to recognize. A bullish wide range igniting bar is an above average size bar that has its open price near the lows of that time period and its close price near the highs of that time period. And it suggests that it's very bullish and that many traders are playing long. And we actually saw what this looks like during the beginner course. However, I'm going to show you guys another example in a second. A bearish wide range igniting bar is an above average size bar that has its open price near the highs of that time period and its close price near the lows of that time period. Suggests many traders are playing short. So this is a great example of what they look like. Just give me 1 second. I'm gonna have a sip of water in 1 second. So why are they bullish or bearish wide range igniting bars? Because here the open is near the lows, right? And the close is near the overall highs, right? We don't have a large bottoming tail. We don't have a large topping tail. Same thing here. We opened near the highs. We closed near the lows. And these bars show you that there is a new move that's being ignited, especially when it's coming from a consolidation. And I'm gonna show you guys examples of that later. Okay, but the whole point, you just make sure you recognize that these are igniting bars. Okay, they're bullish or bearish wide range igniting bars. Make sure you're able to spot one. Okay, and that's really all we're going to talk about. So for this class, if you're still a little confused on how we're going to use these candlesticks, don't worry, we're going to address that. The whole point of these 2 candlestick lessons is to, make sure that you guys familiarize yourself with identifying, for example, wide range igniting bars, narrow range bars, bottoming tails, topping tails. You should know when you see a candlestick that's, for example, a topping tail, you should be able to immediately say, hey, that's a topping tail. I know what I'm looking at. Or if you see a narrow range bar, it's important to look at that and be like, okay, that's identify it for what it is, right? So once you understand all of these candlesticks, how candlesticks show you different time frames, right? What's the point of them? You're going to be able to move on to the next section. Okay, guys. So hopefully this makes sense. Please reach out to me if you have any questions. And if you're, if you understand everything we've done so far with the candlesticks, you're finding it easy, then that's great, because you already just learned a crucial part of price action, a crucial part of reading technical analysis, and you're well on your way to finding trades, understanding what the candlesticks are doing to certain patterns, and it's going to make a lot more sense once we go over the strategy section. But proud of you guys for sticking with it so far, and I'll see you in the next class. Thank you. What is up, guys? Hope you're having a great day. I'm very excited for this section of the course because we are finally going to be going into some of the more exciting parts about trading. And specifically, we're going to be talking about the 20-day moving average today. And a lot of people out there, they trade with different indicators. Some people use MACD, RSI, Bollinger Bands, and other super fancy indicators. And frankly, I don't use any of those. I keep my trading extremely simple. But one of the main, I guess you can call it an indicator, one of the main indicators I do use is the 20-day moving average. And we're going to talk about how to use it and how to really take advantage of it, because I personally believe it is the ultimate and most useful tool in trading, okay? So first, let me show you guys how to actually put it on your trading view charts. And let me turn off my camera. All right. So once you have this blank chart, you've selected candles right here on trading view. You're going to go to indicators and you're going to type in moving average. And you could just select the simplest one. It's going to pop up here. It's going to say MA. Just go to this settings tab, go to inputs, and change the length to 20. And I'm going to make mine white. Okay. And there you go. The 20-day moving average is now on my charts, which is perfect. Now, let's go into how to actually take advantage of the 20-day moving average and how to use it. So, moving average. This is one of the fundamentals of technical analysis. This is, I would say, just as equally important as learning and understanding the candlesticks. It's just as important understanding how to use the 20-day moving average. So, let's talk about what are moving averages. Moving averages, they are lines that represent price action in a particular time frame, okay? So if we're talking about, let's say, the 20-day moving average, that line shows you the average price within the last 20 days, right? If you have a 200-day moving average, which is another one that I use, that shows you the average price of that stock or crypto in the last 200 days. So it's calculated by taking the average of a set of prices over a specific number of days in the past. So like I just said, 20-day moving average, it would be the average price of the past 20 days. A lot of people also ask me about exponential moving averages. That's calculated through emphasizing more recent price action. So the equation that you use for an exponential moving average, it puts larger weight onto the most recent price action, and it's much more responsive to new information that's coming out with that stock or crypto. Okay, it just weighs more recent price action heavier in the equation. And it doesn't really matter which one you use. You could use either or, but just make sure you stay consistent with it. If you have the simple day moving average, right, make sure you keep that across all of your charts. And if you use exponential, make sure you use the exponential on all of your charts. So the moving averages, especially the 20-day moving average, it's the ultimate stock or crypto directional guide. It shows where a stock or a crypto is trending and how much momentum it has. So it's a directional guide, right? And specifically, I know a lot of people, they use the 10 MA. But I only use the 20-day moving average and the 200-day moving average. We're going to be talking about the 20 during this class. So let's talk about some key guidelines. A rising 20-day moving average is indicative of positive market strength. Okay? That means it's bullish. There are more buyers than sellers. We want to see price and the candlesticks above the rising 20-day moving average. Okay, that shows strength, positive market strength. A declining 20-day moving average trending lower shows negative market weakness. And in that case, we want to see price below the 20-day moving average, and that would show bearishness or a negative, it would show market weakness. The sharper the slope of the moving average, the stronger or weaker the trend is. And we're going to look at examples of that. During a bullish uptrend, right? We know what an uptrend is now. During a bullish uptrend, stocks tend to retrace or pull back to the rising 20-day moving average. That's why we want the 20-day moving average above price, because during bullish uptrends, we see price actually pull back or retrace to that rising 20. During a bearish downtrend, stocks, they tend to retrace or rally to the declining 20-day moving average, right? So during downtrends, they retrace to the declining 20-day moving average. So whenever you hear the term extended, when price is extended, that means price is far away from the trending 20-day moving average. So if I ever say extension or extended, it means price is far away from the 20-day moving average. There's distance between price and the 20 MA. And in general, guys, always trade in the direction of the 20-day moving average, especially if you're a beginner. Trade with the trend. Don't go against the trend. So this is an example here where we have a rising 20-day moving average and it is under price. You could see that the candlesticks are over price. Or I'm sorry, the candlesticks are over the 20-day moving average. And we can see that during a bullish uptrend, right, we have higher highs, higher lows. Price tends to retrace or pull back to the rising 20-day moving average. And then from there, it increases again, pulls back to the 20-day moving average, increases again, pulls back to the 20-day moving average. Okay. And so my question for you guys is, can you find the different types of candles that we've learned about? Narrow range bars, tails, or igniting bars. Take a look at this chart and try to pinpoint some of the different candlesticks we've learned about. Go ahead and pause the video and just try to write them down. I'll give you guys a second to do that. Okay. So what we have here is we have a clear topping tail right here, right? Huge tail. The sellers have taken control. Price then dropped. And then we have right here an igniting bar, right, where the opening price is near the lows, the closing price is at the highs, and it ignites a new move higher. We also have one here, right, ignites a new move higher. And then right here we have two narrow range bars, which, you know, are kind of our entry bars in this uptrend. And we're going to talk about entry bars later. Okay, but if you were able to identify these candlesticks, then perfect. You're doing great so far. Let's look at the 20-day moving average when it's declining. Remember, when we have a falling or trending, a falling and trending 20-day moving average that's, you know, trending lower, we see that price is under the 20-day moving average, and whenever price drops, it usually retraces to the declining 20. Drops, retraces to the declining 20, drops, and then now we could see that in this case it based into the declining 20. So the 20-day moving average for both uptrends and downtrends, they can be kind of used as also support, right? It's kind of acting as support for the stock during an uptrend, and it's acting as resistance for a stock or crypto during a downtrend. Hopefully this all makes sense, guys. This is a sideways trend, right? It's kind of fluctuating between highs and lows. Whenever we have a sideways trend, we also usually have a 20-day moving average that is flat and moving through price, meaning there's no noticeable trend that's taking place. And usually, guys, whenever you have a flat 20-day moving average, it shows that there's a lack of trend, and you should avoid that. So don't trade. If you see a flat moving average, it usually suggests that there's no momentum, there's no clear trend, and you know, you generally want to stay away from stocks or crypto that are not trending, right? The whole point, if something's trending, it has momentum, meaning we could take advantage of big moves higher, or we could short, you know, big moves lower. Okay, let's look at some examples. You could see right here, this is the 20-day moving average. We are trending higher, right? We are under price. You could see that every time price touches the 20-day moving average, every time it retraces to the 20-day moving average, it goes higher. So if you guys were to buy it every time price touched the 20-day moving average or got close to it, you would have made money. And once we go into the strategy section of the course, we're going to actually use the 20-day moving average and create a strategy, right? And the strategy is, you know, whenever it comes close, whenever it pulls back to the 20, that's what we buy. It's called a buy setup. We're going to be talking about that later. Okay. In this case, we have a declining 20-day moving average, this blue line. You could see how it's overpriced, and you could see that, you know, price touches the 20 and drops. Price of the 20 touches the 20, drops. Bases into the 20-day moving average, drops. Bases into 20, drops. So you could see that the 20-day moving average is acting as resistance here. And it's declining, it's trending lower, and we would short it every time it touches the 20-day moving average. Let's look at another example. You could see how well price is respecting the rising 20-day moving average, right? Right here, base, right? Right, as soon as it touches the 20-day moving average, it breaks out. Same thing here, as soon as it touches, breaks out. And the main point here is that we could see that it's trending higher and it's under price. Okay. Slope and extension of the 20-day moving average is significant, and we have to remember slope, right? That is the measure of steepness of a line, right? So if you guys have ever taken math classes, I'm sure you guys have calculated the slope for different math questions before, but we got to remember 20-day moving average is a line, right? When we measure the slope of it, we measure how steep it is. So we want to, ideally we have something that's 45 degrees. 45 degrees is ideal because it shows that it's sustainable, right? The move is sustainable. The uptrend is sustainable. If it's higher than 45 degrees, right, where if it's kind of like, this is more or less 45 degrees, but if it's even steeper than this, then it shows that the current move is not sustainable. If it's less than 45 degrees, then it's going to be on the more flat side, and it's going to lack momentum. We talked about before how we want to avoid trading flat moving averages. Flat moving averages, specifically for the 20 MA, when it's flat, it shows lack of momentum. We don't want to trade stuff that doesn't have momentum. And the distance or extension between price and the 20-day moving average tells us if it's overbought or oversold. So let's go into it. You could see we have a solid uptrend. The moving average is it's not quite at 45 degrees, so it's a little bit flat, but still price is respecting it. And you could see how it's getting steeper and steeper and steeper. And eventually we have a large distance between the candlesticks and the moving average. Right here, this is extension, right? This is distance between price and the 20-day moving average. And you could see that the moving average was getting steeper and steeper and steeper. And eventually this move was no longer sustainable. And we ended up, I remember, dropping after this. And you could see how well price is respecting the rising 20-day moving average. Same thing here. I believe this is on Bitcoin. We broke out here, 20-day moving average trending higher. It's underpriced. Touched it here, popped. You could see every time it retraces to the 20, it continues the uptrend. And right here is when we have extension. So this is where you would want to look for a short position, right? We have extension from the 20-day moving average. And you could see the steeper it got, the less sustainable the move was, and we ended up dropping and starting to go sideways here. Okay? So look at another example. Same thing here. We're uptrending. The 20-day moving average is underpriced, trending higher. Every time price touches it, it rallies. You could see how well it's respecting it. Here it got a little steeper. You could see right here, it starts to get steeper. Then we have extension, right? We have distance between price and the 20. Here we don't really have any distance. Every time we have distance, it pulls back. But here we have pretty significant distance and extension. And then we ended up dropping from there. Okay, so we would look for a short in this position. Another example, you could see how well it's respecting the 20. And then you can see the 20 is getting steeper, steeper, and steeper. And from right here, this is no longer sustainable. This is where we're going to be looking for a short, especially with the extension that we have. Okay? So another very useful way to use the 20-day moving average is for spotting price transitions. When stocks or cryptos are ready to transition into an uptrend or a downtrend, the moving average will begin to curl and hug under price for a transition higher, or curl and hug over price for a transition lower. This is really effective for the larger time frames and for longer term trades or swing trades. And usually the time frames you're going to be looking at is the hourly, daily, weekly, or monthly. Let's look at some examples. As you can see here, this stock, I believe this is actually AMC. This stock is sideways, right? We don't have a clear trend, right? It's not really going anywhere during this time period. You could see the moving average is flat and moving through the candles, through price, until right here, you could see that we have a rally and the candlesticks were halted by the curling 20-day moving average. They stopped here, and that's when we had the breakout, the price transition. As soon as we started curling under price and pointing higher. Same thing here. When the 20-day moving average is trending higher, you could see prices respecting it. But as soon as the moving average becomes flat and moves into price, through price, we could see it doesn't respect it until right here. We see prices starting to respect it. We're seeing it curl higher, and that's when we get the breakout and we go higher. So you could see that right before these big breakouts, the 20 MA is curling under it and starting to point higher. Let's look at PRTA. This is a really good example where PRTA, we could see that the 20-day moving average is starting to curl under price, right? Starting to curl under and point higher. And we could see that this is clearly a price transition. And this is the monthly chart. So each one of these candlesticks represents a month, and that's where we had the big breakout as soon as it started curling under price like that. But if we go to the daily chart of PRTA, so every one of these candlesticks represents a month. If we go into the daily chart, right, then we see something a lot more interesting where when the moving average is going through price, it's flat. We don't have any moves, but as soon as it starts to curl higher and under price, that's when we get the transition higher. Okay? Same thing here. As soon as it moves under price and curls higher, that's when we make a move up. Same thing here. It's flat, trendless, nothing's going on. Right here, it starts to respect the 20 MA, it starts to curl higher, and that's when we have the breakout, right? And you can see as soon as it started trending, that's when we started continuing higher. And okay, this is the last slide. So trade with the trend, guys. Your odds of success are greatly increased when you're playing in the same direction of the 20-day moving average. The correct entry is when price is at or near the 20-day moving average, not when it's far away. Let me show you an example of that, right? So we want to be buying it during this uptrend when the moving average is below price. We want to be buying it when price is at the 20 MA. Because when it hits the 20 MA, it goes up. When it hits the 20 MA, it goes up. When it hits the 20 MA, it goes up. So we want to be buying it when it's at or near the 20-day moving average. Just like we want to be shorting it when it's at, right? Rallies into the 20, we short. Rallies into the 20, we short. Goes into the 20-day moving average, short. Goes into the 20, short. Okay? And as soon as we see some price extension, that's when we begin to rally because we're extended. Okay? Hopefully that makes sense, guys. Let's go. And the 20-day moving average becomes extremely useful when you pair it with tradable patterns and strategies. So we're going to be combining this 20-day moving average with a real trading strategy later in the course. So you don't want to just enter because you have a rising or declining 20-day moving average. You want to have a pattern. And there's specific things we look for in that pattern when you combine it with the 20. We're gonna talk about that a little bit later. Okay, so main points here is that it's an excellent directional guide and it shows you what's going on with the trend. If we have a uptrend, we want the 20-day moving average under price and trending higher. If we have a downtrend, we want the 20-day moving average over price, trending lower. If it's sideways, it's not really that effective. Okay, that's kind of the summary here. Make sure you kind of watch this class a bunch of times. And my biggest recommendation, guys, is go and put the moving average, the 20-day moving average, right, on some of your charts and just start watching, how price actually respects it during uptrends or downtrends, okay? And you'll just watch how price really trades off of it. And that's what makes it such a powerful and useful tool. So make sure you do that. And this was an excellent class, guys. Looking forward to seeing you guys in the next one. Thanks. What's going on, guys? Happy to see you here. We're going to continue our moving average class, and today we're going to be talking about the 200-day moving average. Now, we've already discussed the 20-day moving average, which serves as a short-term to medium-term moving average, but today for the 200-day moving average, that one's going to serve more as a longer-term moving average. And I want to really emphasize that I only use the 20-day moving average and the 200-day moving average as my indicators because I think the most brilliant things in life are often the simplest. And I try to keep my price charts and my price analyses very simple, easy to understand. I don't want to have random indicators such as MACD, Bollinger Bands, RSI, all these fancy indicators telling me different things and ultimately confusing me, right? I want to have my charts just a clear reflection of what's going on with price. And that's what the moving averages do for you, right? The 20-day moving average shows you the average price in the last 20 days, while the 200-day moving average shows you the average price in the last 200 days. Okay, so I'm going to show you guys how to put it on your charts on TradingView. Just go to indicators. Once again, write moving average. We're going to select it. It's going to pop up on the left over here. We already, adjusted this one to make it 20. So now we're going to adjust this one to make it 200. And there you go. Now you have the 200-day moving average on your charts. And like I said, guys, this is all I have on my charts. I also use volume. We're going to talk about that later. But I only use the 200 and the 20. And it makes my trading simple yet extremely effective. Now, let's hop into the course. And let me actually... I think my camera might have been up while I was doing that. So just to show you one more time. Moving average. We press it. Comes on the side here. Change length to 200. And that's it. Okay? Now that I have my camera off, let's start the class. So the 200-day moving average, let's get into it. One of the best uses of the 200 is it acts as support and resistance for stocks and crypto, right? So when price is above the 200-day moving average, the 200 is going to act as support for price, kind of like a floor for price. However, when price is below the 200-day moving average, the 200 is going to act as resistance or like a ceiling for price. And this is especially true if the stock is extended and puts in 3+ consecutive green or red bars to the 200-day moving average. So if you have 3+ consecutive green or red bars that directly go into the 200, we often see a reversal because the 200 is going to act as support or resistance. And the 200-day moving average, unlike the 20, is most effective when it's flat, right? We learned that the 20-day moving average, whenever that one is flat, it shows lack of momentum, lack of trend, and we want to usually avoid 20-day moving averages that are flat. With the 200 is actually quite the opposite. We want a flat 200-day moving average. It's most effective when it's flat, okay? And another thing I want to emphasize here is that in general, if you have price above the 200-day moving average on several time frames, especially if it's the larger time frames such as the hourly, the daily, or the monthly charts, it shows that in general the stock has, it's bullish, right? If it's above, if it's above the 200 on most time frames, that's indicative of positive market strength. However, if price is below the 200-day moving average on some of the larger time frames, then that shows that it's actually, overall, it's indicative of negative market weakness, right? Because if price is below the average of the last 200, it makes sense. It's weak. However, if price is above the average of the last 200 days, it shows market strength. Okay, hope that makes sense. So just to show you guys some examples, right? This is the 200-day moving average. As you can see, it's kind of serving as a floor for stocks or for this stock. You can see that every time it touches the 200, it acts as support, right? Touches, rallies, touches, rallies, touches, rallies. And we also see that the 20-day moving average starts curling higher and trending higher. It's underpriced, and that's when we have a nice rally. So this is a good example of the 200 acting as support, and then the 200-day moving average or the 20-day moving average transitioning and having the price go higher. Let's look at another example. We talked about before this idea that if the stock is extended and we put in 3+ consecutive green or red bars into the 200, it usually kind of bounces. This is a good example of that, especially from here. We have 1, 2, 3 big red bars right into the 20-day moving average, right into the 200-day moving average. Here we have a narrow range bar. That's kind of like a reversal bar. We have it higher and we move higher. Okay, so drops right into this 200, acts as support, moves higher. This is another example of it. Acting like resistance. We challenge it here. It drops, challenges it again, drops. Once again, hits the 200, drops. Kind of gets near the 200, drops. Same thing here. You could see that the 200-day moving average is kind of acting as resistance. It's a ceiling for this stock or crypto. And I believe this was like the daily chart of the QQQ. Another example, you could see the 200. Even when it's not flat, it still can act as support. You could see it gets near it, pops. Right here, it touches it every time it respects it. Same thing here. So you could see it acts as a floor or as support for this stock. And you could see here, as the 20-day moving average starts curling under price and trending higher, you could see how well the candlesticks are respecting the 20-day moving average when it's trending higher, right? Same thing right there. Another example, it's acting as support here, here, there, and then as soon as it breaks the support and we have this 20-day moving average that's trending lower and curling lower, that's when we gap down and we continue lower. So you're kind of seeing and noticing how I'm combining both the 20-day moving average and the 200. So you're starting to see how all of these, how the moving averages are coming together. Now let's talk about the 200-day moving average breakout. So when you combine a rising 20-day moving average with a flat 200-day moving average, it can create a very powerful breakout opportunity. And we see that price oscillates between the flat 200 and the rising 20 until a breakout is imminent. What is going on, guys? Hope you're having a great day. We have finally reached the strategies section of the course where I'm actually going to be teaching you different trading setups that you can begin spotting on your charts and hopefully taking advantage of. Okay, so this is finally the most exciting part of the course. But before we go into some of the presentations that I have prepared for you guys, I want to talk about a very important concept, and this is going to kind of preface the other strategies and the other presentations that I have prepared for you guys. And that concept is price correction. Okay, so I'm going to draw a diagram here for you guys. So what we have to understand is that with price action, whether it's for a stock or a crypto or Forex, it really applies to any financial instrument on the market. What we have to understand is that price always corrects itself in some way, right? Prices can't just go infinitely higher. At some point, we are going to have some sort of price correction. And that price correction could happen in two different ways. It could either happen through a pullback or a retracement, or it can happen through a consolidation or a base. So let's first talk about the pullback, right? So let's say we have a really bullish rally, right? We're in a very bullish stock. There's a lot of buying. There's a lot of, strong momentum. After a really strong rally, right? At some point we have to see some sort of retracement or some sort of base, some sort of price correction, right? So price can correct itself in the first way through a pullback, where when a pullback happens, right, we get a minor drop, where perhaps the reason of this is there's a lot of buyers who are buying it down here or buying it over here, and they're enjoying their profits as the stock or crypto is rising, and at this point they want to start taking profits, right? So all those buyers start taking profits, which leads to a drop, or in other words, a price correction. Or perhaps there's a ton of people up here who are skeptical that the stock or crypto is going to continue higher. So what they do is they short it up here, thinking they're going to make money, if this thing drops in price. Okay? So that's one way we could have a price correction. And of course, after the correction, right, ideally, if it's a really bullish uptrend, right, if there's a lot of buying pressure, a lot of buying momentum, we're inevitably going to continue higher, right? So our goal is to buy it where? Our goal is to buy it right down here, right? If we missed the opportunity all the way down here, our goal is to buy it during the correction, right? Why? Like, our goal isn't to buy it at the highs, it's to buy it on the pullback, right? Because after you would assume that price has corrected itself, we're ready to continue higher again. This, my friends, is called a buy setup. Okay? This is a buy setup. So that is one of the strategies that we're going to be learning, right? Buying, you could think of it as buying the dip. I know that's a really popular phrase, but this is what that is. And that dip, like I mentioned, is a price correction. So we are buying this price correction. So that's one way price can correct. Another way price corrects is, let's say we have the same rally, we have a huge rally. We can correct through time, or in other words, through a consolidation or a base, right? Where we actually just stay at the highs of this rally, right? Maybe at this point, there aren't enough buyers to, propel this stock or crypto higher. And there's also not enough sellers to, cause it to pull back. So instead, we just sort of base, we just sort of stay at in this price range, right? Where we don't have enough buyers to bring it higher, but we also don't have enough sellers to bring it down. So we end up just consolidating or staying near the top of this base, right? Before we inevitably continue higher. And our goal, right? Our goal is to buy it as soon as it breaks out of that base, right? After, as it's consolidating, right when the price correction has finished, our goal is to buy it at this point and enjoy the move higher. And this strategy is called a breakout. Okay? And specifically, a base breakout. Okay? So this is kind of the fundamental anatomy of the two strategies that we're going to be talking about first. We're going to be talking about the breakout first, and then we're going to be talking about the buy setup. But something that's important to note from listening to everything I'm telling you guys in this presentation is this is how price corrects itself, right? And based on how price corrects itself, we could find opportunities, okay? We can find opportunities to get into the stock and enjoy the next move higher, right? Because to be honest, guys, you're not always going to be able to buy it down here or buy it down here, right? Sometimes you're going to be late to the party, but you have to identify the points where price correction has completed and we're ready to continue higher, where price correction has completed and we're ready to buy the breakout and enjoy the next move higher. Okay? Hope this makes sense, guys. And in the next class, we're going to be specifically talking about the base breakout. Okay? So make sure you understand this concept and understand that price cannot go infinitely higher. It cannot go infinitely lower. At some point, there needs to be some sort of correction. Okay? And I'll see you guys in the next class, guys. We're going to be talking about the base breakout. Thanks. What is going on, guys? Hope you're having a great day. Today, we are going to be talking about the base breakout. And hopefully you guys understand what we talked about in the last class and how price corrects itself in two ways, either through a pullback or through a base. Okay, and today we are going to be talking about the base breakout or the base breakdown setup. Okay, so let's get right into it. So the base breakout, what is it? This is one of the most potent and fundamental trading strategies that exist. In fact, this is my favorite trading strategy that exists. I make money off this setup every single day, okay? Because I see it all the time. It's a very, well-known setup. And if you know how to play this setup correctly, I can promise you, you are going to make a lot of money trading, either whether it's stocks or crypto or Forex, okay? It's that powerful of a setup. And like we talked about, a base or a consolidation is a period of time when a stock or a crypto is trading in a particular price range. It's not moving out, it's not moving above or below that price range, right? It's sort of staying at the same price level. And our goal as traders is to take advantage when price breaks out or breaks down out of that range, right? We're timing our entry when price breaks out or breaks down. This works on any financial instrument, including stocks, crypto, and Forex. Okay, this also works on any single time frame, and it's a very good high reward to risk setup. That's one of my favorite parts about it. So let's understand the anatomy of the base breakout. And we kind of looked at this before, but let's try to get a deeper understanding. So like we talked about, price corrects itself either through a pullback or through a base. Okay, so in this case, we're talking about the base. So after a large rally higher, we have a base where price is sort of, it's not trading above or below this price range. We're just sort of chilling at the highs of this rally, right? And our goal as traders is to find the moment that price breaks out of this range and continues higher. So we want our timer entry over here, right here, okay? And we have to understand that in a bullish uptrend, right, if there's a lot of buying pressure in that stock or crypto, after a large move higher, oftentimes it's going to correct itself through a base. So it's really important that you guys can identify when this is happening so you could take advantage of it and take advantage of this point right here so you can enjoy the next move higher and hopefully make a lot of money. Okay, and I believe that's all. So just remember, guys, during this process, price is correcting itself. And as soon as it's done with the correction, we're ready to continue higher, and this is where we're buying it. Okay, so this is kind of a little graphical representation of this. We have a rally, and then we have a bunch of candlesticks that are trading in, at the highs of this rally. We're trading in this price range. And just understand that at the top of the base, right, at the highs of the base, that is an area of resistance, right? Because the candlesticks are sort of respecting that high of the base. So it creates a resistance. And the same thing happens at the lows, right? The candlesticks are respecting the lows of the base, right? And that's going to be support. So if you ever see a base like this, just understand that over the highs of the base, we have an area of resistance there. And under the lows of the base, we have an area of support there, okay? So let's talk about the actual base breakout setup and our entry and stop loss, okay? So we have the rally, we begin to consolidate, right? We are going to place our entry over the highs of the base, and we are going to be placing our stop loss under the lows of the base, right? So let's say you have a base like this, find the absolute highs, right? In this case, it'd be over this candle, and place your entry over the highs of that base. And my recommendation is, let's say the highs of the base is, let's say it's $6. You want to place your entry at about 602, 603. You want to give it 2 or 3 cents room, okay? So you give the stock or crypto the actual room to break out and truly break out of this resistance, okay? And the reason our entry is above the highs of the base is because that's when price is breaking that resistance, right? We're timing our entry with the break of this resistance, all right? And for our stop loss, we're placing our stop loss under the lows of the base because that's where we have an area of support. So this is super easy, guys. If you see a base and you wanna play it, you wanna get into it, entry is over the highs. Find the absolute highest point of the base and place your entry above that high. Place your stop loss under the absolute low of the base, okay? That's your entry and your stop loss. Pretty easy stuff. Now, let's talk about the 20-day moving average requirement. We already reviewed the 20-day moving average and how important it is. And we know that we want to see the 20-day moving average either trending higher or trending lower, right? If we're bullish, we're in an uptrend, we want to see the moving average trending higher, ideally at a 45-degree angle, and under price, okay? So that's what we need here. For a base breakout, we want the 20-day moving average to be trending higher and under price. That is a requirement. You need to have that if you want to play the base breakout. It is the most crucial requirement, okay? And the reason we want it is because oftentimes during a really bullish uptrend, stocks and crypto, they tend to base into the 20-day moving average. They tend to just, consolidate right into it And as soon as it's at or near the 20-day moving average, that's when it ends up breaking out. Okay, this is just something that happens. Okay, and we're going to show you guys examples of it soon. So something to understand is that at this point right here, right, let's say we're right here, we are extended from the 20-day moving average, right? And by extended, we learned about this prior, is that we know that extension means distance. There's distance between the 20-day moving average and price, meaning price is kind of overbought, right? It's a little extended. So what do? We need to have a price correction. So we end up basing. And as we're basing into the 20-day moving average, price is correcting itself and it's getting ready to make the next move higher. So our goal is to time your entry when price has based into the 20-day moving average, or we just want at least the 20-day moving average to be near price. Okay, we don't want to be buying it here because right here, there's still some distance between the 20-day moving average and price. There's still some extension. We want to be buying when it's at or near the 20-day moving average when there's no extension. Okay, when there's we're not overbought at all. Okay, hopefully that makes sense. So overarching theme here, guys, is for a breakout, make sure the moving average is trending and underpriced, and you want to be buying it at or near the 20-day moving average. Okay? Let's continue here. And this is something that I oftentimes see. What I see often is a rally higher, then we begin to base. We begin to consolidate. As soon as we hit the 20-day moving average, we have that breakout. And our price is going to be at this resistance level, right? It's over the base. This line is directly over the base. This is our entry point. So we would be entering as this green bar is being formed. We would enter right there, and then we would enjoy these profits going higher. Now, oftentimes what I see is after this primary breakout, after we break out of this resistance and we continue higher, I often see us having another sort of price correction, but this time it happens through a pullback. So after this rally, we actually pull back, okay, and we form a buy setup, or you could call it a secondary breakout. We're going to be learning about the buy setup later, but oftentimes after this initial breakout, we pull back, we form the buy setup, and then we continue higher. And you can think of this as a pullback pattern. Right? Like I said, we're going to be learning about that in the next class. But what I really want to emphasize here is oftentimes this line right here, this entry point, this is serving as resistance, right? We're buying it when it breaks the resistance of the base, over the highs of the base. But this prior resistance level, right, is now turning into support for the stock or crypto, where we actually pull back to this prior resistance, which is now support. So during this point, it was acting as this resistance level was acting like a ceiling. As soon as we broke out of that ceiling, it's now turning into support. And we retrace right back to that support level before we continue higher. Okay? Now, this doesn't always happen, but I think it's something to, show you guys. I think it's important. Here's an example of that. Okay? Where we have a large rally higher, right? Look at this. We have a rising 20-day moving average. We have a huge rally higher, okay? At this point right here, there's significant extension between price and the 20-day moving average. Price needs to correct itself in some way. So first, we have a pullback, and it sets up as a pullback pattern or a buy setup, right? That triggers higher, that goes higher. But there still needs to be some sort of correction, right? This was a huge move. It needs additional correction. So what do? We base, and we stay in this price range, and we stay in this price range until eventually the 20-day moving average, this blue line, starts to curl under price. It starts to trend higher, and that's when we get the base breakout right here, where this red line is the entry point, this red line is the resistance. We break out of that resistance and we enter right here. We rally higher before we have that pullback. And this prior resistance, which was our prior entry point for this primary breakout, it now becomes a support for this pullback. Okay, hopefully that makes sense, guys. All right. Okay, very good. Next, excuse me, we're going to be understanding the base breakdown, which, guys, the base breakdown is the absolute opposite of the base breakout. It's the same exact thing, except it's the opposite. We're going to be taking advantage of shorting it. Okay, but nevertheless, I'll go over it. As we know, price corrects itself in two ways, either a pullback or a retracement or a base. So we have a drop, right? Let's say this is a downtrend, right? It's clearly a downtrend. We have a lot of bearish momentum. There's a lot of selling pressure. We have a drop and we consolidate at the lows, meaning, right, we have a drop. It wants to continue lower, but it needs to correct itself first. So it corrects itself through the base. We're chilling at the bottom of this drop. Before right here, we have that breakdown. We short it. We have a nice move lower, right? We short it right here once it's breaking below this base. That's why it's a breakdown, right? We have a drop. And then we start to base again at the lows of this rally, right? And we have another breakdown here where we're trying to enter when price is breaking down out of this bearish consolidation. Okay? So like I said, guys, our goal is to catch the moment price breaks down and enjoy the next move lower, and we're shorting it. Okay? And we have to understand that in a bearish downtrend, whenever we have a downtrend, price tends to base after a large drop. That's just what happens. Okay? That's the way price tends to correct itself. It tends to correct itself through a base at the lows. So the same thing here. After we have a drop and we have this consolidation, we have these candles trading in this price range. At the bottom of the consolidation, we have an area of support. And at the top of the consolidation, over the highs of the base, we have an area of resistance. The same exact thing as we discussed before, except the opposite. So what's the entry? It's the same exact thing, except the opposite. Our entry is going to be under the lows of the base, and our stop loss is going to be over the highs of the base, right? Because we are entering when price is breaking that level of support. That's when we're timing our entry. And we are placing our stop loss over the highs of the base because that's where the area of resistance is. Okay? So yeah, to emphasize, we're trying to enter when it's breaking that support. And that's where we enter and we enjoy this move lower. Okay, so entry under the lows of the base, stop loss over the highs of the base when we have a breakdown. Okay, very good. Let's continue. So just like the breakout, we have a very strict 20-day moving average requirement. Like I said before, we want the 20-day moving average to be trending lower and over price when we're in a downtrend or when we're bearish, right? We want it to be trending lower and over price. So that's a requirement. And oftentimes, stocks and crypto, they base into a declining 20-day moving average. This is the way they correct themselves. Because as of right here, at this point here, price is extended from the 20-day moving average. And by basing into the 20-day moving average, we have that price correction and we're finally ready to short it as soon as it breaks under that base. And we want to time our entry when price has already based into the 20-day moving average. Okay, it's the same exact idea, guys. And same exact idea here as well. We have a drop, we base, right? Our entry, this is our entry point, which is the area of support. So we're timing our entry when it breaks this area of support, right? This is the primary breakdown that we're playing. We're at the 20-day moving average. We drop, right? Because remember, we shorted it here below the base. This is the primary breakdown. And oftentimes we have a retracement. And this retracement goes back to the declining 20-day moving average. And also it goes to the initial area of support, right? Our entry that's now becoming resistance for this stock or crypto. Okay, and this is our first retracement to the 20. This previous area of support has now become resistance. Okay, this doesn't always occur, but I thought it was important to share it with you guys. And we're going to be talking about reward to risk in the next class. What is going on, guys? We're going to be continuing the presentation exactly where we left off, and we're going to be talking about reward to risk. And this is one of my favorite parts about the base breakout, is the reward to risk aspect of it. And my biggest recommendation, guys, is after you watch this class and later on in the course, after you watch my risk management and share sizing course, please come back to this section of the course after you understand the risk management, after you understand share sizing. And I think this whole section of the breakout is going to make a lot more sense. But nevertheless, I'm going to introduce this concept to you guys right now. But just keep in mind, you may want to come back to this part of the video in the future. So my question for you guys is, out of these two setups, which one is better in terms of reward to risk? Okay. Is it number one or number two? Right? And pause the video, take a second to think about it. Which one do I like better from a reward to risk standpoint? Which one has a lot higher potential? A lot higher potential to be lucrative, right? Which one has the higher potential to make us a ton of money? That's what we're here to do. We're here to make money. So if you guys have thought about it and you guys selected number one, this one right here, you would be correct. Let's talk about it. So over the base, we have our entry point, right? We always place our entry over the base. So for both of these setups, our entry is at $3, right? Over the base is at $3. Over this base, we have $3, right? But let's say our stop loss, right, it's supposed to be under the base. In this situation, it's at 290, right? It's directly under. We have 290 as the price of our stop loss. However, in this situation, the base, you could see it's a little bit of a larger base. Our stop loss is under it, but it's at $2.70, right? So this one's at 290, this one's at 270, okay? So we have the same entries, but different stop loss prices, okay? So what is the size of our stop? Well, the size of our stop, all we have to do is subtract the stop loss price from the entry price, right? So $3 minus 290 is 10 cents. The size of our stop is 10 cents. So in other words, if we enter this setup, this breakout at $3, if our trade drops by 10 cents and hits 290, we are out of the trade, right? That is our risk. If it drops 10 cents from our entry, we are out of the trade. Now in this case, our entry is at $3, our stop loss is at 270. $3 minus 270, that's 30 cents, 30 cent stop size. Meaning if we get in at $3, that's our entry point, and it drops 30 cents, right, to 270, the bottom of the base where we have support, that's when we exit the trade. Okay? So hopefully that makes sense. Stop size 10 cents here, stop size 30 cents here. If we are risking $100 on both of these setups, meaning $100 is the maximum amount that we could lose for this trade, right? $100, like we can't lose more than $100, right? What are we gonna do? We have to share size accordingly, right? So if we're risking $100 with a 10-cent stop, right? Meaning if we get in at $3 and it drops 10 cents to 290, if it hits 290, we're out of the position. How many shares do you have to buy to ensure that if this drops by 10 cents and hits the stop loss price, we only lose $100? And I'll make it easy for you guys. The formula is take your risk, your dollar amount risk, which is $100, divided by the size of your stop, which is 10 cents. So 1,000 shares. Meaning we could buy 1,000 shares at $3, and if it drops 10 cents to our stop loss price at 290, we will lose $100, which is the maximum amount we are willing to risk. In this scenario, we're still risking $100. The risk is the absolute same. We're risking the exact same amount in both of these setups. However, in this case, we have a 30-cent stop, right? Because our stop loss is under the base at 270. So if we're risking $100 per trade with a 30-cent stop, well, the risk unit, $100, divided by the size of your stop size is 30 cents. 100 divided by 0.3 is 333 shares. Meaning, if you get in at $3, and if this drops 30 cents and you bought 333 shares and it drops 30 cents, you will lose the maximum amount you're willing to lose, the $100. So, looking at what I've presented you right now, you must have an immediate conclusion. And that immediate conclusion is the tighter the base, meaning the smaller the base, right? That you could see how this one is all sloppy. It's all over the place. It's a large base. It's not tight like this one. You can see this one's tight. It's small. It's clean, right? It's not sloppy and with a lot of tails and all that, right? The tighter the base, the tighter the stop loss, right? In this case, the tighter the base, we have a smaller stop size here than there, the better the reward versus risk. Because think about it. We're risking $100 in each of these setups. However, because we have a smaller base here, we have a smaller stop size. With a smaller stop size, we're able to purchase more shares, right? If we're able to purchase more shares, well, that means our reward is a lot higher, right? Like if this goes up $1, right, we're going to make $1,000. However, in this situation, with this entry and with this stop loss, if this goes up $1, we're only going to make $333, okay? So we're risking the exact same amount, but our potential reward with this tight base and this small stop size is significantly higher. So guys, always look for tight bases, really clean, tight bases, as opposed to really sloppy bases that are all over the place, because the risk to reward is going to be way better. And honestly, the tight bases, the clean looking bases that are not sloppy, they tend to work a lot more often too. Okay. And like we talked about, we have the share sizing formula. It's going to be your risk, your dollar amount risk divided by your stop size. Okay. And in order to calculate stop size, just subtract your entry from your stop loss price, right? $3 minus $2.90. And how are we setting? Where are we getting $3 and $2.90? Well, remember, the entry is over the base. The stop loss is under the base. So when you see a base like this, draw a line over the base, see what price that is. Draw a line under the base, see what price that is. Okay? And we're going to be talking about share sizing and risk management, and we're going to go a lot deeper into this reward versus risk concept a little bit later in the course. Now, let's talk about the shakeout bar. And guys, I can guarantee you there is nobody else talking about this. Okay, there's nobody else presenting this sort of information to you. And the reason I say that is because I learned this by myself. I learned this through experience, okay? And the shakeout bar is an incredible enhancer to the breakout, okay? This is something that I have just seen through my years of experience and through looking at thousands of different charts and looking at thousands of different breakouts and breakdowns. So the shakeout bar improves the quality of the base, and it makes it a lot more potent of a base breakout or breakdown. This increases the odds of success for your breakout or your breakdown. And it makes the setup battle tested. That might sound confusing. You'll understand it in a second. And what it does really is it makes a bullish base, right? Remember, if we have a bullish base at the highs of a rally, it's going to make that base even more bullish. It's gonna kind of give you confirmation that this is definitely bullish. This is probably going to continue higher. And it gives a bearish base, right? That's basing at the lows of a rally. It's going to make it even more bearish. It's going to show you that there's actual bearish confirmation. And it triggers stop losses. We're going to talk about that in a second. And like I said, it's a trading enhancer. It's a trade enhancer. It makes me immediately more confident that this breakout is going to work, or this breakdown is going to work. So let's look at it. So in plain view, this is the shakeout bar. And a shakeout bar, if you're looking at it, you might recognize it immediately. You might say, hey, listen, that's a bottoming tail. And you would be exactly correct. This is just a bottoming tail. You're absolutely right. However, what does this bottoming tail do for us? And what this bottoming tail does is picture as this breakout is forming, right? Let's say a bunch of people have already entered the breakout, right? Or let's say a lot of people, they're in it long from here, right? They bought it down here. They haven't sold it here. They're waiting to capture bigger profits. And let's say during this base, all of those traders, all of those buyers, they set their stop losses. They're going to set it under the base, right? That's where we're supposed to set it. We're supposed to set it under the lows of the base because that's where we have an area of support. And that's where they're going to be setting their stop losses. Now, when this bottoming tail forms, and right, we know that when a bottoming tail forms, it, drops in price before the buyers show up here and bring it right back up. Okay? So it shows us that the buyers are taking control. And what this bottoming tail does, right, as it's dropping, it's triggering every single stop loss that is at this support level. And by triggering all of those stop losses, right, all of those stop losses, they're sell orders, right? They're sell orders to try to get out of the position, right? As they're triggering all those sell orders, it brings the stock or crypto even lower, right? Because if all of a sudden we trigger a bunch of sell orders, that's even more selling pressure. And as a result, we drop even more. But despite us dropping all the way out and breaking down out of this bullish base, if we end up rallying right back higher, that is confirmation that this stock or crypto is indeed bullish and we will continue higher. This is confirmation, right? This is showing you that the buyers, they're not allowing this stock or crypto to continue lower. No, as soon as it tried to drop, it went right back up. That is, in essence, what a shakeout bar is. And this is when I say battle tested, meaning the sellers showed up. The sellers tried to bring this lower, but there was so much buying pressure that they brought it right back up, and then it continued to base at the highs, right? And this is a very bullish sign, right? We want to see this sort of bar when we are basing, okay? It's the same idea here. After a drop, right, we have an area of resistance over the highs of this base. And a lot of people are placing their cover orders, right? Let's say people shorted it here, right? And they're enjoying their profits, and now it starts to base and they want to capture additional profits. They place their stop loss over the base, as they should. And as soon as buyers start to show up and they trigger that stop loss, a bunch of buying happens, right? Because that's where people are covering their shorts. So they're covering their shorts at this position, and we see a rally higher. However, it ends up just being a topping tail. And remember, guys, a topping tail suggests that the sellers have taken control. So basically, the buyers showed up. The buyers attempted to bring this stock or crypto higher. However, the sellers said, hey, not so fast. And there was so much selling pressure, excuse me, that they brought the stock or crypto right back to the lows, and it continued basing. And then eventually finally break under this support, and we continue lower, okay? And you can also call this kind of a breakout failure. You can call this a breakdown failure. It's a topping tail as well. So this is why it's so important for you guys to understand and be able to identify the different candlesticks that exist, because you'll be able to find information like this, where if you see, oh wow, we have a topping tail during a very bearish base, that's a good sign that that's good confirmation that we're actually going to continue lower. Hopefully that makes sense. Now, let's talk about a breakout, or let's talk about breakout and breakdown failures, okay? And a bullish base that has a breakout failure, which is, in other words, a topping tail, especially on high volume. And we haven't talked about volume yet, but this is when we're going to begin discussing it. Whenever we have a bullish base that has a breakout failure on high volume, that is a sign that a reversal to the downside might occur. And with the opposite, let's say we have a bearish base, right, at the lows of a rally, at the lows of a drop, right? If we have a breakdown failure, which is a bottoming tail, right? We try to go lower, but we fail, especially in high volume. That's indicative that a reversal to the upside may occur. And guys, this is also information you're frankly not going to find anywhere else, because these are strategies that I personally found through my years of experience. All right, so let's kind of walk through this. We're first going to be talking about the breakout failure with the topping tail. So we have a large rally and we begin to base at the highs, right? So far, so good. All of a sudden, we break out, right? The buyers, they bring this stock up or crypto up and we break out of the base. However, this is very short-lived, and then the sellers take control at the top here and they bring the stock or crypto right back down, right? That's what a topping tail is. It suggests that the sellers have taken control. So during this bullish base, rally higher, we're basing bullishly, we're basing, okay, everything's looking good higher. We finally break out, right? But ends up leading to a topping tail like this. This is a breakout failure. And the market speaks loudest in its breakout or breakdown failures. It speaks loudest in its failure patterns, right? So we base, we have a breakout, leads to a topping tail. The breakout has failed, especially if this is occurring on high volume. We're going to be talking about that more in the volume class. But this is usually indicative that this move is done. This move is over. It attempted to break out and failed. What does that tell us? If it attempted to go higher and failed, it tells us, hey, this is probably going to go lower. And this is indicative that a reversal might take place and this will actually drop. Just like here, let's say we have a, excuse me, let's say we have a drop in price. We are basing bearishly, right? We're basing at the lows, which is indicative of weakness. We attempt to break down. However, it leads to a bottoming tail, meaning we attempt to break down, but we just shoot right back up, right? Leading to a bottoming tail. What does a bottoming tail tell us? It tells us that the buyers have taken control, and usually it's indicative of reversal and reversal to the upside. Okay, well, I mean, it's really not too difficult, guys. Think about it. If we drop, we're basing, it's looking lower. We attempt to go lower, right? We attempt to break down and drop lower. However, the buyers show up here. They bring prices right back up, and that usually means. It might mean that we're actually going to end up reversing and continuing higher, right? I mean, it makes sense. We try to go down, we fail, it probably means we're going up. If we try to go up and we fail, probably means we're going down, okay? So, key characteristics about the breakout. Basing at the highs of a rally is bullish. If we make a rally higher and we're basing at the highs, that is bullish. It shows strength. It shows that there is positive buyers, like there's buying pressure. The longer it bases, the more bullish it is. Okay, so we want, if we're basing at the highs, we want a long base. We want a base that's, ideally longer than shorter, because it shows that, hey, this is just taking a little bit more time to correct itself, but there clearly aren't enough sellers to bring it down and make it break down out of the base. So we're probably going to go higher. Basing at the lows of a drop is bearish. And the longer it bases at the lows, the more bearish it is. I mean, it makes sense. Okay. If it's at the lows and it's staying at the lows, it probably means it's lower. If it's staying at the highs for a long time, it probably means it's higher. Basing at resistance is bullish and indicates a break of resistance may occur if the breakout triggers. Okay, so if we are at a previous resistance point and we're basing at that resistance, it probably means we're going higher, right? Because if we're at a resistance level, right, usually you would expect us to drop. But if it's basing at that resistance level, it probably means we're going higher. If we're at a support level, right, and if you've already identified support on maybe the other time frames, if it's basing at support and it continues to base at support, then it probably indicates that a breakdown is probably going to happen and we're most likely going to continue lower. Okay, and let's just want to make sure. Okay, let's just make sure we look at some examples. So we have a rally, we begin to base, we enter above the base, we enter, oh, and now we have another base, right? We're going to enter at this red line, which is over the highs of the base. Then we get that pullback. We saw a diagram of this earlier where this prior resistance is now becoming support, right? And this is a buy setup, where we're going to talk about that in the next class. We rally higher, and this is sort of a little bit of a base, and another buy setup here. Okay, let's look here. We had a rally before this, and another thing to note here, guys. Notice how the 20-day moving average is underpriced and it's trending higher. Okay, and we didn't quite base. What is going on, guys? Glad you're watching this class. And today we're going to be talking about the buy setup and the sell setup. In other words, the pullback or retracement pattern. And I know we talked about the base breakout and the base breakdown during the last class. And I believe the stream cut off while I was actually looking at some examples. So I want to go ahead and finish the examples that we were looking at before we continue on into the buy setup. Okay, so let's go ahead and do that. Okay, play from current slide. So we talked about this example. So looking at this example, number one, the 200-day moving average is underpriced. It's under the 20-day moving average. That's a bullish sign. You usually want to see the 200 generally underpriced, right? You want the average, the 200-day moving average to be below price and the price to be above that average. Okay, we had a prior rally here and we ended up basing, right? Our entry is above the base, our support is, or our stop loss is under the base. And notice that as soon as we begin to break out, or right before we actually begin to break out, the 20-day moving average starts curling under and trending higher under price. Okay, and that's when we start to see the breakout. And we're going to be talking about the buy setup today. Same thing here. 200 is all the way below price and below the 20. We have the 20-day moving average. Notice that as soon as it starts to break out here, it starts to rise under price. It's trending higher, right? You could see that there's clearly bullish momentum with the 20-day moving average. And as soon as we base into that 20-day moving average, that's when we break out, okay? So our entry would be over the highs, stop loss would be under the lows. Okay, hopefully that makes sense. So those are just some examples of it. And later in the course, we're going to be looking at some charts and actually pinpointing different breakouts, different buy setups, and also looking at the other patterns that we're going to be talking about. So let's go into the buy setup. And the buy setup, as you may recall, is one of the other fundamental strategies that I talked about. We talked about how price tends to correct itself in two ways. Either through time, or in other words, base, it consolidating. We already learned about that last class. Now we have to understand that price can also correct itself through a pullback, through a price correction. Okay, so what is it? And this is ultimately correctly buying the dip. We always hear that phrase, buying the dip, right? I think it was coined in 2020 when all stocks went up, all cryptos went up during the COVID pandemic, right, or after it. And a lot of people, frankly, they lose money when they buy the dip. Most people, most amateurs, they lose money when they're buying the dip. But what I'm going to show you today is how to correctly do it, what characteristics you should be looking for when you're actually buying the dip. Because I'm making money buying the dip. I know other traders making money buying the dip. There's no reason you shouldn't be making money when buying the dip. And I'm going to show you exactly how to do that. This is one of the most potent trading strategies for day and swing trading. It works on any time frame for any stock, crypto, forex, any financial instrument that operates in a market. And it's really important to develop the skill set required to identify when to be buying the dip, right? When, or identifying what is a high quality buy setup or pullback pattern. So like we did with the base breakout, let's try to analyze the anatomy of the base breakout. Oh, I'm sorry, of the buy setup. Sorry about that. So number one, we have a rally, right? A lot of the people who bought it down here, they want to start taking profits. So what they do is they start selling, right? They sell at this point and we see a minor pullback. What we want to do, and during this pullback actually, this is price correcting itself, right? That's why it's pulling back. But what we want to do is time our entry for when the pullback and the correction is finished. So we buy here and enjoy the next move higher. Again, we begin the pullback. We want to buy when the correction and the pullback is finished and enjoy the next move higher. Okay. Also, guys, for the buy setup, this is kind of a big, this is a requirement. You need to have an established uptrend in order to trade the buy setup. You need an established uptrend, especially if you're a beginner. Make sure there is a present uptrend before you consider playing the buy setup. And the buy setup, of course, occurs after the pullback has completed right here. So let's go over some key criteria for the buy setup. And ultimately, the buy setup, really, we're buying after a pullback, right? So following a rally higher, right, you want to have 3 or more consecutive red bars in a row. And you want to have 3 or more consecutive lower highs in a row on the pullback, right? So right now, we're trying to analyze the quality of the pullback, right? We want to be looking for specific types of pullbacks when we're analyzing a buy setup, okay? So one of the criteria is, like I said just now, you have to have 3 or more consecutive red bars, right? We have a red bar, red bar, red bar, red bar. We have 4 in this case. Perfect. And you also ideally want to have 3 consecutive lower highs, right? What does that mean? Right, we have, this is a high of this red candlestick, then this is the next high of the next candlestick, this is the next high of the next candlestick, and this is the next high, right? Notice how every high is lower than the previous one. Notice also how every low is lower than the previous low. That's what we want to see. We don't want to see we're down, then we're up, then we're down, then we're up, then we're down. We don't want to see that. We want to see 3 red bars in a row and ideally consecutive lower highs and lower lows, okay? Key criteria number 2, and this one is very important. We want to make sure that the 20-day moving average is trending higher and under price, okay? I can't emphasize this enough, guys. I keep talking about the 20-day moving average because it is extremely important, especially for this setup, okay? We want it to be trending and under price, and you guys are actually going to notice that price tends to retrace and it tends to pull back right into the 20-day moving average, okay? Key criteria number 3, we have to look at the retracement of the pullback. The retracement is the amount that a stock pulls back, right? It's the measure of the amount, or the, I guess you could say the amount of the pullback, or how large the pullback is. That's what the retracement is. And we want to be looking for a 40 to 60% retracement of the prior rally. Meaning, let's say from the lows of this rally to the highs of this rally, that makes up 100%. We want this pullback to be in the 40 to 60% region of this rally, right? So let's see. I would say this is about 60%. I would say this pulled back to around the 60% point, right? So in general, you want it to be in this area right here. That's between, I would say, 40 to 60% of this rally, with 50% being around right here. Okay. And the whole point of this is you don't want a really deep retracement, right? Like, let's say after this rally, you retrace all the way down here. That shows weakness, right? If we're really that bullish, if we're in an uptrend, if there's a lot of buying pressure, why would we retrace all the way back to close to the lows of the rally? That shows a lot of weakness. Furthermore, if we retrace under 40% retracement, meaning we retrace to only right here, well, that shows lack of price correction, because we're still going to have significant distance between price and the 20-day moving average, right? So we want to have that golden spot of 40 to 60% retracement of the prior rally, okay? Hopefully that makes sense. Key criteria number 4, let's talk about the entry, stop loss, and targets. So first step is to identify the entry bar and wait for it to completely form. We're going to be discussing entry bars on the next slide, but for right now, this is our entry bar, okay? So as soon as this entry bar has finished forming, what we're gonna do is place our entry above the entry bar's high, right? Like, that's the whole point of the entry bar. This is where we base our entry off of. You wanna put it over the entry bar's high, and you wanna put the stop loss under the entry bar's low, or under the rising 20-day moving average, okay? So basically, once this bar is finished forming and the buy setup, like you see that there's a buy setup, you're going to want to just place your entry right above the highs of this bar and place your stop loss once you're in the position under the lows of that candle. So you would be entering during this green bar as soon as it hits this entry, and you would enjoy the move higher. Okay, and your target 1 is the previous high, right? So we rally, we make a high, right? This is a pivot high because we start pulling back. And our first target is the previous high, because this previous high is now resistance, right? We go up and we drop. This now becomes resistance, so it acts as the first target, okay? So let's talk about entry bars. The ideal entry bars that you want to see at the end of a pullback look like this. They're either narrow range bars or they're small bottoming tails. We want to see small bars, right? Either small narrow range bars or small bottoming tails. And this is where, really understanding the types of candlesticks that exist, this is where it becomes really important. So if you still don't know what a narrow range bar is or what a bottoming tail is, take a step back and go back to the reading candlesticks section of the course. So after a pullback, we always want to see one of these entry bars because it enhances the buy setup, okay? Excuse me. So let's understand why. When looking at these two pullbacks, which one of these pullbacks is much higher in quality in terms of reward versus risk? Which one is better in terms of reward versus risk? This one or this one? And if you're looking at this one, well, obviously this is the correct answer. The reason this is a better pullback than this one is because, first, the bars are becoming continuously smaller. That's another thing we want to see. If the bars are becoming, right, these are red bars. If they're becoming continuously smaller, well, what does that mean? If the red bars are becoming smaller, that means the selling pressure is diminishing, right? Remember, we're trying to play long. We want the selling pressure to diminish. The other thing is we also have an entry bar. You can see this is a kind of like a doji bar, very, very small bar, okay? We can see that the selling is weakening, and we have a clear entry bar. In this case, the selling is not weakening. We have 3 large bars in a row, and we don't have an entry bar, right? There's no clean entry for us to actually go into the buy setup. So let's understand why we want entry bars. And this, once again, guys, is going to touch up on the reward versus risk aspect of this setup and like I said with the base breakout video, later in the course, when you're looking at my risk management and my share sizing videos, make sure after you watch those, you come back to this section of the buy setup, and it'll give you a lot more perspective. It'll help you understand what I'm talking about here. But I think if you guys went through the base breakout, understanding everything, you guys should be good for this. So entry bars improve your reward to risk. Why? Well, with an entry bar, we have a tighter stop loss. And just like the base breakout video, with a tighter stop loss, we have a higher reward to risk ratio. This is why we want small entry bars, right? So let's understand this. Remember, our entry is always over the entry bar. Our stop loss is always under the entry bar, right? We talked about this here. Once we get this bar by the 20-day moving average, our entry is over it, our stop loss is under it. So in this pullback, we have an entry bar. In this pullback, we don't have an entry bar. So what do? So in this case, in both of these setups, our stop loss is under the lows. Under the lows is 590, is 590. In this setup, we have the entry bar. So remember, our entry is above the entry bar's high. So it's at $6, meaning after this bar has completed forming, we're going to be entering during this green bar. And as soon as it hits the highs of this entry bar, that's when we're going to be entering and enjoying this move higher. In this case, we have a very, we actually have an entry bar. So our entry is at $6. However, in this case, our entry has to be over this candle because we don't have an entry bar. So in this case, we have a larger entry. It's at $6.20 compared to $6. Our targets in both of these scenarios is $6.50. Right? So our stop losses are the same. Our targets are the same. However, because we have an entry bar here, we actually have a clear entry price compared to this one. So in this case, we are risking 10 cents. Right? Because that's the size of our stop, $6 minus 590. We're risking 10 cents, meaning if you enter here and it drops to 590, you're out of the position. It hits your stop loss, it hits your risk, you're out of the position, right? You're risking 10 cents. In this case, if you enter at 620 and it goes all the way to your stop loss at 590, that's 30 cents. So, right, because 620 minus 590 is 30 cents. So we're risking in this scenario 10 cents to make 50 cents because our target is at 650, our entry is at 6. We're risking 10 cents to make 50 cents. In this scenario, we're risking 30 cents to make 30 cents. I don't know why this says 20. It should say 30. So you could see that even though we have the same exact risk, because we actually have an entry bar here, we end up having a tighter stop loss. Because we have a tighter stop loss, we have a higher reward to risk because we're only risking 10 cents to make 50. While in this case, we don't have an entry bar, we don't have a clear entry, we're risking 30 cents to make 30 cents. Why would you risk $100, let's say, to make $100, where in this case, you're risking $100 to make $500, okay? Hopefully that makes sense. Now, let's look at some examples. So right here, we hit the 200-day moving average, which is acting as resistance for the stock. We drop to look at this, the rising 20-day moving average that is under price. You could see that the 20-day moving average is halting prices from continuing lower. It's rising. We get a rally, and boom, we begin to retrace. And we have 3 red bars in a row. We have 1, 2, 3, 4 red bars in a row. It retraces into the rising 20-day moving average, so that's check. It's also retracing into the flat 200, so that's a bonus. We have a 40, I believe, this is probably like a 50% retracement, right? If it rallied here, pulled back to here, that's probably 50% retracement, I'd say. Right, so that's a check. There's consecutive lower highs, there's consecutive red bars, perfect. And we have a bunch of entry bars here, right? We have a bottoming tail, then doji bar, then another bottoming tail, and 2 other very small bars. So we have a bunch of entry bars here. Whenever you get into this situation, just put your stop loss under the absolute lows, right? So this is the absolute lows of all these bars. Put it at the lows. So your stop loss would go here. Your entry would be over this bar. And boom, what a move higher. Okay. Let's look at another example. We have a rising 20-day moving average. Check. We have a nice rally. Okay. We have 3 consecutive red bars in a row. Check. We have 3 consecutive lower highs in a row. Check. Let's see. This is probably a 50% retracement, right, of this rally. Check. Into the rising 20-day moving average. Good. Then we get a doji bar / bottoming tail. Check. Very good entry bar. Stop loss would be under this candlestick. Entry would be over this candlestick. And you would be entering during this green bar as soon as it hits the entry over that doji candle. And boom, nice move higher. Our target is right here. Let's look at another example of this buy setup. We have a rally. It's kind of a deep pullback, but given the overall context of the uptrend, it's not a big deal. We have a rising 20-day moving average. Great. We have a really tight entry bar, really small entry bar. Perfect. And look at that move. Beautiful. We also have, 2 red bars in a row. Unfortunately it's 2, or maybe this might be a red bar as well, but it's not going to be perfect every time. Sometimes there's going to be bits and pieces missing, but it's important to look at the overall context of what's happening. So beautiful buy setup here. Same thing here. We rally. We retrace around, I'd say, like 45%. Rising 20-day moving average. Nice, it's not a perfect candle, but it's a nice smaller candlestick we can base our entry off of. And boom, what a nice rally. Entry would be over, stop loss under. And check this out, guys. I believe this is the NASDAQ ETF, the QQQ. You could see that, these are all buy setups. You could see we have a rising 20-day moving average. We have a flat 200 that's under price. Every time price touches the rising 20-day moving average, we go up. So you guys are starting to see how we are combining different elements that we are learning. We are combining our knowledge. We know that when the 20-day moving average is rising and trending higher, price tends to retrace back to it, right? Price goes up and retraces back to it. Price goes up and retraces back to it. Goes up, retraces back to it. You guys get the idea. And we're combining our knowledge of how to use the 20-day moving average with the buy setup, with, the 40 to 60% retracement, with the lower consecutive red bars, with the consecutive lower highs, with the entry bars, right? We're combining all of this information to produce a very potent setup, okay? We looked at this example earlier. Take a look at this. We rally. We have a rising 20-day moving average right here. Nice doji bar. We rally. We actually end up kind of basing and then retracing back. Another buy setup. Boom, boom, bam. And what we have to understand, guys, not every buy setup is going to be perfect. You're not always going to get exactly what we talked about in this class. However, just look at the overall context of what's going on. This is not a perfect setup. We had a bit more retracement than we wanted to. However, given that it's also retracing to the prior support, it's in a really strong uptrend. We have a really nice rising 20. It looks like a nice setup, okay? So not every buy setup is going to be perfect. You have to look at the overall situation, the overall context. You have to look at multiple time frames, okay? And yeah, make sure you take advantage of the setup, guys. And make sure you really understand everything we talked about today, okay? You can't have missing parts, right? And I'm trying to think of anything else I want to emphasize here. Something I really want to emphasize actually is play with the trend, okay? If we're in an uptrend and several time frames are telling you that this is bullish, we're in an uptrend. On several time frames, we have rising 20-day moving averages that are trending under price, right? Let's say that's happening on several time frames. All the time frames are telling you that it's bullish, that there's buying pressure, right? Then look for buy setups. Don't look for buy setups if we are in a downtrend, if there's a lot of selling pressure, if we have conflict on the time frames where one conflict says bullish, one conflict where one time frame says bullish, one time frame says bearish, right? One time frame is sideways. Don't play a buy setup in those conditions. Play a buy setup when everything looks bullish, when we have a clear uptrend. Okay. Hope that makes sense, guys. Thanks for the class. And we're going to be talking about the sell setup in the next class, which is the exact opposite of the buy setup. What's going on, guys? Hope you're having a great day. We just talked about the buy setup, but now we're going to be talking about the sell setup, which is the exact opposite of the buy setup, except we're going to be shorting instead of going long. So we're not going to spend as much time on the sell setup as we did on the buy setup, since it's exactly the same concept, except, obviously it's the opposite. So let's just get right into it and we'll do a quick little class here. Sell setup, what is it? It's the opposite of a buy setup. We're going to be shorting the retracement rally, right? So we know how if we have an uptrend, if we have a rally, we have a dip. Same thing when we have a downtrend, right? We drop, we also have a little bit of a retracement rally. It's one of the most potent strategies for day and swing trading. Works in any time frame, stocks, crypto, forex. And it's really important to just develop the skills required to recognize one and recognize when you have a quality sell setup. So guys, same idea here. We drop, we need to correct in some way after this large drop. Maybe some people need to cover their shorts. Maybe some people are buying it down here in hopes that it's bottoming. But we have a retracement rally, right? And this is where we want to time our sell setup. This is when we want to get in, so we enjoy the move lower. And then, of course, we could cover here or stick with the play. And we see we have that retracement rally, and we have another sell setup, and we short it here and enjoy the move lower. Okay, we must have a downtrend in order to play the sell setup. Just like we need an uptrend when we're buying the dip, when we're doing a buy setup. We need an established downtrend when we are trading the sell setup. Guys, don't overthink this. It's the exact same thing, except it's the opposite. Key criteria number one, after a huge drop, we need to have 3 or more consecutive green bars in a row with higher highs and higher lows, right? This high is higher than this high, this high is higher than this high, and this high is higher than that high. Okay, 3 consecutive green bars, and ideally consecutive higher highs and consecutive higher lows. Okay, it's the same exact thing. We are basically analyzing the quality of the retracement. Okay, same thing here, guys. The 20-day moving average requirement. Remember, when we're downtrending, when we're shorting, we want the moving average to be trending lower, and we want it to be overpriced, trending lower and overpriced. So we drop from the 20-day moving average, and then we retrace right back to it here. Okay. Same thing, guys, 40 to 60% retracement. If this retrace is too much, then it's clearly too strong, right? We're trying to short. We're looking for weakness. If it rallies all the way up here, then it's clearly not all that weak, because otherwise, if there was really that much selling pressure, the sellers wouldn't allow there to be a retracement to here. Similarly, if we only retrace to right here, there's still extension from the 20-day moving average, and a full correction hasn't been made. So we're looking to the 40 to 60% area. In this case, it's around 50%. Okay, so we drop 40 to 60% retracement. Our entry and stop loss, it's the exact opposite. Once our entry bar has formed, we put our entry under the entry bar. We put our stop loss over the entry bar, since we are shorting. So we would be entering during this red bar when it hits the lows of this entry bar. Okay, and our target is the previous pivot low. Same exact thing, guys, just opposite. Entry bars, as we're aware, it makes it an enhanced setup. Ideally, we have narrow range bars or small topping tails, right? Before, on the buy setup, we wanted bottoming tails, because a bottoming tail shows that the buyers have taken control. With a topping tail, it shows us the sellers have taken control, which is what we want when we're shorting. So we obviously want an entry bar. It improves our reward to risk. Okay, obviously here the green bars are becoming smaller. The buying is weakening compared to this. We have an entry bar here. We don't have an entry bar there. Okay, same thing. And the exact same idea, guys. With an entry bar, we have a tighter stop loss. We have a higher reward to risk. This is why we want entry bars. Stop loss is at $6. Our entry is at $5.90. We're shorting it, remember? Here our entry is at $5.60. Stop loss at $6. Right? Same target, same stop loss. Different entries because we don't have an entry bar here. And in this case, we're risking 10 cents to make 40 cents. Oh, I'm sorry. We're risking 10 cents to make 50 cents. In this case, we're risking 40 cents to only make 20 cents. Okay, obviously the reward to risk is a lot better here because we have that entry bar, we have a tighter stop loss, and our risk to reward is a lot better. Okay? Okay, guys, let's look at some examples, right? The 20-day moving average is starting to curl over price and is declining now, right? Especially it's curling over. And we have a drop. Then we have a base breakdown here, actually. So we have a drop, base breakdown. We break down, right? Then we have that retracement. We have 3 or more consecutive green bars in a row. We have a topping tail, right? In fact, we have a topping tail and a really nice small entry bar. In this case, guys, I know technically we're supposed to put our stop loss over the entry bars high, but in this case, since the topping tail is higher, we're going to put our stop loss there. Okay, we in general want the stop loss to be over the absolute highs of the sell setup, right? Our entry would be under this bar as this bar is forming. So as soon as it hits the lows, we enter. And the target is a previous low. Beautiful, beautiful sell setup. This is around, I'd say, 60% retracement. So beautiful sell setup. Perfect example of this. And notice how it's right into the declining 20-day moving average. It literally stops at the moving average. This is why the 20-day moving average is so important. Same thing here, guys. The 20-day moving average is dropping. It's trending lower. We have a huge drop. 3 or more consecutive green bars in a row. We have a, kind of larger, a larger entry bar than we want. However, it's still good. Our stop loss is right here, entry right here, and we actually surpass our first target. Notice how it went right to the declining 20-day moving average. That's when we had our drop. And we actually did another one here where we rallied. This is not a perfect sell setup, but still. Entry bar, and we continue lower. Okay, hopefully that makes sense. We also have higher highs on each of these green bars. Just really, really nice setup. Same thing here. This one's a little sloppy. We have a prior support here that becomes a resistance for the sell setup. We drop. This one's a bit sloppy, entry bar, but nevertheless, it's a sell setup right into the declining 20-day moving average. It kind of went above the 20-day moving average, but that's not a big deal. It's never going to be perfect every time. Okay, really nice sell setup. And notice this is supposed to say sell setup, but not every sell setup is perfect. You have to look at the overall context of what's happening. And remember, guys, if you're having troubles with this setup, it's exactly like the buy setup. It's just the opposite. You're shorting. You're taking advantage of and making money off the price moving lower. But key idea here is, guys, remember, use the 20-day moving average to your advantage. And once again, you're seeing that we're combining all of these ideas to produce a really potent trading setup that has a high likelihood of success. Okay? By combining different ideas and different elements of what we're learning in this course, we're going to be able to combine everything, right, and find setups that are extremely high quality and have a high likelihood of success and high likelihood of, making money. That's what we're here to do. So hopefully this makes sense, guys. This is basically like buying the dip, except you're shorting the rally, right? So you guys know all the requirements. And something I want to emphasize, just like I did with the buy setup class, is make sure there's an established downtrend. Okay, don't trade the sell setup if you have an uptrend. Don't trade the sell setup if the charts are looking bullish, if the charts are showing buying pressure, look at several time frames, look at the daily, right? Look at the hourly, look at the weekly maybe, look at the smaller time frames such as the 15, 5, or 1 to 2 minute charts and see what's going on. Are we bearish? Do we have clear selling pressure? Do we have a downtrend? Or do we have conflict on the time frames? Do we have some time frames looking higher, some time frames looking lower, some time frames maybe sideways? You don't want to trade that. You want to trade the sell setup when there's clear bearishness on multiple time frames and when you have established downtrends on multiple time frames. Okay, that's something that's really, really important. And same thing with the base breakout and the base breakdown as well. I didn't really cover it before, but you want to trade the base breakout when you have an established uptrend on several different time frames, when several different time frames are showing that it's bullish. Just like you want to trade the base breakdown when several different time frames are showing bearishness, showing that there's selling pressure. If you guys don't get the idea at this point, definitely go back and watch my multiple time frame analysis video. You guys get the idea here. You want multiple time frames to all be in agreement. And once they are, then you could start finding these setups that we're learning. Okay? Awesome, guys. We have now learned 2 different strategies, right? The buy setup and the breakout and the respective sell setup and base breakdown. And boom, now you guys are ready to begin trading them. So maybe try to look for some on your charts, try to practice, maybe come to my live streams and ask me questions about whether you found one or not. But perfect. Make sure you guys really understand the requirements that go into the strategy. Anyway, guys, we're going to be discussing the 1, 2, 3 pattern next. See you there. What is going on, guys? Hope you're having a great day. Today, we're going to be talking about another strategy that we're going to add to our trading arsenal. We already talked about the breakout/breakdown and the buy setup and sell setup, but today we're going to be talking about another type of strategy. And the best way to sum up this strategy, it's a continuation play, okay? So we already discussed and looked at a diagram showing how price corrections occur and how we take advantage of price corrections through either buying, after a base, or through buying a pullback, or shorting a base or shorting a retracement. Okay, but let's talk about what happens if, let's say, you miss the initial breakout or you miss the buy setup, right? So let's say we have a breakout, or let's say we have a rally first, and then we get a base, we get a consolidation, and of course we're looking to play the breakout, right? And similarly, let's say we have a rally, and then we get that price correction and we get a pullback. Okay, so what happens if you miss this initial breakout and you miss this initial buy setup, right? Let's say maybe you weren't at your trading desk, maybe you're coming late to the party and you weren't able to catch the initial breakout, okay? The initial breakout here, or the buy setup here, right? What do you do, right? Maybe, you still want to take advantage of the play, and you may ask yourself, okay, I missed the initial entry. Is there any way I could get into this position through a secondary entry? Okay, right? So maybe you missed this initial breakout, but you get another opportunity here before it inevitably continues higher. Or maybe you get an opportunity right here to get in before it continues higher, right? So the whole point of this setup is to talk about the 1, 2, 3 pattern. That's what it's called, and it's a continuation play. This setup is basically trying to catch the continuation of the move. It's a secondary entry, okay? So let's get right into what it looks like, okay? So the first requirement that you need for the 1, 2, 3 pattern is a bullish 1, 2, 3 pattern, right? Where we're actually going to go long is we need a bullish wide range igniting bar first, right? So remember we talked about what an igniting bar is. Okay, so we need a bullish wide range igniting bar. We don't want to see a large candle up here, right? Or I mean a large wick. We don't want to see a large wick or tail on this bullish igniting bar. And this igniting bar, the reason it's called an igniting bar is that it ignites the move higher, right? This is the first bar that is igniting the next move. So it's going to indicate the direction of the move. In this case, it's higher, right? Shouldn't have a significant topping tail. We talked about that. And the next bar we have here is a resting bar. And this resting bar, it's usually a narrow range bar or sometimes a doji candle, okay? And this resting bar has to form and stay in the top 33% of the igniting bar, meaning it has to be ideally in the top third of this candlestick. You're not always going to see that. Sometimes the resting bar is a little larger. It's not a big deal if that's the case, but ideally, you know, if we're just talking about the textbook version of this pattern, you want to have a resting bar that's in the top 33% of this igniting bar. You could see this one is, you know, in the top third of this bar. It doesn't matter if it's green or red or if it's a doji candle, that doesn't matter. And ideally, you want it to form an equal or near equal high with the igniting bar, meaning you want the high of this resting bar to be near the high of this igniting bar, right? In this case, we're kind of near the high, because what it ends up forming is a double top or an area of resistance, okay? And the reason why we want to have an area of resistance is whenever we get the triggering bar, right? This is the bar where we would actually enter this pattern, right? We want the trigger to happen when it breaks that resistance, right? And as soon as it breaks that resistance, that would be confirmation that we're going to go higher, and that's when we enter. So you're entering above the highs of the igniting bar and the resting bar, whichever one is higher, right? So if it's equal highs between these two bars, great. But let's say in this case, the igniting bar is a little bit higher than the resting bar, right? You're going to place your entry above the highs of either these two candles. So whichever one is higher, that's where you're going to be placing your entry. And you're going to be placing your stop loss under the low of the resting bar, okay? Or under the low of the triggering bar, whichever one is lower, right? So let's say that there's maybe a large tail, maybe there's a tail here in your triggering bar. You're going to be placing it at the lows. So at the lows of either the resting candle or the lows of the triggering bar. So this isn't really hard stuff, guys. You have an igniting candle, right? Then you get a resting bar, a narrow range bar, or perhaps a doji candle. And right, so it's a 1, 2, and then we're on the third bar. That's where we're going to be that's a triggering bar. That's where we're actually going to be entering and placing our stop. Okay, so let's look at the opposite, the bearish setup, where we're going to actually be shorting the 1, 2, 3 pattern. We first have the wide range igniting bearish bar, ignites the move lower. It indicates the direction of the move. We shouldn't have a significant tail here, right? We shouldn't have a significant bottoming tail, right? When it's a bullish wide range bar, you're not supposed to have large tails, right? So you definitely don't want to have a large bottoming tail here, okay? So that's the igniting bar. The next, we have the resting bar that's forming and staying in the bottom 33% of the igniting bar. So it has to kind of form and stay in the bottom third of this igniting bar. It's not always going to do that. In trading, nothing is ever really, exactly perfect. But ideally, the textbook version, you want to have this resting candle be in the bottom 33% of this igniting bar. It doesn't matter if it's green or red. And ideally, you want it to form near equal or equal lows with the igniting bar, right? You want the low of this bar to be near the equal or near the low of the igniting candle, because that's going to create an area of support. And once that support is broken during the triggering bar, that's where we're placing our entry, right? So the entry is going to be under the igniting bar or under the resting bar, whichever one is lower. So find the absolute low of the igniting bar, the absolute low of the resting bar, whichever one happens to be lower, you're going to place your entry under that, okay? And you're going to short immediately when the bar goes below the lows of the igniting resting bar. We just talked about that. Entry, we just talked about that. Stop loss is going to go over the highs of either the resting bar or the triggering bar, whichever one's higher. Usually it's going to be over the highs of the resting candle. So you're going to place your stop loss over the highs of the resting candle, right? So you have a 1, you have a 2, so you have an igniting 1, a resting 2, and then the third candle is going to be our triggering bar. And the 1, 2, 3, by the way, whether it's bullish or bearish, it could really be played on any time frame. It works on any time frame for crypto or stocks. So you shouldn't have a problem, beginning to immediately take advantage of using this setup. So let's talk about what I meant by it's a continuation pattern. Okay. So you guys should immediately recognize what we have here. We have a rally. We have a rising 20-day moving average that is under price. Perfect. We have a rally stemming from the 20, right? It's coming from the 20. Perfect. And we begin to base. We have our shakeout bar. Remember, what does the shakeout bar tell us during a bullish base? It gives us confirmation that the stock or the crypto is indeed higher. Okay. It's an enhancer. We talked about that during one of our classes. So we have a bullish base at the highs, and of course we have our base breakout. So the initial entry for this trade is for the base breakout, right? This is our entry point. It's over the highs of the base. That's our entry. That's the first setup for this stock, right? But let's say you missed it. You weren't able to take advantage of the entry for the base breakout. Maybe you weren't really confident that this stock or crypto was actually bullish, and you wanted to wait for the next setup. Maybe that's what happened, or maybe you just missed it. You didn't see it. But the 1, 2, 3 pattern then gives us an option to get into the stock or crypto after the breakout, right? So then we have the igniting bar. The breakout happened, right? We broke out. And then all of a sudden we get the resting bar, we get the 1, 2, 3 pattern, and now you can enter over, the highs of the igniting bar here, enter over the highs, and you put your stop loss under the resting candle, and boom, now you have a 1, 2, 3 pattern. So this is going to serve as a secondary entry into the stock or crypto in case you missed out the initial breakout, okay? And in general, guys, the igniting bar, right? We talked about the igniting candle. This usually has to stem from either a base or from a buy setup. Okay, that's why it's igniting a new move, right? This can't, we're actually going to talk about it in a second here, but this can't, you really can't have an igniting candle unless it's coming from a consolidation or a buy setup. You need that, right? And here we have a 1, 2, 3 pattern stemming from a buy setup, right? So let's say you have the rising 20-day moving average that is under price. You have the rally. You begin to pull back. You have your buy setup, where your buy setup entry would be over this candle, right? Stop loss under this candle or under the 20. We have our initial igniting bar, right? The buy setup worked. It triggered. Right, our entry was right here. It worked. But let's say you missed this entry, or maybe you were skeptical that it was really going to work and you decided to pass on this setup. Then it gives you a resting bar, let's say, and now you're going to be able to play it as a 1, 2, 3 pattern where your entry is right over these two candlesticks, stop loss is under this candlestick and that candlestick, okay? So you could see that the igniting candle, right, it always has to stem from either a base or a pullback, right? Because the igniting candle ignites a new move higher. And this kind of brings me to this point. Look at this candlestick. Is this considered a 1, 2, 3 pattern? What we have here, right? We have this green bar, and then we have the resting candle, right? And let's say we continue higher. Is this considered a 1, 2, 3 pattern? And pause your video and really think about it. Okay? So I'll give you guys the opportunity to do that. Okay? And it's not, right? The move was already ignited. A 1, 2, 3 must have an igniting bar that starts the move. We just talked about it, right? This move has already been ignited. We're already up 4 green bars in a row before we get this 1, 2, 3. This is not an igniting bar. This is just, this is really just continuing the move higher. But that's not what we want here. We want the first bar to be an igniting candlestick. It has to stem from either a buy setup, meaning it has to stem from a pullback, or from a base. It ignites. It's really important. You wouldn't believe how many questions I get about this. And they'll give me an example like this, and they'll be like, is this a 1, 2, 3? No, it's not a 1, 2, 3, because this candle is not igniting a new move higher. Okay? So let's continue. What's the benefits of this trade? Well, number one, it creates a higher reward to risk setup, right? We talked about reward to risk, but it usually gives us a pretty tight stop loss, which is really, really nice. We know that the tighter the stop, the better reward to risk. And like I said, if you miss the breakout or the buy setup, you could use the 1, 2, 3 as a secondary entry. It gives you another opportunity to take advantage of the trade. And it also, it kind of gives you confirmation. The stock has already proved that it's bullish due to the successful breakout. And you're just trading the continuation of the move, right? This has already proved that it's bullish, right? We broke out. We have the igniting candle. The trade is telling you, hey, we're bullish. We're probably going to continue higher here. And then you get the 1, 2, 3, and boom, you can take advantage of the continuation higher. Okay, let's look at some examples here. We have the 200-day moving average. It's flat and underpriced. Perfect. We actually have a buy setup here, which is, it's not a clean buy setup because of the 20-day moving average, right? It's not underpriced. It's kind of like moving through price. But nevertheless, we have a rally. We have a retracement. Notice how right here, the 20-day moving average starts to point higher. And boom, we get an igniting bar. We get our resting bar. And then we get our triggering bar. And our entry would be over the highs of the igniting bar and the resting bar. So it'd be right here. Our stop loss would go right below the resting bar. And this is a 1, 2, 3, right? 1, 2, 3. Perfect. We could see also the resting bars in the top 33% of this candle. Awesome. Let's look at another play. We have a rising 20-day moving average, right? It's starting to curl higher. We get the wide range bar. We get our resting bar. And then we get the triggering bar completing the 1, 2, 3. So you guys could see this is the definition of igniting bar, right? We're kind of sideways here. It's trendless, right? We're not really doing anything. And we, boom, ignite right out of that sideways trend, and we begin to start a new trend, right? So I guess you can call this a base. It's a really sloppy base. Like, I know I said that you want to have the igniting bar stem from a base or a buy setup, but sometimes you're going to have a sideways trend like this where, price begins to break out of that sideways trend with a large igniting bar. Notice the size of this bar. This bar is bigger than any other bar on this chart, and that's what makes it such a strong igniting candle. Here we have a resting bar. It's not, perfect. Ideally, this would be smaller, but, nothing's ever perfect. Our stop loss would go right here. Our entry is over the highs, and we have the 1, we have the 2, and we have the triggering bar number 3. Perfect. Let's look at another example. This is a really pretty setup. We have our wide range igniting bar. Really, really bullish candlestick right here. We have our resting bar and we have our triggering bar. And this was actually in the beginning of the day. I forget which stock this was, but this igniting candle, ignited the entire move for the entire day. So we could see that off this 1, 2, 3, we continued higher the rest of the day. We have our resting candle, we have our igniting, we have our triggering candle. So let's say you missed the initial breakout down here. You were able to capitalize because it gave you a 1, 2, 3. You were able to put your stop loss under the resting candle and entry over. This is literally, this is a perfect 1, 2, 3 pattern right here. We also have a rising 20-day moving average. We have kind of a flat 200. It's kind of trending, but not a big deal. All right, so let's take a look here. Okay, and this is a really great example of what I said. The 1, 2, 3 is the best continuation pattern, right? We have a base right here. we actually break under that base, right? So we have a base breakdown with this candlestick. But let's say you missed this initial entry short, right? It gave you a 1, 2, 3, 4 actually. So a 1, 2, 3, 4 is the exact same thing as a 1, 2, 3, except you're gonna have 2 resting candles. So we have our igniting candle, and then we have 2 resting candles before we have our triggering candle that triggers under the lows of, you know, basically all of these preceding candles. And boom, you could have taken advantage of this, right? You would have placed your entry right under the lows here, your stop loss. You can either place it up here or you could place it over this candle, whichever one kind of fits your risk management. I would have probably placed it over this candle just because I like the reward to risk. It makes it a better reward to risk setup. And we actually ended up, you know, having a huge, tremendous drop before we formed for a sell setup right here, and we had another drop. So there's a lot of patterns in here. We have a base breakdown short. Then we have a 1, 2, 3, 4, which is, like I said, the same thing as a 1, 2, 3. Then we continue lower. We actually have a climactic buy setup reversal play, which we haven't talked about that yet, but we have that here. And that's where you actually play a reversal. Then we have a sell setup. We have a declining 20-day moving average. We have the sell setup that worked. And wow, I mean, there's a lot of strategies that's in this screenshot. And you could see that this 1, 2, 3, 4 served as a secondary entry just in case you missed this initial breakdown. Okay, hopefully that makes sense. And that's really it, guys. So the 1, 2, 3 is not a difficult setup, guys. It's just a continuation play. And you could just see from these examples that it's not that hard. They're pretty easy to pinpoint. Remember, we have to have an igniting candle, right? We can't have something like this, right? This is not a 1, 2, 3. It needs to ignite a new move higher. That's the whole point. And this works on any time frame. And hopefully you can begin seeing 1, 2, 3s on your charts, and you can begin applying them, right? And start actually trading them. All right, guys, perfect. Let me know if you have any questions on that, and have a great day, guys. What's going on, guys? Hope you're having a great day. Today, we're going to be talking about another trading strategy and another trading setup that you guys need to add to your arsenal. And this one is going to be focused on picking reversals. It's called the exhaustion and the climactic pattern. And what this strategy is all about is, you know, picking reversals with precision. So far, with the base breakout, with the buy setup, with the 1, 2, 3 pattern, we've learned how to play with the trend, right? If we're in a solid uptrend, we've learned how to find setups in that solid uptrend, or how to find setups in that downtrend so we can play short. But today we're going to be talking about how to go against the trend, okay? And before I hop into the presentation, I want to give you guys a little diagram of exactly what I mean showing you guys this. So let's go to my little drawing area, okay? Let's say we have a 20-day moving average that's, let's say, trending higher just like that. Let's make this moving average this orange. And let's say we have price. Let's make this actually yellow. Let's say we have price, you know, respecting the 20-day moving average and continuing this uptrend. Okay, so let me just draw this real quick. Very good. So right now, and we could even make this a little flatter, maybe make it more like 45 degrees. Perfect. Okay, so what we have here is a gradual uptrend. We have an uptrend that it's just grinding higher and it's gradually continuing higher. Okay, so this isn't where we're going to find a reversal. Why? Because price is near the 20-day moving average. We talked about in some of the other classes that extension is when we have distance between price and the 20-day moving average, and we're really going to be diving into this idea of extension during this strategy. But let's say all of a sudden, we talked about how the slope of the 20-day moving average matters, right? And the higher the slope is, the more unsustainable the move is, right? So right here, let's say we have let's just call it a 45-degree angle. And let's say all of a sudden, let's make this same color, yellow. The 20-day moving average starts to, it becomes basically steeper, right? It starts to kind of curl even higher and make it kind of a higher angle. This is 45 degrees. Maybe at this point, this is more like 60 degrees, right? And we see price start getting really extended from the 20-day moving average to the point where there's even, let's say, even higher, right? And you see that there's a ton of distance between price, right? Let me make this a different color. Make this like orange. Let's say there's a lot of difference between price up here and the 20-day moving average down here. You can see this is the price, this is the distance that's representing that. So what do we do up here? Well, we don't want to play long up here, right? Why? Because number one, we're extended from the 20-day moving average. Remember, we talked about we want to take entries that's at or near the trending 20-day moving average. At this point, we're really far from the 20, right? The other thing is we had a huge move higher, and we don't want to buy at the highs. So what do? This is actually the exact point where we're going to be trying to find a short where we have extension in this sort of acceleration. So now that you guys get the general idea of what I'm talking about and how we're finding this reversal setup, let's actually go into the presentation and talk about details and specific things that we're looking for. So this is called the exhaustion play. You could also call it the climactic pattern. And this is honestly the most potent reversal setup. This is the only way to pick reversals, right? I think there's this amazing idea where traders, they just want to pick the tops, they want to pick the bottoms in stocks, right? There's just this like idea behind it where it's just like, oh, you're buying it at the absolute bottom or you're shorting it at the absolute top. And that idea is so appealing. So if you're one of those traders who is really trying to find reversals and that's just what you're inclined to do, that's just like what makes sense to you, then this strategy is going to really help you with that and help you take, your trading to the next level, especially with the strategy. So something to understand, guys, I think truthfully, this is the most difficult trading pattern. If you're a beginner, I would say stay away from this pattern until you're a little bit more experienced. And the reason it's the most difficult is because your odds of success is always greatly increased when you play with the trend. You usually want to be going with the trend, right? If the charts are saying bullish, if there's an uptrend on several time frames, right, and everything is screaming bullish, well, you should play long, right? You should go ahead and look for buying opportunities because everything is telling you that there's a lot of buying pressure. So going short in an environment where there's a lot of buying pressure, that's difficult. And a lot of times you're going to take some trades with the exhaustion or climactic pattern, and it's not always going to work out. They have a lower likelihood of success, right? Especially when you don't know the specific details that you need for the setup. So it's difficult. Just stay away from it as a beginner and start doing it when you're a little bit more experienced, I would say, but it's up to you, obviously. So like I said, you typically don't want to play against the overall trend. However, you should still be equipped with the knowledge of how to do it correctly. And the thing is, guys, since we're trying to catch tops and bottoms, this setup might take more than one try, right? Like if you're finding one of these setups, you might have to enter it more than once because you have a high likelihood of getting stopped out if it continues like in that direction. You know what I mean? And that'll make sense in a little bit here. So let's talk about the setup. So first requirement is we have, in this case, this is a climactic buy setup, right? Or exhaustion buy setup because we're going to be buying in this situation. So number one, you need a declining 20-day moving average right? And ideally, we talked about slope. Ideally, you know, the slope is very steep with the 20-day moving average. So declining, it's overpriced, perfect. Acceleration. So let's talk about acceleration. We kind of mentioned acceleration, and I kind of showed that idea. Oh, where did it go? I guess my drawings got deleted. No problem. So in terms of acceleration, notice here that these red bars are becoming increasingly larger. And for the climactic pattern, for this pattern, you need to have at least 5 or more red bars in a row. Actually, let's start over here before we go on to acceleration. So yeah, you need ideally 5 or more red bars in a row, and you need 5 consecutive lower highs, right? So 1, 2, 3, 4, 5. That's 5 red bars in a row, even 6 actually. And you could see we're making lower highs on each red bar. Those are requirements. And we're going to be looking for clear extension and acceleration. And the whole idea of this setup is we're trying to buy the stock or crypto when supply is about to run out. Like there's a lot of selling at this point right here. We can be confident that supply is starting to run out, and that's when we're going for the long, and that's when we're trying to buy it, because there doesn't need to be a lot of demand to bring this stock or crypto up from here. Because if there's zero supply, if there's zero people selling it down here because they already sold, then any amount of buying pressure will bring this back up. So we talked about acceleration. Notice how these red bars are becoming increasingly larger and larger. Notice that the distance between price and the 20-day moving average is becoming increasingly larger, right? Like here, there's not that much different distance. Here, there's more distance. Here, there's even more distance. And all the way down here, there's a lot of distance. That's what I mean by acceleration. The candlesticks are becoming increasingly larger. So we need to see this acceleration. It cannot just be a steady and gradual decrease. Okay, this is a lot of people get this wrong, where they'll see a very steady and gradual downtrend and they'll try to find a reversal. No, you need to have this acceleration. We also talked about, extension from the 20. These are kind of connected, the acceleration, the extension. As it's accelerating, it's going to become more and more extended. And the larger the distance between price and the 20-day moving average, the more oversold the stock or crypto is. So if there's a lot of distance between price and the 20-day moving average, like in this scenario, you could think of it as this is oversold and there's probably going to be a correction higher. We also talked about volume already, or if we haven't talked about volume yet, it's going to be in the next class. And you could think we also need a large volume spike here. And the volume spike, we talked about amateur and professional volume or igniting volume. So we want to see a ton of amateur volume down here. Okay? And so hopefully those are the 3 requirements there. We have acceleration that causes, right, the acceleration, increasingly larger red bars, that causes the extension from price and the 20-day moving average. We have a huge volume spike indicating a reversal. And once we have one of these entry bars that we talked about that with the buy setup. Once you get one of these entry bars, you place your entry over the entry bar and your stop loss under the lows of the move. So that's what's key. It has to be under the lows of the move. So let's talk about the importance of entry bars. We already talked about this with the buy setup. You guys should already know this. We're looking for narrow range bars, or we're looking for doji bars, or for bottoming tails. Because remember, if we get a bottoming tail right here, it suggests that that the buyers have started taking control. So an entry bar provides us a clear entry and a clear stop loss, right? Entries above the entry bar, stop loss below it. It increases our reward to risk. And we're always going to put our stop loss under the very lows of the drop. So wherever the lows is of the drop, that's where we're putting our stop loss. So if it continues lower, it'll hit our stop loss and we'll exit immediately. Let's look at the opposite. This is a climactic sell setup or an exhaustion sell setup. You could see here we have a rising 20-day moving average. You could see price. Well, number one, we need ideally 5 or more green bars in a row and 5 consecutive higher highs. You could see we have higher highs. Okay, 5 green bars in a row. We're looking for acceleration. Notice how the green bars are becoming increasingly larger and larger, causing extension from the 20-day moving average. You can see the distance here. Okay. Obviously, the larger the distance between price and the 20-day moving average, the more overbought it is. So if you see a lot of distance between, or you see a lot of extension between price and the 20, you could assume that it's a little bit overbought and a correction might take place. And of course, we have a volume spike at the highs indicating a reversal here. Okay, it's the same exact thing, except obviously the opposite. Our entry in this case would be shorting under the entry bar, stop losses over the absolute highs of the move. Okay, so whenever you have a huge rally like this and you get narrow range bars or topping tails or even bottoming tails, doji bars, small bars like this, those are entry bars. They enhance the shorting opportunity. It gives you a clear entry and stop loss. Obviously, better reward to risk, and we're always going to put the stop loss over the highs of the rally. Okay, hopefully this makes sense for you guys. Now let's look at some examples, and let's kind of check off everything we need to know here. So number one, do we have a rising 20-day moving average? Yes. Is the 20-day moving average, is the slope increasing? Well, you can see it's curling. You can see the slope is slowly increasing to the point where here you could see that this is much greater than 45 degrees. This move is probably, based off this moving average, the move is probably not sustainable, right? Now, do we have, acceleration? Okay, well, first we move up, then we kind of base, then we start to grind higher until eventually we start to see some clear acceleration, right? The bars are becoming bigger and bigger and bigger. We kind of had 2 little breaks with these bars, but right after that we get one huge bar, another huge bar. And with this topping tail, this was being bought before. The highs was up here, right? So you could see clear acceleration. The bars are becoming increasingly larger. There's clear acceleration, right? We also have extension. I mean, look, at this point, we're kind of close to the 20. We're close to the 20. We're close to the 20 until boom, huge rally. At some point, we were all the way up here. Look at the distance between price and the 20-day moving average. Clear extension. And we also, at the top right here, right, huge spike in amateur buying volume up here. Huge spike in volume, suggesting a reversal. Where would our entry be in this case? Under this candlestick, that would be entry, and then stop loss up here. Okay? We also get a topping tail, by the way, which shows that the sellers have taken control. Let's look at another example here. We started from the 20, huge rally higher, right? This might have even gotten halted because we have a gap here. Oh yeah, by the way, guys, for this setup, the target is always the 20-day moving average. So this would be this is target. The bars are becoming increasingly larger. This is not a perfect setup. I kind of want to show you guys, not the best setup, just to show you guys that, you don't need a perfect setup like this to play this pattern. Entry is right here. Stop loss is over the highs. We have the extension as well. So nice. This is a really, really beautiful setup here. So let's take a look at it. You could see move starts from the declining 20-day moving average. You could see the 20-day moving average is starting to curl lower and lower and lower and lower, right? And we drop, we kind of base here, we drop again, little retracement. We start to drop, base, and all of a sudden you could see the acceleration right here, really starting where we really accelerated, right? You could see the bars are becoming larger and larger. We don't get the volume spike. So in this case, we didn't get the volume spike. That doesn't mean that this is not a good pattern just because we don't get the volume spike. Everything else, the acceleration, the extension from the 20-day moving average, it was telling us that it was climactic and it was exhausted. And the reason it's called exhausted, right? The reason I say exhausted is because in this case, the sellers have been exhausted. In this case, the buyers have been exhausted up here. There's no more demand up here, causing the sellers to bring it down. Here, there's no more supply, causing the buyers to bring it all the way back up to the 20-day moving average as target. Entries over the highs, stop loss under the lows. Let's look at another example. So guys, if you guys are looking at this, you should immediately be able to identify the setup that this is stemming from. This is a breakout, right? We have a rising 20-day moving average that's curling under price. We base into the moving average. We start to break out. We start to get the acceleration, right? Huge volume spike up here, showing amateur buy volume and then professional igniting volume, right? Because that's when we started to move lower. We have distance between price and the 20-day moving average, right? There's clear acceleration, really nice shorting opportunity. These are incorrect. This should say stop loss. This should say entry, okay? And that's our target. Same thing here, guys. Clear, we have a base breakdown, curling 20-day moving average pointing lower. Really nice breakdown here. Huge drop. Right, we see clear acceleration. There's clear extension from the 20 in price. We get a bottoming tail suggesting the buyers have taken control. The 20-day moving average is our first target. Huge volume spikes up here, showing a reversal. This is a really, really nice setup here. We play it long. Entry here, stop loss here. Let's look at, I think you guys have seen this before in our other classes. Several setups here. We have a breakdown, right? Under this base breakdown with a 1, 2, 3, 4 pattern. 1, 2, 3, 4 setup. We drop, clear acceleration, clear extension, huge volume spike indicating a reversal. First target is a 20-day moving average. And this actually formed a sell setup. Okay, this formed a sell setup and then we ended up going lower. Okay. Same thing here. What happened here is we have a rising 20-day moving average. The acceleration wasn't very clear, but it is sort of climactic because the 20-day moving average started, the slope was pretty huge. Rallied. We got a double top, making a higher low right here. And boom, nice setup here as well. Same thing here. We dropped into the 200-day moving average in this case on large volume. Okay, reversal setup, boom. So guys, let's talk about multiple time frames for the setup. Using multiple time frames is key. And why is it key? Well, if you don't have a clear entry on the time frame you're looking at, you should shift to a lower time frame. And you can even go down to the 1 or 2 minute charts for a potential entry. Okay. So let's kind of talk about this. Let's go to an example. Let's look at this example. You might be saying to yourself, "Hey, I understand this setup, but one thing I don't understand is we talked about entry bars, right? How we want entry bars, but on a lot of these setups, like for example, this is not a great entry bar. This is a huge topping tail, right? If our entry is over here." And our stop loss is over all the way up here, that's a huge stop size. And you might be thinking there's no entry bar here. Like there's a topping tail, but this is not a small bar like this. So in those scenarios, let's say we're looking at the 15-minute chart here, right? This is the 15-minute chart. If you see something like this on the 15-minute chart and you're saying to yourself, I want to play this, but I need a better entry bar. What you would do is you would drop to the 5-minute time frame, or the 1-minute time frame, or the 2-minute time frame, and see if you can spot a potential entry bar. And then, play the setup off the lower time frames, wherever you could find an entry bar. However, always place your stop loss over the absolute highs or absolute lows of the move. Hopefully that makes sense though, right? So let's take a look at this example. You can see we don't have an entry bar. right? Our entries here, stop loss is here. But in this case, go to a smaller time frame and see if you could spot an entry bar off the lower time frame, okay? And if you can't, then you're just gonna, and you really still like the setup despite it not having an entry bar, then you're gonna have to just have a larger stop loss than you want to. You could even just, sometimes when they move really fast and I can't find an entry bar, I'll just short it right here, right? And I'll just place my stop loss above the highs, right? Like you could even do that. And it's technically not a textbook, but let's say you're over here. You could just, and you think this is the reversals coming, just buy it. Calculate your risk, make sure you're not risking too much, buy it wherever, and just place your stop loss underneath the lows. And if it hits the lows and continues lower, well, you're going to be already out of the position. Okay, so you could do that as well. Same thing here. We have a large entry bar. Go to the smaller time frames and try to find a better entry bar, a better entry into the trade. Okay, so hopefully that makes sense. And looking at the climactic and exhaustion pattern, something to note here: if the daily chart and the intraday charts are both climactic, meaning let's say on the daily chart, you also see that there's clear extension, there's clear acceleration, right? And on the lower time frames, right? Like for example, on the 15-minute chart or on the hourly chart, you're also seeing that that there was acceleration, we have extension, right? And if both the daily and the intraday timeframes are both exhausted and climactic, that makes a much more potent setup, right? Because all of the timeframes are climactic, all of them are exhausted, and that setup has a much higher likelihood of working out. Okay, hopefully that makes sense. Hopefully you guys understand what I mean about the multiple time frames. I'm trying to think if there's anything else I want to mention with this setup. So yeah, guys, this is a difficult setup, but it's really not that hard if you think about it. There's not that many, requirements we need. We need acceleration. That's pretty easy. Extension, pretty easy as well. Just distance. And just make sure you're following all of these qualities. Make sure you're looking at several time frames. Don't make the mistake of just finding a gradual uptrend and just shorting that. That's not correct. You need that extension. You need that acceleration. You need, hopefully, ideally, you also need the volume spike as well. This could work on the smaller time frames for scalps as well, for 1 or 2 minute time frames if you're scalping, or 5 minute. So this works for scalping, swing trading, whatever, doesn't matter. I will say one thing, guys, before I forget, and there was this example. So I see this mistake a lot. Let's say you have a climactic move, that we have that acceleration, we have that extension, right? Usually the first sell setups after that move, right, we drop. Remember, a sell setup is when we retrace back to the 20-day moving average, right? And then we short it again. Usually, whenever you have a sell setup, after a huge drop like this, they usually never work. Okay, so let me kind of paint that out on here real quick. Let's say we have a huge drop, climactic drop, and then we retrace. This, shorting this position right here, right, doesn't work. Don't do this. It worked right here, but this is an anomaly. It usually never works, okay? So if we have that climactic drop, right, we have that acceleration, that extension, the volume spike that we talked about. It's a clear climactic pattern. And you buy it, let's say down here, right? Right, remember our first target is the 20-day moving average. So let's change this color, let's make this white. Let's say, it got to the 20-day moving average. I know it's kind of sloppy, but that's the 20, right? And you took profits off this long, you bought it here and you took profits there. Don't short it, right? Because this rarely ends up continuing lower. This usually fails. And let me show you what that looks like going long. let's say you have a climactic long, right? Where a huge increase. We have literally picture this, right? We have that here, okay? And you decide to short it up here, right? You're shorting it up here, and it drops in your favor, right? And remember, the target is what? The 20-day. The target is the 20-day moving average. So let's say that's white. And you go, remember that that's where our target is too, the 20-day moving average. You took profits right there. This is technically a buy setup, right? Because we're retracing to the rising 20-day moving average. This doesn't work. This buy setup after a climactic move does not work, right? You can see it here. We had a climactic move higher. We dropped. We retraced, right? Technically to the 20-day moving average. The first buy setup after a climactic rally usually doesn't work. You could see tried to move up and it failed, okay? Let's see if we could find another. So this is an anomaly, it working here. Let me see if I could find another example. Like here, right? This is technically a sell setup, right? We buy it down here, right? Climactic, retrace to the 20-day moving average. This is a sell setup. You could see the sell setup did not work. We ended up continuing higher. Same thing right here. A lot of people are going to go ahead and buy this and be like, okay, we have a rally. We have a pullback into the rising 20. This is a buy setup. But remember, buy setups after climactic moves like this, where we have that extension, they never work. And this ended up failing. Okay, same thing here. Technically, over right here is a buy setup. These don't work. So in summary, after a climactic rally, where after exhaustion or climactic rally, or a climactic or exhausted drop, and we get that retracement to the 20-day moving average here, or the 20-day moving average here, this sell setup doesn't work, and this buy setup never works. So never take buy or sell setups after exhausted or climactic patterns, okay? That's basically the last point I wanted to make. Now you guys should be able to also play reversal patterns and understand what to look for specifically. Remember, multiple time frames is key, and that's basically all I wanted to talk about, guys. So thanks. See you in the next class. What is going on, guys? Glad that you've made it to this section of the course, and today we're going to be talking about multiple time frame analysis. And I've mentioned this in previous classes, the importance of using several different time frames while you're trading. And that is an extremely important concept. In fact, I will say that it is probably one of the biggest beginner mistakes that I see, is that traders are not using multiple time frames when they're analyzing a specific stock or crypto. They're only using one time frame, and then they're making bad decisions from it because they're not considering the overall context, overall landscape of what's going on with that stock, right? So let me turn off my camera here, and we're going to get into multiple time frame analysis. So key concept here, guys. Like I said, like I just mentioned, not checking multiple time frames when you're trading, one of the largest beginner mistakes you can do. You are literally trading blindly if you're only considering one time frame prior to taking a trade. You really are. And the probabilities of a trade working in your favor significantly increases when there is multiple time frame alignment. When several time frames are all saying the same thing about a stock or a crypto, that's when you could look to take advantage of a potential move either higher or lower. And you don't want to take trades where there's a conflict between the time frames, right? So let's kind of talk about that. So what is multiple time frame alignment? It means it's when, several time frames are aligned. They're all saying the same thing. They're either all saying that it's bullish, or they're all saying that it's bearish, or they're all saying that, oh, there's no momentum, it's actually a sideways trend, okay? So let's go over one example here. The daily chart is bullish, it's uptrending, and the 20-day moving average is trending higher and is underpriced. The hourly chart is also bullish with a rising 20 MA under price, right? The 15-minute and the 5-minute are also both very bullish with rising 20-day moving averages. And the 15-minute chart also has a breakout pattern, which we haven't learned about that yet, but we will learn about that. So it also has a beautiful breakout pattern, right? So let's compare this example to example number 2, where the same thing, the daily chart is bullish, it's uptrending, the 20 MA is rising and trending under price. However, the hourly chart has a declining 20-day moving average that's curling over price, right? And remember, when it's declining and when it's curling over price, that suggests, bearishness. It suggests that prices are going to go lower. The 15-minute chart is sideways and has a flat 20-day moving average. And remember, when it's flat, that means it's trendless. There's lack of momentum. And the 5-minute chart, however, looks bullish with a trending 20-day moving average that's under price. Which trade has a higher probability of succeeding, right? The example 1, where every single time frame, doesn't matter if it's the larger time frames, such as, going at the daily or hourly chart, or the lower time frames, that's the 15-minute or 5-minute chart, all of them are screaming bullish. All of them are giving you the same information, that the stock or crypto looks higher. Or you're going to choose example 2, where you have one time frame showing higher, another time frame showing lower, one time frame showing that there's no momentum at all, and then this time frame saying that it's higher, right? You could see that we don't have multiple time frame alignment in example 2. And we would prefer seeing example 1. So you can quickly see the importance of having multiple time frames all giving you the same information. And here we have a great example of conflict between the time frames, right? We have different time frames telling us different types of information. Okay, so obviously example 1 has the higher probability of succeeding. So let's talk about what time frames you should actually be looking at. And we're going to be talking about crypto day trading first. So something to note, crypto markets are 24-hour markets, meaning they don't close. They operate on a 24-hour schedule. There's always buying and selling in the crypto markets. So step 1, always check the higher time frames, meaning the daily and the weekly charts, to see the overall context on how the crypto is trading. You're looking at the larger term or longer term trend, right? Step 2, you're going to move on to the hourly chart, see what's going on there. And then step 3, you're going to go to the 5 and 15-minute charts. And if you're scalping, which is taking really, really short trades, really quick trades, then you're going to be looking at the 1 or 2-minute charts. So the point is here, guys, we're starting at the larger time frames and we're moving to the smaller time frames, right? We're seeing what are the larger time frames telling me, and then we're going to go to the smaller time frames and see if those time frames are telling you the same thing, and if we could potentially find a strategy or an entry. Okay, so hopefully that makes sense. For stock day trading, it's a little bit different because the stock market in the U.S. equities market is open from 9:30 a.m. to 4 p.m. Eastern, and that's Eastern time, okay? So as a result of that, there are going to be price gaps that occur, and we're going to be talking about price gaps a little bit later, but just know that in the U.S. equities market, it opens and closes at a specific time, okay? So step 1, what you're going to be doing is always look at the daily chart first to see if the stock is gapping and for overall context on how the stock is moving. So once again, we're starting at the larger time frames. Then you're going to move to the hourly chart for further context to see if you can get any information from that, to see if the hourly chart aligns with the daily chart that we did in step 1. And while you're keeping an eye on the larger on the higher time frames, and this is of course Eastern time zone, from 9:30 to 10 a.m. you want to be looking at the 1 to 2 minute charts. From 10 a.m. to 11:30 a.m., you're going to want to be looking at the 2 minute and the 5 minute charts. And from 11:30 a.m. to 4 p.m., you want to be looking at the 5 minute and 15 minute charts. Okay, so just write this down and keep these time frames in mind. But even if you're trading at, let's say, 2 p.m. and you're looking at the 5 and 15 minute charts, you want to always have a look at the daily chart to see if it's gapping and what's going on with the daily chart, right? What overall trend is seen, and how is it trading? For crypto and stock swing trading, number one, you're going to want to look at the daily chart and the weekly chart, okay, and identify potential setups. So go to the daily and the weekly chart, see what's going on, see how it's overall trending, try to find specific setups. And step 2, then look at the hourly to find potential entries. So once you found the strategy or the setup that you're playing on the daily or the weekly chart, then go to the hourly to find some potential entries so you can take advantage. Okay, so main time frames are the hourly, daily, and weekly charts. Okay, so now we're going to practice. Now we're going to analyze some more stocks and crypto for you guys, so you guys can get the hang of it on how to practice multiple time frame alignment. And we're going to be kind of showing you what it looks like when multiple time frames are aligned, and what it looks like when we actually have conflict between the different time frames. Okay, so hopefully this all makes sense, guys. This is a very, very important topic. Okay, so please make sure you're always looking at different time frames. Okay, and just follow the framework that I set. Always start at the larger time frames and then move to the lower time frames. And when you have the larger time frame saying bullish, and then you have the smaller time frame saying bullish, and the 20-day moving average looks good, and the 200-day moving average looks good, and you have an actual playable pattern, which we're going to learn about soon, then you could actually take the trade and make some money off of it. But you could see the multiple time frame alignment part of it is key. It's crucial that all of the time frames are telling you the same information. It increases the likelihood of success for that trade. All right, guys, we're going to do a practice session next. So see you then, and we're going to actually learn how to do this, not just in theory, but in practice as well. So thanks, guys. What's going on, guys? Hope you're having a great day. And today we're going to be talking about another tool that I use on my charts, okay? We already talked about the 20-day moving average. We talked about the 200-day moving average, and we talked about how to read candlesticks. But I also use another very important tool, and that's called volume, okay? And a lot of people kind of overhype the utility of volume. They say that they kind of come to these random conclusions about what's going on with the stock or crypto based on volume. Or they'll say, oh, because we see a volume spike, this, and this is going to happen. And most of what you're going to hear about volume out there is complete nonsense, okay? But I'm going to give you guys the actual way you could use volume to your advantage, and the situations where volume is actually pretty useful, okay? And by the way, guys, before I start the class, I just want to tell you a lot of what I'm teaching doesn't only apply to volume. This is stuff I've learned through experience, okay? So you might catch me throughout this class kind of citing specific instances of different things that have happened to me with volume, and it's very experience based, okay? This isn't stuff that I'm just finding on Google, okay? This is stuff that I've actually gone through taking on thousands of trades and through my years of experience. So how can volume be a powerful tool? And there's really only a couple ways you could use volume. And what is volume in the first place? It shows you how much a stock or a crypto is being bought or sold. It's showing you how many shares are being bought or sold, okay? And volume is one of the primary ways of predicting price reversals, okay? And using volume will greatly increase the accuracy of picking tops and bottoms with precision, okay? There's this really interesting idea of finding tops and finding bottoms, right? Where you're buying at the absolute lows or you're shorting at the absolute highs. A lot of people want to do that. And if you're one of those traders where you just have, affinity towards finding those type of reversal plays, you're going to be using volume and looking at volume a lot. All right. And another thing that, way you could use volume is that it can indicate when a move, usually it's a rally or a drop in price, when it's beginning, ending, or continuing. Okay. And we're going to get into that. So first, I want to kind of classify different, I guess you could say different versions of volume. I guess that's the best way to put it. So the first classification is amateur buy volume, okay? Where let's say we have a multi-move or a multi-bar move towards the upside where we have 1, 2, 3, 4, 5. We have 5 green bars in a row, and we start to get a spike in volume towards the end of the move, right? Towards like after you see the 5 green bars in a row and you get a huge spike in volume. That suggests that that is the end of that move and a reversal might take place, okay? And you can think of this increase and this spike in volume, and you could think of it as the last group of buyers who have finally bought the stock or crypto, and that stock or crypto is running out of demand, right? You could see that the green candlesticks. And the reason we call it amateur volume, and specifically amateur buy volume, is because what do the amateurs want to do? What do the novice traders want to do, right? They hate missing out on moves. When they see a stock or a crypto go up 1, 2, 3, 4 green bars in a row, right? What do? They're like, oh my God, I don't want to miss out on this rally. This stock or crypto is going to continue higher. I don't want to miss out. And what do? They start buying at the highs, right? That's what amateurs and people who really don't do this professionally, that's what they do. They buy at the highs and they sell at the lows, losing money. So you could think of it, these candlesticks, this is amateur volume. These are the amateur traders who are buying it at the highs with the fear that they're going to miss out on this move. But they already missed out on the move, right? The professionals are buying it down here before the move, right? The amateurs are the ones that are buying it at the highs, right? So you could think of this as the last group of buyers. They're finally getting into the stock. And this is really also effective when this rally is right into resistance. If this rally is directly into a resistance level, it's much more potent, right? If you see this amateur buy volume, it suggests that we're probably, going to see a reversal here. And like I said, think of it as novice or beginner traders finally buying their position. They saw the move already go up without them. They're finally buying the position up here when when the professionals are actually selling it up here, right? Someone is selling their shares or their coins, right, their crypto coins to these amateurs, and those are the professionals. The professionals are buying it down here, and they're selling their shares or their coins to the amateurs up here. And you could see that that's when we get the sharp reversal lower, right? So let's continue. We also have amateur sell volume, where let's say we have a multi-red bar move lower, and we start to get that amateur volume. You could this spike in volume at the end of the move suggests that a reversal might take place, and you could think of this as the last group of sellers who have finally sold their stock or their crypto, and the stock is running out of supply, or the crypto is running out of supply. Okay, and it's very effective if this is actually kind of dropping into support, and we also get that amateur buy volume with multi red bars lower. Okay, and think of it as novice or beginner traders. They're finally selling it, right? These beginner traders, these amateurs, they were down on their positions here, right? They were losing money here. But then they see the stock or the crypto continue going lower, and their losses are increasing, they're increasing, they're increasing until eventually they can't stomach, right, that huge loss, and they're like, you know what, I'm going to exit the position. And as soon as they're exiting the position, right, they're selling their shares to the professionals who are buying it down here. Okay, hopefully that makes sense, and that's why we get that sharp reversal higher. Okay, so quick summary, guys. If you have several green bars in a row or several red bars in a row, and you get a huge volume spike towards the end of that huge move higher, probably means that you're going to get a reversal, right? And these are the amateurs who are buying it at the top, right? Because they have the fear of missing out on the move. But remember, we're trying to be professional traders. We're the ones who are either shorting it up here or selling our positions that we bought down here. Okay, same thing with amateur sell volume. Maybe the people who, right, they're taking big losses on their position. It's dropping and dropping and dropping. They can't stomach their losses. They end up selling it down here, and those are the last, group of sellers, and then we get a pop higher. Okay. So another version of volume, it's called igniting, or classification of volume, it's called igniting volume, right? And we talked about an igniting wide range bar, an igniting wide range candlestick. We already talked about that. Okay. So what you guys want to do is couple the wide range igniting candlestick with igniting volume. Okay. So this volume is igniting a brand new move or direction. The professionals, they don't enter a stock at the end of the move. They enter at the beginning. We talked about this. The professionals, they're not buying it up here. They're exiting here. And if anything, they're shorting it up here. They're not selling it down here, right? If anything, they're buying it down here, okay? And so it makes sense, right? The professionals, they're entering at the beginning. And this is also a very potent reversal signal where you're often going to see amateur volume, right, followed by igniting volume, right? So this is amateur volume right here, where the sellers are trying to get out of their position, and the professionals start buying it here, and this ignites the move higher, the reversal higher. There's also something called continuation volume, and this really only applies to a base, right? So we already learned about the base breakout or the base breakdown, okay? So this is something that you want to combine with the base breakout, where let's say you have a rally higher, right? You have pretty high volume during the rally, and then you start to get a base, right? You start to get a base. What you want to see during that base is very low volume. It indicates that there's not that much selling pressure. So when the stock does have a breakout and that igniting volume, it's more likely to succeed, right? So you don't want to see high volume during a base. You want to see very low volume during a base, because that is continuation volume. And then when the stock breaks out over the highs of the base, that's when you want to see igniting volume. And this igniting volume, it sparks a new move higher after you haven't really had any volume or any buying and selling at all during the base. Okay, hopefully that makes sense. So if you have a base, you want to have low volume. When you have that breakout, you want it to have igniting volume. Okay. We already talked about the shakeout bar, but let's kind of talk about it again. Why not? So it happens when a stock attempts to break down from a bullish base on large volume and fails to break down, right? So you can combine volume with the shakeout, where you have a base with low volume. All of a sudden, you get that shakeout bar, right? This bottoming tail. It triggers everyone's stop losses. We get that drop, right? We have large volume during the shakeout, and then it comes right back to the highs to finish here. And then we continue basing, and then we have the real breakout where we have huge igniting volume, okay? Why is it called a shakeout? Most people who are in their long positions, who are expecting the rally to continue higher, they're placing their stop losses under the base, right? When the stock attempts to break down, the stop losses are hit propelling the stock lower, right? All those sell orders, those stop losses that are hit, it causes an influx of selling. The stock or crypto drops. And if the stock is still able to get bought in return all the way back up to the highs, then there's clear confirmation that we're going to continue higher. We already talked about this, guys, but this is kind of a reminder. So it's okay to see large volume during a shakeout before we have the igniting volume during the actual breakout. Let's also talk about potential reversals when we're looking at a base. So this is something I can guarantee you're not going to learn anywhere else. I would highly doubt there's any other course in existence that teaches this very topic, because this is something I personally learned. This is something that over the years I saw this so often that it's almost become just like its own trading strategy almost, right? So if you have a base, right, we have a rally, we have a base, we're setting up for a base breakout, right? You're looking at it, you want to play it as a breakout. And you have a sudden volume spike that does not lead to a breakout. This can be indicative that a stock or the crypto will reverse in price. And this usually applies more to intraday trading, meaning the smaller time frames, right? So we want to see igniting volume during the breakout, right? When we actually make the move higher, we want igniting volume. But let's say we all of a sudden get igniting volume, we get that volume, huge volume spike, and you're seeing, hey, this stock or this crypto, it's not breaking out. What's going on here? When you see something like that, you should be very cautious, because it usually means that we're going to actually end up getting a reversal. Because, right, if this is a volume spike, if this is igniting volume, these are people, buyers, that are trying to get in and buy the stock or crypto and propel it higher, right? And if this is buying pressure, it's a green volume spike, and it doesn't go higher, well, why, right? Like, there has to be some going on. And just be cautious. It usually ends up leading to a reversal. So if you're in a position, right, and all of a sudden you see a huge volume spike and the stock isn't going in your favor, it probably means it's about to go against you. Okay, so keep that in mind. So let's now talk about breakout and breakdown failures. If you have, let's say, a base breakout, right? You have a rally and you're basing, you're trying to go for the breakout. Let's say you get the breakout, right? It hits your entry, you're in the position, it breaks out, okay? And you get that igniting volume. But let's say this igniting volume doesn't lead to a continuation move higher, and in fact, you end up failing and you end up getting a red bar that's going lower, right? With a huge volume spike. It basically confirms that this is a failed breakout. If you get a rally and then a sudden drop, right? Like, let's say you're in it, it goes up and then it drops against you on huge volume, then you should maybe immediately exit that position and maybe even play it short, okay? It's considered a failed breakout, and it suggests that the prices are going to actually continue lower. So just understand that if you're in a position and it breaks out on igniting volume, but then immediately starts to drop and come back in, also on huge volume, it suggests that that's a breakout failure and get out of the position, okay? So a lot of the times you can pinpoint failures by just looking at volume. And let's say all of a sudden, we have a huge volume spike, and then it starts going against you on huge volume. You can maybe exit before it hits your stop loss, right? Because then you're like, oh, this is a breakout failure, let me get out, okay? So let's look at some examples here on how we could use volume, right? You could see that we dropped right into the 200-day moving average. We know that acts as a floor, acts as support for our stock or crypto. We drop. Oh, boom, we got a volume spike right here. This led to a reversal, right? All of a sudden here, check this out. This volume spike correlated with this reversal. We drop, right? We don't really have any volume reversal here, okay? It's not going to happen every time. Then we drop, we rally again on large volume. We start to get a big volume spike, right? We drop, It's not too prevalent here. I think this is the best example because we actually have a multi-bar move lower. Like here, it's green bar, red bar. We have a bunch of doji candles. There's not that much momentum here. But here, we're getting, huge red bars in a row. And you could see that. You could see the clear amateur volume and the clear igniting or professional volume, right? We drop, right? We're getting that big amateur volume. All of the people, they're finally selling their position after they took a huge loss. And then boom, we have an igniting move higher. We have ignite on green volume, and boom, we continue higher. So you can see how this is really, it's really, it comes in handy when you're picking reversals. Let's look at another example. We have a large move lower, right? Aside from this green bar, this is all straight red bars in a row. We drop hard, huge volume spike, we reverse, right? Right here, huge volume spike, we end up dropping. And I think it's really prevalent here, right? We have a huge 1, 2, 3, 4, 5 red bars in a row. We also have a bottoming tail here, which suggests that this was, this was selling off. At some point, we were selling off to down here before the buyers started coming in, right? So we made a huge drop on huge volume, right? So notice that whenever you're seeing huge volume, right? You could see this is much greater than any other volume that we've had here. Drops, huge volume, that's when we get the reversal, right? And you could see this red volume, that's amateur volume, and then you could see the green volume, that's sparking the new move higher. Those are the professionals buying down here. Let's look at another example. I mean, this is perfect. We have a huge move lower, we have a double bottom, we have a bottoming tail. On huge volume, we get the reversal. So we didn't really get amateur buy volume here, or amateur volume. We kind of did maybe with this candle, but we get a lot of igniting volume that ignites the new move higher. Same thing here. We drop, huge spike in volume, and ignites this move higher. Okay. So let's go over the example where we talked about continuation volume and igniting volume. Notice we have a rising 20-day moving average. We have a really tight base, beautiful base that's based right into the 20-day moving average as it's rising. We get that breakout. Notice how during this base, look how low the volume is. It's beautiful. And then boom, we break out on huge volume and we continue higher. Sparks this new move higher. Beautiful. Let's look at another example. Let's not only talk about volume. There's a bunch of stuff to talk about here. Rising 20-day moving average, that's underpriced. Check mark. Right here, we have huge volume igniting this move, right? We end up getting a pullback and we get a buy setup, right? We get a buy setup right here. It's right at the 20-day moving average. Really nice buy setup, right? We have 1, 2, 3 red bars in a row. Kind of a deep retracement, but it's right to the 20-day moving average. Really nice entry bar. We rally to resistance, right? Because the previous highs is resistance. We start to base at resistance. And where do we base into? We base right into the 20-day moving average, the rising 20-day moving average. Beautiful. With continuation volume, really low volume. And then we get that huge spike in volume during the breakout, right? We continue higher and then we get a buy setup right here, right? Pullback pattern, beautiful, right to the 20-day moving average, doji candle, really small entry bar, really nice risk, reward to risk, rally. Everything is beautiful about this chart. Let's look at another example here. This is actually a gap up. So this happens with stocks. We'll talk about that later. But you could see, right, we're kind of down here. We're kind of just sideways down here. We get a gap up and on huge volume. And this is professional volume, right? These are the professionals starting the new move higher. It gaps right to the 200-day moving average and ignited a new move higher. Another example, we get a drop. It ignites a new move lower. You could see huge volume spike. Okay, so something that I really want to emphasize here, guys, is, like I said, volume is really useful for reversals, especially when it's when you get a huge move. Like, for example, you get a huge drop, then a big volume spike usually means we're going up, right? Huge drop, volume spike usually means we're going up. Same thing right here. I mean, this is a perfect example. Huge drop. I mean, 1, 2, 3, 4, 5 red bars in a row. nice amateur volume, and then boom, we get a igniting volume. So notice how sharp increases in volume during major sell-offs or rallies lead to sharp reversals as well. Okay, and if you guys have noticed, especially looking at this chart, right, you're starting to notice how we're putting everything together in this course. We're putting the 20-day moving average, right? We're combining it with the strategies we've learned. We're combining it with volume. We're combining it with the 200-day moving average. We're combining it with reward to risk, okay? So towards the end of the course, I'm going to try to give you guys more practical kind of tests or practical quizzes on this stuff. But yeah, volume, very, very useful, guys. Hope you guys kind of understand the theory behind amateur volume and igniting volume. This is important stuff here, but just understand that it's mostly used for reversals. And if you have a base, you want to see a base on very low volume. Okay, guys? Hopefully that makes sense. Have a good day, guys. This was a great class. See ya. All right, today we are talking about support and resistance lines. And as traders, I'm sure you have heard plenty and seen plenty about support and resistance and how you could potentially use it to your advantage. However, during this class, I'm going to be teaching you exactly how I use support and resistance and some of the theory that you need to understand before actually applying it to your trading, okay? So what is actually support? What does it mean? So support can be defined as a price level or area, or you could think of it as a price zone where historical price action has shown that in that area, there's way more demand than supply. So in other words, in that area, there are way more buyers than there are sellers, okay? And when a stock actually hits support, you can either buy it, or you can either look to, buy it, or you can even look to short it, using support. And we're going to be looking at both of those examples. So the key thing about support is that and resistance, as a matter of fact, is that we have to make sure that price is actually retesting that support level. So looking at this, we have one rally, okay? And as we're dropping down, price actually retests this support and then rallies from there as well, okay? So as soon as we have two tests of support where both tests actually rallied from that support level, then we can actually use and trust that support level, okay? So that's what we need. We need two tests of a support or resistance level before we can actually trust that it's actually serving as resistance or support. And this is an example of buying using support, where a price level or price touches the support level, you can look to purchase it, right? Obviously, this is a super basic understanding of it. If it hits a support, we're going to buy. There's obviously other strategies, other factors that we're going to use as well in order to justify actually buying it at support. But I think the number one mistake people make using support and resistance levels is that they solely base their decisions, their entries, their exits off support and resistance. And I think that's a mistake. I think using support, you have to use support and resistance to your advantage, but that shouldn't be the only indicators or the only factors in trading that you're looking at. And that's what traders do. They tend to just use support and resistance to base their entries off of. You kind of have to use support and resistance with the other knowledge and skills that you possess in trading. And when you combine, the other strategies, with support and resistance, that's when you can make, a lot more higher quality decisions. So don't just use support and resistance. Use it alongside the other strategies you're going to learn in this course, okay? So this is one example where you could buy using support. When it retests the support, you can look to purchase it. An example of actually shorting at support is, let's say we have a huge drop and we start to kind of consolidate at this level. We can kind of think of it, the top of the base as resistance and the bottom of the base as support. And whenever it actually breaks the support level, we could actually look to short it, right? And because breaking support suggests that there are now more sellers than buyers, right? because during this support level, we could see that during, in that area, it keeps getting bought, right? Like once price touches that zone, it gets bought. But right when price decides that, okay, once it actually tears through that support, it suggests that, okay, there are no more buyers left, right? The sellers are really dominating. Like there's way more sellers than buyers now in that zone. So we're going to actually look to short it and make money as it continues to fall, okay? So you can either, you could use support to either buy or short. In this case, we're buying it when it retests the support. In this case, we're shorting it when price, goes through support, okay? And I'm not saying that you should be buying whenever we do have a retest or shorting every time it breaks support. These are just two ways you can actually play support, okay? And you might be thinking, okay, then when do we know when to short? How do we know when to buy? Well, that's when we combine the other strategies that we know in this course, such as some of the skills we took from the breakout or breakdown, or the buy setup or sell setup, and the other knowledge that we've learned in this course, level 2 as well, okay? So let's continue on, and we're going to be talking about resistance, okay? So resistance is a price level or area or zone where historical price action has indicated that there's actually way more supply than demand when price actually reaches that point. So in other words, there are way more sellers at that point than buyers, right? And once again, you could either buy or short using resistance. So for example, you could look to sell your position at resistance. Let's say you bought it down here. You could look to sell your, you bought it at support. You could look to sell it at resistance. Or let's say it hits a resistance level, you could also look to short it, right? And you have to make sure there's two tests, right? Price tested the resistance level twice before we can actually determine that it's a viable resistance level, okay? Hope that makes sense. And this is another way where we can, let's say we have a huge rally and then we begin to have a consolidation. The bottom of the consolidation can be looked at as support. The top of the consolidation can be looked at as resistance, and we're going to purchase it, right? Purchase when price actually breaks the resistance level, okay? Because it suggests that now there's way more buyers than sellers at that resistance point, right? We had a lot of selling pressure when price hit that resistance before, but now that selling pressure has seemed to disappear. It's no longer there. And that's when we actually buy it, because now we have confirmation that there are actually way more buyers than sellers. And you can kind of pair this right away using the breakout method, right? This is a breakout. We're playing above the consolidation. So you can kind of see how support and resistance can help you with your breakouts and breakdowns and how they kind of relate to one another. Okay, now looking at another example when, let's say, we actually have an uptrend, right? So let's say we have a rally and then we have a pullback. That high, the previous rally high right here, is now going to serve as resistance, right? So now this is resistance, okay? And then let's say we, from there we also continue, we have a pullback, right? And then we break the resistance, we continue to rally, okay? And we begin to actually pull back again. What we want to see is we want to see this prior resistance from here, right? This prior resistance now turn into this pullback's support, right? So here, the resistance level, right? This resistance level from this high is now turning into the support for this low, right? So this resistance is becoming this support now. So this is really what we kind of want to see during uptrends, okay? So exactly like I mentioned, this is the resistance level. It turns into this pullback's support. And during these retracements, right, like this pullback is technically called the retracement, we want it to retrace 40 to 60% of the prior rally, right? So we have this rally. We want this retracement to be, we want it to retrace 40 to 60% of this rally, which it has. I mean, this kind of retraced around, I would say probably right around 50%. Okay, and we want to see that retracement be between 40 to 60%. We don't want to see deep retracements. We also don't want to see super shallow retracements. Okay, and we kind of talked about that during the buy setup classes. Okay, And right, and the whole idea of this turning, this resistance now turning into support is that we want price to actually retrace to the prior resistance level, which is now being considered as support, right? We want we want price to retrace to this resistance. And once it does retrace and respects that resistance, it becomes support. Same thing here. We have a rally, right? We have this prior resistance, and we retrace back to that prior resistance, now therefore making it support, and we rally again. So this is something we want to see this during uptrends or downtrends, right? We want to see we want to see retracements that retrace to the prior resistance. Okay, just like, and we're going to examine a downtrend as well, right? Where we have, we have a drop, then we kind of have a retracement here, a rally higher, and this support level, right? This support level right here is now becoming, this retracement's resistance level. So this support here, right, is now becoming resistance for when this stock, after this drop, it's going to become resistance for this retracement or this rally higher, right? So it's the same thing. This support level becomes resistance here, and we want price to retrace to the prior support level, right? This was the prior support level. We want it to retrace to the prior support level here, and now it's turning into resistance. We also, like I said, just like same thing, we want a 40 to 60% retracement, right? This is a drop. We want it to retrace 40 to 60% of this drop, right? Straight to this new resistance level, which was the prior support. Okay, and it's basically the same idea. This is what we want to see during a downtrend. We want to see retracements to the prior support, which is defined by, this low, right? Same thing here. We have a drop, right? And then the retracement, and the retracement, it goes right into the prior support level, which is now resistance. Okay, hope that makes sense. And we are actually going to head into the conclusion here. So support and resistance is a very important tool and resource that you can use to benefit your trading, right? And what we should do is combine support and resistance with other strategies, with the other information that we are learning in this course. And a huge mistake traders make is that they solely trade and rely off support and resistance levels, right? They only use them, which is foolish, right? Support and resistance is incredibly useful when we actually pair it with other strategies. That's the key thing. That's the key here. We're pairing it with other strategies. We're not just using it by itself, okay? We should not be trading anything in a vacuum. We shouldn't be using one piece of information. We should be using a collection of different factors, different strategies that we're learning in this course. And once, using that collection of strategies, we're able to make a lot more higher quality decisions, a lot more higher quality trades. So please use support and resistance to your advantage, but don't solely use it. And you should be combining support and resistance knowledge with other strategies for the best results. And I'm going to include a video next actually looking at stocks in practice, looking at real stocks, drawing support and resistance lines, and kind of trying to analyze what we learned during this presentation in theory. We're going to try to bring it into practical knowledge, okay, and into more practical application of support and resistance. So that's in the next video, okay? And I will see you guys in the next class. Thank you. Alrighty, let's dive into more ways we could actually use support and resistance to our advantage. And we're going to kind of get into the more practical elements of using support and resistance. So I've made a few examples in the slides. And in the next class, I'm actually going to be looking at real stocks and showing you how you could apply some of the support and resistance, teachings, or this education that you've been seeing, how we could actually apply it into real life charts, okay? So key points, and specifically for, determining targets in this case, we're going to be talking about how to use support and resistance to determine targets. Some key points is that, determining targets and determining, where you think a stock is going to rally to or where you think a stock is going to drop to. It's based completely off support and resistance, right? And if you're playing long, right, you're buying a stock, what you're going to want to do is check the next resistance level and use that as a potential target, okay? And if you're playing short, you're going to want to check the next support level and use that as a potential target, right? So our targets are simply based off looking at support and resistance, all right? And what you're going to want to really do is look at several different time frames, right? Because let's say you're trading off the 5-minute chart and you don't see any resistance above. Let's say you're playing long, right? And you don't see any resistance above on the 5-minute chart. Well, what you should be doing is looking at the higher time frames and then seeing if there's resistance, because you might not see resistance on the 5-minute chart. But if you go to, let's say, the hourly or the daily chart, you might end up seeing resistance, and that's going to affect whether you're actually going to take that trade or not, okay? So, like I said, we're going to be looking at higher time frames to check if there is support and resistance above or below. And you're going to want to, look at the higher time frames. So specifically the daily chart and the hourly chart. I wrote daily chart here, but you could also check the hourly, right? So always check the daily chart first, right? Or you could check the hourly first and then the daily. It's really kind of up to you. But you're going to want to check the daily chart and determine if there's enough room for the stock to rally or drop to the next resistance or support level. Ultimately, when let's say we find a trade that we like and we're trying to figure out targets and we're looking, let's say we're playing long and we're trying to figure out the next resistance level. And so we take a look at the daily or hourly chart and we determine what the next resistance level is. We have to then ask ourselves, based on, the size of our stop loss or the size of our risk, is the trade worth it? Is there actually that much room for the stock to go up before hitting resistance, right? Or is resistance literally directly above, right? And if resistance is directly above, well, that's when the stock, assuming it hits resistance, that's when it's going to have a tough time, continuing higher, right? Because if it's hitting resistance, you can think of that as kind of like a ceiling, right, for the stock. So, or if it's hitting support, that's kind of like a floor for the stock. So it's going to need, additional, I guess you can call it effort, or a lot more additional buyers for it to actually rip through resistance, right? So our goal is to make sure there's an ample enough room before the stock actually hits resistance, right? So before there's actually enough, room for it to go up for us to make a profit before it hits our target or resistance. So just to reiterate, if you're playing long and you see that there's a resistance level directly above, you should reconsider taking that trade, right? Or, maybe, rethink the trade a little bit, because if there's resistance right directly above, there's really not that much room for the stock to go up before it hits it, right? And that's gonna, decrease your reward to risk. And if you're playing short and you see that there's a support level directly below, well, you're going to want to reconsider taking the trade. Because if there's support directly below and there's not that much room for the stock to fall until it hits support, your reward to risk might be affected. And this, of course, all depends on the actual, what your actual stop loss is, okay? And I went a lot more into detail with this in the risk management video, so definitely go back to that if you're having some confusion around this. And something else I want to talk about is what I want you guys to do is check for overlapping candles. Overlapping candles, or you can call it maybe a consolidation or a base, that represents resistance or support. So let's look at this example. Let's say we have a stock, it drops, then it begins to consolidate. And after this consolidation, it continues lower, right? And let's say here, we're looking at potentially playing this long. This is just an example, right? I'm not saying it only applies to this situation. This is just an example. We're playing long from the bottom and we wish to determine the next resistance level, right? We're playing long and we're asking ourselves, what's the next resistance? Well, we're going to look at the next area of overlapping candles. And these overlapping candles, they can represent support or resistance because it kind of represents an area of uncertainty, right? Where we have a drop and we kind of have a consolidation. Some people ended up playing long here. Some people played short. And let's say someone who played long, they ended up getting stuck in the position and it ends up going against them. As soon as the stock ends up, reaching back to their entry point, because remember, if they're playing long from here and then it ends up dropping, they're down on the position. Let's say they don't exit and the stock goes right back up. Well, they might end up looking to get out of their positions, break even. And there's a lot of different details, there's a lot of uncertainty that occurs during these consolidations. So that's why we use it as support or resistance. So when looking at something like this, if we're playing long here, we're looking at our next target is the next resistance, which is these overlapping candles. So this is just an example of, how to determine if something is support and resistance. It's check for overlapping candles, okay? So this is definitely one way to look at resistance or support. This is another example here where, I kind of talked about assessing your risk using support and resistance. Well, this is a really good example where we have a consolidation, right? We have a bunch of overlapping candles. Then we get a tremendous drop. Then we get a rally, and all of a sudden now we have a breakout or a base breakout, potential for a base breakout. And our entry is over the base, our stop loss is under it. And where our next target, well, it's going to be the next resistance area, which are these overlapping candles, okay? So this is going to be our first target, right? So what we have to assess when looking at a trade like this is, okay, what's our entry? What's our stop loss, right? Then determine the size of the stop, which we would, subtract the stop loss from the entry point, right? So let's say our entry is $4, our stop loss is $3.90. That's a 10-cent stop. And let's say, right, so our entry is $4, our stop loss is $3.90. Let's say our target is, let's say $4.10, right? This resistance starts at $4.10. Well, our entry is at 4, our stop loss at 3 is at $3.90, and the next target, the next resistance area, our first target is at $4.10. Well, at that point, we're risking 10 cents to make 10 cents, right? So obviously that wouldn't be worth it because, after watching the risk management video, you guys should know that our risk should be 2 to 1, right? So let's say our entry is at $4, our stop loss at $3.90. That's a 10-cent stop. We want to make sure that there's at least 20 cents of room before it hits the first target or the first resistance area. Okay, I hope that makes sense. Like I said, watch the risk management video if you're still kind of confused on that. But now that we know how to determine our targets, right, how to determine what the next resistance area is, we can now manage our risk a little bit better, where we're trying to assess, okay, what are we risking versus what's our potential reward? And our potential reward is, well, however much room there is between our target, right, or resistance area from where our entry is. And, I just want to reiterate here, this is a base breakout, right? We play long over the base and we place our stop loss under the base. So long over the base, stop loss under the base. The target is the next resistance level, which are the overlapping candles above. We must consider whether our target is worth the risk of taking on the trade. We just talked about it, assessing the stop loss, assessing where our targets are. And refer to the risk management video. We want the potential of making 2 to 1 return or 2 to 1 reward on our risk. Okay, so I hope this makes sense. This is just an example of how we could apply resistance and support, where we're looking at the next resistance level for our target, and then we're determining whether the trade is actually worth it dependent on our actual entry and stop loss. Okay, and another topic I wanted to discuss is, if a stock is rallying into all-time highs, there is no resistance to the left, right? It's into all-time highs. The stock has never been at that point before because it's, like I said, it's all-time highs. So there is no resistance to base our targets off of. So we cannot accurately determine our targets. Just like if a stock is dropping into all-time lows, there's no support below and to the left. There is no support because the stock has never been at that price before. So therefore, we cannot accurately determine our targets, right? So if the stock is into all-time highs or all-time lows, we're not going to be able to determine targets that well, just because there is no support or resistance to base that off of, right? And as a general rule, this is really going to help you understand where there is support resistance is. Always look to the immediate left for support and resistance. And that's a key word. Look to the immediate left, right? And this is one of those things that it's all about practice. It's all about actually looking at some charts and looking at support and resistance. But like I said, we're going to be looking at the immediate left for support and resistance. And what I want to do is actually go through a bunch of real life charts and give you guys some examples of all of the theory that we have learned about support and resistance, looking for overlapping candles, looking for targets, trying to assess risk to reward using support and resistance, right? Looking into some all-time highs or lows, and also looking to the immediate left when analyzing support and resistance. So the next class, I'm going to be looking at specific stocks, and I'm just going to analyze, draw some support and resistance lines, and show you some of the theory that we have learned so far. See you in the next class. All right, guys, we're going to go over some real life examples, some real life charts, showing you guys how to apply some of the support and resistance theory and knowledge that you've just obtained, okay? And we're going to be first looking at Facebook. I kind of picked random stocks, so these weren't pre-selected. I kind of just found a list of random stocks that we're going to go over here today. And just one example, looking at this, let's say you're looking at this and you're looking at potentially taking a short, right? Let's say it dropped where we had a big drop here. It's kind of consolidating here. And let's say, I'm not saying this is a great short opportunity, but let's say you intend to play this short. You want to play it short under the consolidation, right? So you short it when it breaks the consolidation, and you want to put your stop loss, let's say, above it, just like that. So this is just an example, just to show you how to apply some of the theory. So let's say that's your end. This is your entry. This is your stop loss. Okay, and our goal is to assess, what's our target? What's the next support level? Because remember, we're shorting it. So, like I said, the general rule is look to the left, right? And in this case, when you see something, we're on the daily chart here. If you're seeing the stock and there's nothing, absolutely nothing to the left, what you're going to want to do is go to the higher time frame. So we're going to go to the weekly chart now. Okay, so now all of a sudden, we actually have a little bit more clarity on where our next support level is. Like on the daily chart, when we looked at it, well, there was nothing to the left, right? We can keep scrolling for a long time, and we might not get anywhere with it. But we go to the weekly chart, we can immediately see what's to the left, right? So we're taking a short position here, right? And Facebook does look lower. We have a declining 20-day moving average, right? We have a huge drop. It does look lower. However, where's the next support? How much lower does it look? Well, looking at it, our next support level is right around here. You want to say this entire area, right? So you want to say this is our next support area, right? I don't want to say it's one line, but this general area, right? So let's kind of draw it maybe here. Okay, so this is our next support level. All right, well, let's see if the trade is actually worth it, right? So this is our next support, and this is our stop loss, this is our entry. So now we're going to do some calculations. We're going to see, okay, what's our stop? We're going to subtract our entry from the stop loss, see what our actual stop is, see what our reward is, and we're going to determine if the trade is actually worth it, right? So that's a really good example of how to figure out whether it's actually worth the risk of taking the trade. So this is our next support level, and if we look to the left again, our next support level is right here, right? So this is our first support level. Our next one, we're going to look to the left, is directly above, below, is right there. So that's a good way of figuring out where support is. We're going to, and when in doubt, when you don't see support or resistance to the left, like in this case, go to the higher time frame, go to the weekly chart. Or if you're on the 5-minute chart, go to the 15-minute chart, or go to the hourly or daily chart in order to analyze what the resistance or support is. Okay, so that's a great example. Another example here, let's see, if we're looking at this uptrend, right? We kind of talked about in the first resistance video how resistance and support is used during uptrends or downtrends where our previous resistance, right, becomes the new support, right? So let's look at an example here. We could I guess we could actually use this as an example right here, right? We have a consolidation right here. We have a rally consolidation. So this is our resistance, right? This level right here, right? Because we had it retested that resistance basically almost 3 times, and the third time it actually went through it. But notice how when we actually had a pullback, it pulled back, maybe not exactly to this resistance, right? But around in that area. So this is a great example of resistance, now becoming support on the pullback. And that's what we want to see. We want to see the pullback, actually pull back to the previous resistance, which was right here. So this is a great example, right? Let's look at another example here where, another example here where our resistance is actually right here, right? Oh, sorry for the text, guys, but our resistance is right there, and our pullback occurred to, we had the rally and it pulled back to the previous resistance, and now that is the new support. So this previous resistance became the new support for the stock. Okay, I hope that makes sense. And this relates to the first video where we talked about, resistance becoming support. So these are two pretty good examples. Well, I think actually this is even better example right here. We have a rally, then a pullback, right? Notice how the pullback, it pulled back to this previous support, this resistance area. So this was resistance, and now it became support here, right? This is now the new resistance, and this new resistance, notice how the stock pulled back to this resistance, now becoming support, right? And if this sounds a little confusing, go back to the first resistance video, and that's where I really talk about it more. It's a more of a theoretical approach, but it's definitely, I give a bit more detail. But the general idea is that the previous resistance level, right, like this previous resistance level becomes the new support when the stock actually pulls back. So it pulls back to the prior resistance, and that now becomes support, okay? So those are two good examples of that. Another example that I want to just show you here is this kind of relates more to the 200-day moving average, but this 200-day moving average right here is acting as support, right? We have the stock pulled back here, retested it, that's 1. Then it retested here and rallied, that's 2. And again, it retested actually here. So now this has been a proven support level. So this is a really good example of how you can use the 200-day moving average as support to your advantage, okay? And I guess we could talk about one more thing. Let's say all of a sudden we're looking at, let's say we're going to reverse back in time and we're here. Right? Let's say this drop right here hasn't occurred yet, and we're here in time. If you're looking at this and thinking, okay, do I want to play it long? Well, either way, you're not going to play it long because we have a declining 20-day moving average. It's a downtrend, but let's say you decide to play it short and you want to short it here. Well, if you're gonna be looking here right here, you're gonna be looking directly to your left, which is these candles and then these candles. Right? So right away, if you're trying to short it from here, we have support here and here and here, right? We have a support level here. We also have support down here. So, if you're looking at this and you're thinking, okay, do I want to play it short? Well, you got to ask yourself, is there a lot of support below? And in this case, there was a lot of support below. You had all these candles, then plus you had these candles, right? And then you had this low. So the answer is, yeah, there was a lot of support. And you would now consider that. You're like, okay, there's tons of support below. Do I really want to short it? Am I that confident that's actually going to go through the support? Okay. Let's look at another stock real quick. We can look at PLTR and kind of look at what's going on. In this case, if we're looking, let's say for example, we actually want to short this, right? Because with the 20-day moving average is above. If the 20-day moving average was to theoretically start to curl over price, we could actually probably look for a short position in theory, right? I'm not saying we should do that, but you can. Now, if I'm looking at this, right, I'm looking directly to my left. We have this entire support, right? Because remember, we look directly to the left. If we're here, we're going to look to the left. We have this entire support, right? Not only that, but we have this low, right? So we have two kind of support levels right in front of us, right? Let's say it actually breaks through the support, right? It ends up going lower. It actually breaks through this entire support level. Our next support is right there. So the question is, does it really have that much room to drop before it hits support? Right? And that's something that you're going to have to figure out. Like, does it have enough room? Like, if you put your stop loss here, entry here, well, it doesn't really make sense from a reward to risk standpoint because the next support level is directly below. So you would probably be a little more hesitant on actually taking this trade because of that, because support is right below. Because, and let's say it hits support. Well, the likelihood that it's just going to rip through the support level and continue lower is kind of low. It might go down to support and then bounce and stuff like that, maybe rally a bit off support. We want to have, let's say our support level is actually down here instead, then we would have ample enough room for the stock to drop before it's actually hitting that support level. Okay, I hope that makes sense. This is a good example right here. We have a drop. Then this is a clear support level. You can see how much it's retesting and bouncing. So this is a support level. And as soon as it broke this support level, well, this is our short position, right? We short it right there as soon as it breaks this support because it's kind of like a consolidation here, right? We'd probably put our stop loss around right here, right? And you could see that it ended up really dropping. But if we're in this area, right, and we're looking at, let's say we're looking to short it here, maybe actually wouldn't have been the best position because we did have this support to consider, right? Because if we're looking at this, right, we have to look directly to the left at the next support level. The next support level is right here. Luckily, it ended up actually completely breaking through it, but still, that's how we're going to be looking at support resistance. Look directly to your left and look at the next support or resistance level, okay? Let's see if there's any other examples that I can make from here. Not really. We can move on to the next stock. We'll probably do one or two more here, right? I think this is okay. This is interesting. Well, we can kind of go through this right here. If we're looking at let's say we're looking at this point right here, and we're looking to play long, right? Well, if we're looking to play long, our next support level is going to be right there. Right, because if we're buying it down here, let's say it's a buy setup, we're buying it here. Our next support level is the previous highs, right? So that's our previous resistance. I'm sorry, I keep saying support. The resistance level. So we're going to look to the previous resistance level, which is right here. That's going to be our target number one, right? After that, we're going to look at the next resistance, which is basically, we're going to look to the left. It's this next high. So this is our next resistance level. And as you can see, the stock actually went up to that resistance level and ended up dropping down. Okay, so I hope this is starting to make sense, and you're beginning to understand how we could apply support and resistance, right? So if we're playing it long from here, we're gonna look to the left. This is our first resistance level. The next one, we're gonna look even more to the left. Okay, this is our next resistance level, and it ended up rallying straight to that resistance and dropping. So that would have been a perfect target. Okay. So in general, guys, I'm not going to go through all of these. You guys get the idea. We're going to be always look to the left. Always look to the left and to specifically the immediate left to check for support and resistance. And you're going to be using it as targets, right? If there's a lot of support below and you're shorting it, maybe reconsider the trade. right? You don't want there to be tons of support below because the likelihood of that trade actually working is a lot lower. Just like if you're playing long, right? You don't want there to be tons of resistance above because it's going to be, the likelihood of the trade actually working out in your favor is a lot lower. Okay, because there's tons of resistance above. Resistance is going to stop the stock. It's going to stand in the way of the stock really continuing higher, right? And that's why I personally like trades that are going into all-time highs, right? So let's say we have a stock that, it pulled back, right? I'll kind of paint it out like this. Okay, boom. Let's say we have a rally, then a pullback, and then another rally, and it's basing at resistance at the all-time highs. That is extremely bullish, right? So I'm going to actually write that. This is going to be kind of another quick little lesson here. A consolidate base at the all-time highs is a very bullish quality, okay? And similarly, a base at the all-time lows is a very bearish quality. Okay, so let's say, like I said, this is here. I'll even write it. I'll even write it here. Boom. Right. So let's say we have a rally, then a pullback, and then we have another rally, and it's basing at the all-time highs. That is very bullish, and we like that. We want to see that. And the reason it's very alluring is that let's say it actually ends up breaking out. Let's say it breaks out. Well, there is no resistance to the left, meaning this has unlimited room to go higher. Excuse me. And that's the great thing. There is no resistance to stop the stock from actually continuing higher, right? Since there's no resistance, the stock could easily continue higher as much as it wants. Okay? Just like it worked the same way if it was the opposite. If it was a base at the all-time low and it started to break down under the base, there's no support below. So it, in theory, has unlimited room to continue lower, right? And that's a great quality because since there's no support below, I mean, on the one hand, we can't really pick targets all that well, but there's no support to, stop it from going lower, which is great if we're shorting it, okay? Hope this all makes sense. I'm going to try to find maybe an example here. We could find an example here. Let me look. Maybe, let's see. Let's look at this one. No. Okay, this is actually a fine example. We could look at Hood, for example. Okay. Let's say we were shorting Hood under this base. Just as an example. I'm not saying I would do this, but let's say that's what you were going to do, right? Well, there's no support at all under this base. There's nothing to the left of it. So this, in theory, there's no support to base our targets off of, but there's no support that's going to stop it from continuing lower. So this can, in theory, go lower all the way to zero if it wanted to. Obviously, it's Robinhood. It's probably not going to do that, but you guys get my point. There's no support stopping the stock from dropping, which is great if we're shorting it. Or just like the opposite, if we're playing long and there's no, and we're into all-time highs and there's no resistance above, well, there's no resistance that's going to stop the stock from continuing higher. So the point is that a base at the all-time highs or the all-time lows is a very bullish and bearish quality, meaning if it's a base at the all-time highs, it's very bullish. If it's a base at the all-time lows, it's very bearish, right? And we want a breakout into the all-time highs because there's no resistance to the left stopping it from going lower. And similarly, we want to short under the all-time lows, especially if there's a consolidation at the all-time lows. We want to short under that consolidation, right? Because there's no support stopping it from continuing lower. All right. And let me know if you guys have any questions about that. And hope this helps. We've kind of took some of the theory we already learned and put it into more practical information. Okay. Let me know if you have any questions. Thank you. What's going on, guys? Hope you're having a terrific day. Today, I want to talk about market relative strength. And this applies for stocks, crypto, and forex as well, but mainly for stocks and crypto. So if you're trading stocks, you should always keep an eye on the market. And what is the market? Well, you can look at two main ETFs. Okay, so I'm going to turn off my camera and we can look at it. So for stocks, right, if you're a stock trader, I would always keep an eye on the QQQ, or keep an eye on the keep an eye on the SPY. And most of the stocks that you're probably trading is either in the QQQ or in the SPY ETF. And maybe if you're trading really low price stocks, you should also keep an eye on the IWM. And IWM has a lot more lower priced securities. So let's kind of write that down here. For stocks, and maybe put this down in your notes here. For stocks, you should be looking at the Qs or the SPY or 3 IWM, maybe. I mean, IWM, honestly, I trade a lot of lower price stocks, and I personally just look at the Qs. Okay, so I just look at the Qs personally. That's what I do. I trade stocks. So that's for stocks. For crypto, right? If you're someone who trades crypto, I would be constantly looking at Bitcoin, right? So if you're trading crypto, you really always want to keep an eye on Bitcoin. So let's go into why are we looking at, Bitcoin or the Qs or the SPY, right? They're going to act as overall markets, right? If we're trading stocks or crypto. Okay, and we should always keep an eye on what the overall market is doing, because that could have there's a lot of implications on that could affect our trading. Let me give you an example. I know a lot of you guys that are in the server, in our community, trade crypto. Let me just give you a quick little example. Let's say you're trading, let's say Gala, right? Just as an example. And you're trading Gala and you find a buy setup, right? We have a rising 20-day moving average. We have a rally. We pulled back to the rising 20-day moving average. We have a pullback setup, right? And we have a rally. Or you're going for a rally, right? You're going for the buy setup, right? Hopefully to capture this move higher. Okay, but let's say before this move even happens, as this buy setup is setting up at this point, you're looking at Bitcoin, and Bitcoin started just randomly tanking, and a huge drop on Bitcoin. Bitcoin is tanking. You could see that there's a lot of selling pressure on Bitcoin. You may want to reconsider this buy setup, because with Bitcoin dropping, this buy setup now might fail, and it might not even work out, just because the overall market, and for crypto, that's Bitcoin, is tanking. Okay, so you could have found an excellent, perfect buy setup on Gala, but because the market and Bitcoin is tanking, that buy setup may not work. And without keeping an eye on Bitcoin and seeing that it's tanking, you might end up playing this long and then losing money. And you're going to be like, oh, wait, hold up, though. Like, why did I lose money? It was a perfect setup. And then you look afterwards and you're like, oh, it's because the entire market tanked. Bitcoin and Ethereum both tanked, right? So you could you could also look at Ethereum as well with Bitcoin. But Bitcoin, I should say Ethereum usually just follows Bitcoin anyway. Bitcoin is the most widely traded crypto, so that's why it serves as the market. So there's really, you should just always keep an eye on how Bitcoin and how, or the Qs if you're trading stocks, how it's trading, what's going on with it, right? And let me give you another example of how to use market relative strength to your advantage. Let's say the market, whether it's Bitcoin or for crypto or the Qs or SPY for stocks, let's say it's tanking, right? The entire day it's moving lower, lower, and lower. But you find a coin or a stock that's actually basing at the highs, right? Where you're seeing that the entire market is dropping, right? Bitcoin's dropping hard, or the Qs or SPY are dropping really hard. Yet this stock or this crypto is basing very bullishly at the highs, and it's not being affected by the market, right? With the market tanking, this is not breaking down. This is actually just continuing to base. You could actually use that to your advantage and say, okay, the market's dropping. Whenever I see the market starting to have a reversal, hold on. Whenever you see that the market is starting to have a reversal, you can keep an eye on this coin or stock and be like, okay, whenever the market has a reversal, there's a solid chance that this is probably going to break out as well, because it was holding so bullishly during the massive drop of the market or Bitcoin. Okay, does that make sense? So if you're in a situation where you're seeing a stock that's, it's not following the market, where it's actually just acting really bullish as the market is, trending lower, that whenever you see that market reverse, you could see that breakout as well. So same thing, if you have a huge market pop, but there is a coin or a stock that's basing bearishly, where it's basing at the lows, whenever the market starts to drop, you could see this also start to break down, right? So if you're playing short, you want to see a low of the day base while the market is rallying really, really hard, right? Because if this was, think about it, the bearishness is so prevalent that it's not reacting to the market. It's saying, oh, the market, you might be continuing higher, you might be, pumping, but there's so much selling pressure here that the market's not even going to move me. And whenever the market starts to drop, it gives it that extra boost, and some probably cause it to start to break down. Okay, so in general, guys, always keep an eye on the market. If you're trading crypto stocks, always have a separate chart where you could refer to the overall market. Look at Bitcoin or the Qs and see what's going on. How is it trading, right? And usually, I'll give you another example. If the market, let's say, is basing bullishly, right, like this, this is what the market is doing, and you find other stocks that are also basing bullishly, you might notice that as soon as the market begins to break out, those other stocks or those other crypto will also begin to break out. Okay, hopefully that makes sense. So always keep an eye on the market. There's really no strategies you could create from just relative strength to the market, but you could use relative strength to your advantage when you're considering some of the strategies we already talked about, such as the buy setup, sell setup, breakdown, 1, 2, 3, exhaustion or climactic pattern. You could use that, really to your advantage and kind of combine it. Where if the market is rallying hard and it's super bullish, right? If the market is really bullish, you want to buy, you want to look for bullish setups in other stocks or other cryptos. If Bitcoin is tanking, right, and it looks like it's going to continue lower, you want to find shorts, right? Because you're playing with the overall trend of the market, right? Hopefully that makes sense. So always just keep an eye on what Bitcoin is doing if you're a crypto trader, and what the SPY or the Qs are doing if you are a stock trader. Always just keep an eye, and just you'll start to notice different patterns of how different stocks and different coins react to the market or to Bitcoin. So just keep that in mind. Always keep a chart of the market on your trading setup. Okay? And yeah, you'll start to notice patterns. So I just wanted to point this out so you guys could consider that as well. And I'm trying to think if there's any other points I want to make about this. That's really basically it. I don't want to say this is a make it or break it indicator, relative strength. Also, I don't use RSI, by the way. A lot of people are going to ask me, hey, do you use RSI for relative strength? I don't. I just look at whatever I'm trading, right? And then I look at the market, right? And make sure you're like, if you're trading off the 5-minute charts, 15-minute charts, or hourly charts, make sure you have, you know, those time frames for the market as well, right? If you're trading off the hourly chart, make sure you're looking at the hourly chart of the market, right? You don't want to be looking at the weekly chart of the market while you're trading the hourly chart of whatever, you know, crypto or stock you're trading. You want to keep the time frames more or less similar. Okay. But yeah, that's really it, guys. I don't use RSI. I just look at the market as I'm trading. I try to notice if anything's going on, and I try to use it to my advantage. And that's really it, guys. So hopefully that's beneficial. There's not too much to take from this. Just keep an eye on the market. Okay. And that's basically it, guys. See you in the next class. Thanks. All right, the recording has started, and I don't have a presentation for this class because this class is going to be strictly application. We are going to be looking at charts, and we're going to be answering questions about them. And specifically, I've been getting a lot of questions asking, you know, how do I pick targets on a trade? So that's going to really be the topic, the main topic, how to evaluate where you should take profit, where you should start, you know, even thinking about taking profit, and just, you know, try to evaluate your targets. Okay. And like I said, I don't have a presentation. We're just going to be looking at charts and, you know, looking at potential trades we could have taken off the charts, and then seeing where should we begin looking at taking profits, or where, you know, where's the appropriate place to start even thinking about it, right? So I guess we could just get this going right away. I have a bunch of different stocks that I picked out that all have had kind of interesting setups as of late, right? So we're just going to be looking through them and, you know, looking at the setups, looking at the targets. We're just trying to apply some of the principles that we've been learning in the other videos onto this, because a lot of people have been, you know, I think in my videos, especially with the, you know, teaching the trading strategies, I've been pretty transparent about where your entries should be and where to put your stop losses. I definitely detailed them in the videos, but in terms of picking profits, or not picking profits, but, you know, evaluating where should I look for potential targets, I haven't really discussed it that much, and I think we should definitely get that going and watch. So let's start with, for example, we could start with MMM. Okay. Now, first of all, I'm going to ask you guys, you know, do you guys see any potential setups with MMM? And if so, what are the setups that we potentially may see? And this is kind of a tough question because I'm going to be honest, this doesn't look that great right now. But what do you guys have in mind in terms of what it's doing? So what I'm going to do is I'm going to leave around 10-20 seconds for you guys to look at this and then give me your thoughts about it. And then we could talk about the setup, the entry, if there even is an entry. You know, and honestly, if you guys don't like this setup, you know, just say this isn't good. Like, that's totally an option too. I didn't only pick good setups. I picked a bunch, like bad setups, good setups. So what are your guys? What are your thoughts? Okay, Valacom saying long. I don't like the setup, not much volume, not a rising 20. Probably not either. You guys are right, honestly. There's not even a point of picking profits or picking targets here because I don't like the setup either. We don't have a rising 20. Even if this was, like, let's say, you know, for argument's sake, we played this as a breakout. Like, in terms of targets, we have resistance all right here. So we don't have that much room to actually rally before we're going to hit resistance. Does that make sense? Make his 20 maybe before going short again. Oh, I mean, yeah. If it got up to here, maybe. I mean, I doubt it even gets up to here. That'd be crazy. That'd be a pretty crazy move. Yeah, I'm with you guys. I agree. But so there's not even anything to look here. So let's go on to the next one. Okay, interesting. NXD, NXGN. What do we see here? Do we see any setups that occurred here or anywhere? And if so, what setups have you guys seen? And in terms of, if you guys are confused what I mean by setups, is it a buy setup? Is it a breakout? Is it a reversal play? Is it a 1, 2, 3? I want you guys to kind of tell me that, right? And if you guys don't know what those setups are, then definitely start watching the educational videos. So what do you guys see here? Let's see. Will this be recorded? Yes, it will be recorded. We got 25 people. Nice. Yeah, what do you guys think? I'm really curious about this because I think there's a bunch of answers that you guys can give here. There's a bunch of different answers. So I'm really curious what people are going to say here. Can you show the chart? Yeah, here's the chart. Sorry. Okay, let's see what people got. Rising 20 May 1 2 3 strong. Okay, way bullish but waiting for consolidation before entry. Okay, it could be the 1 2 3 but and the reverse. Okay, interesting. Yeah. I mean, I'm with you guys. Rising 20. We can say this is even a buy setup right here. This is a buy setup. We have a rally, then a pullback. It's not a perfect one, but it's a buy setup. We could also say this is a 1 2 3. We have one green bar up, resting bar, like that. I'd say this is the primary. I don't think I would have played it just because we have a topping tail here, which suggests that the sellers kind of took control here and pushed it back down. I'm not saying it's a great 1 2 3, but this is definitely a 1 2 3. Let's get the circle right here. Definitely a 1 2 3. And yeah, so what about targets? Now, let's say you took this 1 2 3. Let's say you bought it here. What targets are you going to be looking at, right? And there's several answers here. I mean, what targets would you guys look for first? And if you need more information, that's also a potential answer. But I want you guys to give me your reasoning. I think this is a target because why? I think we need more information here because why? I want you guys to tell me that. So think about it. And, if you guys are watching, if you guys didn't actually watch this, for anybody who's watching the recording of this right now, I want you guys to think about it yourself. Maybe even pause the video if you guys are watching the recording to see what you think, because this is really going to be. I want you guys to think about this one. This is the best way to learn is by doing it and then me correcting it. Okay. So what do y'all think? Okay. I set up. Okay, sure. Scale out and percent of also for area previous resistance. Okay. Place orders right below this area. Okay. Well, it looks like it's going to break through. Looking bigger time frame. Okay, I like these answers. Basically, from what I understand, you guys are saying there's not resistance here. Like, look, if I go to the left, right, there's no resistance anywhere. So there's nothing I can even base my targets off of. And, that leads me to basically the essence of the class is that when we're looking for targets, we are going to be looking at the next support and the next resistance levels, depending if we're playing short or long. So if we're playing long and we're buying it, we're going to be looking at the next resistance levels as potential targets. If we're shorting it, right, we're going to be looking at the next support levels for potential targets. So you guys are saying, okay, I'm looking to the left, there's no resistance, right? And that may be true, but we have to consider we're on the daily chart. So what I'm going to do is I'm going to say, okay, well, let me look at the weekly. Okay, boom. Now we're looking at the larger picture of the stock, right? And look at the daily. We looked at the daily, there's no resistance, right? But looking at the weekly, the larger picture, we see, yeah, we have a lot of resistance here. We literally have a double top right here. So in terms of picking profits, I think the appropriate place is, maybe look to take profits here. Or I'm not saying definitely look to take profits there, but this is a reference point. This should be an idea of a target, right? And that's a good amount of room, right? Or maybe this is not where you should take profits, but this is where you should consider alternative forms of trade management, right? And if you guys don't know what I mean, watch this video, the trade management video, where you guys can look to either take small, maybe take half profit, or maybe trail the position. And if you guys don't know what trailing the position is, then definitely watch this video. Does that make sense though? Do we have any questions about that? Okay, set a trailing, maybe, yeah. You can leave some free. That is totally true. Yeah, in terms of actual like the free runners and the way you're managing it. Wait, Maxco, are you here? Maxco, it's all right here in the premium education. All of the classes are here, right here. So these are all where all the recorded sessions are. But yeah, in terms of like, so we're just talking about picking profits. Or I'm sorry, not picking profits, picking targets. Once we have reached target, that's when trading management comes in. That's where you're saying, do I exit the entire position? Do I exit half? Do I maybe raise my stop? Or do I, that's where that comes in. But the first part is picking targets, okay? So that's I think this was a great example. Let's go on to the next one. So this is the weekly chart, interesting. Okay, first let's look at the daily. All right, so in terms of potential plays here, I'll tell you guys. First of all, we could say this is a buy setup, right? I guess this is probably the play, the buy setup. But, let's say for argument's sake, we're going to play this as a breakout. And we are going to, right, play it over this base. This is the entry. We put our stop loss down here. It's not it's not a tight base. It's not an ideal breakout, but let's say that's what we do. So I'm looking to the left on the daily chart, and what do we see? Well, okay, we see here's an area of resistance, but we already broke it. We're above it, so we're in the clear. That's fine, right? So what do? We, of course, then, let's go to the weekly chart. Okay, interesting. Now on the weekly chart, it's a little bit more clear. So we had a really large resistance level right here. We broke that already. So when's the next one? I mean, presumably the next one would be in this area, about right here. So that's our next resistance on the weekly. So if we're looking, that's where we're going to probably put targets on a potential swing trade at $56. And a really important idea to understand here is, guys, resistance and support is not a level, right? It's not one level. It's an area of levels. Like, it's an area of price. I put this line here, but this line doesn't represent this. This is not the absolute resistance level. I could have put this line here. This whole thing is resistance. That's something really important to understand. It's not one price. It is a range of prices. So that's something to consider. So many times people are like, oh, this is hitting resistance. Or this is hitting support. I'm going to buy it. It's like, yeah, but a support is an area of price. Like, where are you going to buy it? Are you going to buy it at the top of the support, at the bottom of the support? Like, how do you evaluate that? Make sense? We good with that? We good with this stock? And guys, like, it's a really super easy concept too. Like, that's the thing. Like, a lot of these trading concepts you're going to notice that you're learning, it's like, yeah, like, this all makes sense. It's intuitive almost. Like, this is kind of common sense. And it's supposed to be like that. Like, this is not hard stuff. The harder you're making it for yourself, like, stop. That's why I literally use the 20 MA, the 20 MA, the 200 MA, and candlesticks. I make it as easy as possible for myself, so I don't need to be confused. Make trading simple, right? And the simpler it is, the more successful you'll be, because you don't need to focus on 10 different indicators telling you different things. Okay? Just focus on the raw price action. Anyway, let's move on. AUY. Okay, we're looking at the weekly chart. So what do we think here? What are we thinking? This is the weekly chart. What are our thoughts? Let's go back to this. What are our thoughts about this? Give me your thoughts, okay? So I'll leave it up for a few seconds. And we're gonna do this. I have to kind of hurry this up a little bit. We're taking, I think, too much time per stock, but because I have a lot of stocks here. But the idea is, I want you guys, even the ones that are watching the recording, to think about it. Even pause the video. Think about what you think. What are your opinions? All right. Do we have any answers? I think a short position probably interesting. Okay, we have a short position. Okay, interesting. I think don't chase a green candle. It's already up. Nice play of 200 MA, but extended away from fire right now. Okay, interesting. Came to micro resistance. We'll see if it breaks out. Okay, yeah. I'm starting to really like your reasoning here. Nice play, extended away. So he's saying he's arguing that it's extended from the 20 MA. It's tough to get a long position right now. He's right. That's a really good way of thinking of it, right? I think don't chase a green candle. It's already up. That's true. I agree. Short position. I don't know about a short position. I'm not sure. I mean, it's up a bunch of green bars in a row. There's not really a candle we can play off short, right? And let's say we want to play this. Let's go to the lower time. Let's look at the daily chart. Looking at the daily chart, does this look like a short? I mean, guys, if anything, what does this look like on the daily chart? Like, what we have to understand here is that the weekly is saying extended, sure, right? It does definitely have some room to get up. I mean, there's an area of resistance, but it is a little bit extended. Does it look lower? It certainly doesn't look lower. If anything, would I think it would it's probably going to go higher than lower? Definitely. But if we go in a smaller time frame, we could see that there's a potential trade here just because you can see the 20-day moving average on the daily is right up hugging price, right? It doesn't look extended, right? So in theory, this is a play here. You could do this, right? Put your entry above the highs, stop loss below the lows. Does that make sense? Yeah, and Wally brought up a good point. It's extended on the weekly. It is extended on the weekly. You're definitely right. But it could still probably go higher. And that's when we look at the daily. If the daily looks like crap, and then it's also extended on the weekly, then it's I'm not going to play it. But that's okay because the daily looks good. The daily looks really good to continue higher. So, and what are our potential targets? Well, let's go back to the weekly. Potential targets, to be honest, it's tough to say. In theory, this could be a target. Again, it's an area of resistance. It's hard to pick targets here. What I would do in this case, since it's a little more difficult, let's say we have the breakout. We have a breakout. What we could do is just manage the position. Let's say we're up a few green bars in a row. That's when we can look to raise our stop loss, right, and trail the position. Does that make sense? Are we good on that? Yeah, and it's not perfect, guys. There's not always going to be a time where you have perfect targets, perfect entries. Trading is oftentimes imperfect. But the key is taking advantage of imperfection to make it into a good play. Obviously, there's no picture perfect setups all the time. Sometimes you're gonna have to take setups that are they're not perfect, but they look good enough to play. This looks good enough to play. This looks like I might even call this trade come Monday. Let's look at TAP. TAP, what do we got here? To be honest, do we see a play here? Do we see a play? And if so, what's the play? Does it look good? What do you guys think? Does this look like something that we want to be interested in? Could be a potential short. So what makes you say that? Why do you think it's a potential short? Yes, long, but last candle bulls took over. True. Trust in sport, red was growing in size. That's true, but let me ask you this, syntax geek. Let me ask you this, and I know. I think this could be beneficial for you. Yeah, I mean, I suppose. Okay, we do have a red bar, but my question is, what is the general trend here? Is the general trend here bullish or bearish? And when I say general, I mean, yeah, basically, yeah. Is the general trend here bullish or bearish? Okay. Bullish. So let me ask you this. Why are we going to, it's not, look, there's no extension from the 20. It's bullish, clearly. Why are we going to play something short that's bullish? You know, I mean, it makes sense. Why would we? You know, it's bullish, so why would we short it? We would, if anything, play with the trend. So that's a really important, that's what I want you guys to do. If you guys are beginner traders, always trade with the trend. Do not play reversals if you're a beginner trader. Guys, I'm going to be honest, I barely play reversals because they're really, really hard. Don't look for the crazy, because I don't see where it's bullish. Okay, well, the question is, do we have an uptrend? I mean, starting from basically here, we basically have an uptrend here. I mean, it's not perfect, but we have lower lows and we have higher highs and lower lows. I'm sorry. We have higher highs and higher lows. This is a low. This is a higher low. This is a higher low. Same thing. So we have higher highs and higher lows. So it's uptrending. Does that make sense? Yeah, exactly. It's textbook bullish. Now, it's not an ideal pattern in terms of playing long. Like if I'm seeing this, my only how do I say, intention is to play this long. But I don't see a great entry, you know? I mean, yeah, maybe we could play the breakout, but then we're going to put our stop loss all the way down here, and it just doesn't make sense. Like, I don't even need to look at targets. Right? Like, let's say our stop loss is down here, entry here. So our entry's at 55, our stop loss is at 51. So that's a $4 stop, right? Let's say it's 52 for simplicity. So it's a $3 stop because 55 minus 52 is $3. Now let's look at potential targets. Potential targets are up here, let's say, right? The next resistance. So that's at 59, right? So let's say we did take this trade, and let's say it did in fact go to 59. Is that worth it? We're risking $3 to make $4. Is that worth it? Right? Because we're entering at 55. We're putting a stop loss at 52. Our targets are around 59. Let's say 60. Is it worth it? From a reward to risk standpoint. It's probably not worth it. What we're risking $3 to make what? To make 5? I mean, that's almost 2-to-1, almost. But like that's the best case scenario. Best case scenario, it hits $60. More likely, it's going to hit like 58, 59 before it pulls back. So that's not a trade we're going to look to take. And that's the way our thinking has to be. Like that's the way we have to think about about taking trades from a reward to risk standpoint. Okay, is the reward enough for me to bear on this risk? And that's the problem. A lot of traders, what they do is they, their losses will be the same as their wins, or even their losses might even be larger than their wins, and that's absurd, right? Let's look at the next one. Okay, PFE on the weekly chart. Okay, it's kind of pulling back. Interesting. We have a good rally. Now let's see what's going on. Okay, what do we think about this? I want to see if you guys like this. I already know exactly what I think. What do you guys think? Bullish. Okay, interesting. Now, there's a reason that I wouldn't play this long. Can anybody tell me that reason? And I want you to look in this area. Actually, no, sorry. Not in that area. In this area. Oops. I want you to look in this area. Why wouldn't I play this long? I'm like really, I want to, this is kind of a tough question. I really want to see if someone gets it. Why wouldn't I play this long? Really think about it. Look at what's happening. Look at the last moves. Okay, wait, what do you mean by descending? You're warm. Regina's warm too. Okay, hyper X gamer. I mean, you guys basically got it. Really good. It went up, but came only to a lower high twice. Absolutely correct. Why wouldn't I play this long? It went up, and look, here's a pullback. This is a buy setup. Right here. This is actually a nice looking buy setup. The buy setup triggered, right? But with a buy, if this was really bullish, then the buy setup would have produced a higher high. Instead, it produced a lower high. So now, in theory, it's actually downtrending. It's starting a downtrend. That's why I wouldn't. So that's not bullish at all. If this was actually bullish, this buy setup would have produced a higher high. It didn't. Does that make sense? So there's no point. I mean, let's say, for argument's sake, that we played this buy setup. We bought it here. Where would our targets be? I mean, number one, first of all, we have a bunch of resistance here. First of all, targets. First, on a typical buy setup, our targets are the recent high. So off a buy setup, here are my first targets. In terms of second targets, I'm looking at this whole entire area right here. Right, that should be a reasonable target. It's not perfect, but around here. Does that make sense? Yeah, exactly, Syntaxy. That's what I thought. I knew you meant that. Very good observations. That's really good. Like, a lot of you guys got that. A lot of you guys got that. So that was really, really good. I'm really happy about that. You guys are clearly learning. With that said, my stop loss would be hit. Well, why? In theory, it shouldn't be hit. I mean, okay, let's really go into it. If you played it right here, we have a doji bar. That's a really nice bar for a buy setup. You would have put your stop loss under the lows. It would have never got hit. I mean, unless it would have got hit here. But in theory, you should have. I mean, yeah, obviously it wouldn't have worked. It would have got hit here. Right, so it wasn't the best trade, but it definitely went up a little bit. If you were gonna play along, you'd want to keep a tight stop loss. Yeah, I mean, well, it would be a very tight stop loss because it'd be right under the lows. We have a pullback. The stop loss would be placed under the lows of the pullback, right here. And our entry would be, where would our entry be on this buy setup? Tell me that. Tell me that. Where would our entry be on this buy setup? Over what? Sorry guys, I'm still a little bit under the weather. But where would our entry be? Yeah, Ernest, there is definitely, yeah, this is actually recorded, so above red candle open. Interesting. Above red candle open, you're talking about this candle? I disagree. It would be over, the entry for this would be over this doji bar. And if you're a little confused by that, go back and watch the buy setup video. It would be over that. This is an entry bar, right? We have a pullback. Let's say this is a pullback. Then we get a doji bar. Or, I mean, this basically describes it. We have a pullback, then we get a doji bar. We play it long over the doji bar, not over the red candle. That's the open on the red candle, though. Yeah, it actually... Oh, okay. Yeah, that is true. That is true, but I don't want you to think that it's because of the red... Like, it coincidentally is there. coincidentally. But like, if this doji bar was lower, it wouldn't be at the open of the red candle. It'd be over the doji bar. You know what I mean? Coincidentally, in this case, it is above the doji is exactly. Yeah, I don't even know what fib retracement is. I like don't do that at all. Over 55.25. 55.25. No. That's. Oh, I see. Yeah, I mean, then again, that'd be targets. I mean, if you're buying it here, that's 55.25 is your target. Let's look at the next one. Okay, interesting. What do we got here? All right, so what setup is this? And I'm not talking about here. Like, where does this move is already triggered? From what rally? Or like not what rally? What setup did this move trigger from? Riddle me that one. Okay. Breakout from base, buy, setup, return. Okay, yeah. All right. Yeah, I mean, yeah, you could say this is a buy setup. You could say it's a base. I mean, I personally, your guys are all right. I would personally play it as a base breakout like that. Put our stop loss right here. So where are our targets? What do we do? I don't see any targets here. I go to the left. There's no reference point. What do I do? What do I do when I don't see a Yeah, exactly. Go to the weekly. And if the weekly isn't giving me much, we go to the monthly. Look, okay, this is the weekly. Is the weekly giving us anything? Nope. So we go to the monthly. Oh, interesting. So we are at all-time highs. Okay, guys, what do we do when it's all-time highs? So what does that mean? We don't have any resistance. So what do we do here? What do we do when we don't have resistance at all? Okay. That's tricky. Dave is right. That is tricky. There's no right answer. There's a bunch of different right answers. Definitely not Fibo. I don't use Fibo extensions at all. I'm excited. Oh, whoops. Use a stop loss creator. Okay. Tight stop loss. Let's scale out. Gonna start. Okay. Look for. Yeah, I mean, you guys are all right. I agree. I mean, in this case, we're gonna have to manage it probably bar by bar. I mean, in this case, you know, what am I doing? I mean, it depends how tightly I want to manage this. If I don't want to manage this that tightly, I'm probably just going to put my stop loss right here. If I want to manage it super tightly, I'm probably going to go to the hourly. And I might even trail it hourly bar by bar. If I'm trying to take profits, I might trail it hourly bar by bar. And oh, guys, look at this setup. What is this setup right here? What is this setup? This is like a really beautiful setup, actually. This is really nice. What setup is this? That is, I mean, look at that. That's a really nice setup. Why is this a nice setup? Why do I like this a lot? Yeah, I mean, that is true. Yeah, it's a good rally, drop. We have a bottoming tail, nice risk to reward. It's really, really nice. I mean, let's see. I mean, we would enter above this bar, put our stop loss under that bar, and it's a nice move. So in terms of targets, like let's say our targets would be the previous highs, which are right here, but it's surpassed that. So maybe we could look to trail it. Maybe put our stop loss at the right at the previous at the trailing bar by bar, hourly bar by bar. Or if you want to give it a lot of room, again, like I said, go to the daily and put it under the daily bar, like that, and you could put your stop loss there. So what does this do, putting your stop loss here? It gives the stock enough room to come in a little bit if it wants to, but then continue higher. Because let's say you put your stop loss like right here. This might come in, shake you out of the position, hit your stop loss, get you out of the position, right? Like it might do this. It might come in, get you out of the position, and then immediately continue higher. And then you're like, damn, like I got out way too early. So you want to give it some room. In this case, if you put your stop loss here, you can, let's say this comes in a little bit the next couple days, right? It's not going to hit your stop loss, and then it continues higher. Boom, you've maximized your potential profit while you also are securing some money. You're limiting your risk too. I mean, you're securing some money. Because right, like let's say it does drop and hits your stop loss, well, you're already in the money. You're in the money already because you entered here. So you would still be making money, You would still be making a profit. Does that make sense? Yeah, we could do Apple. Yeah, I mean, this kind of looks like a buy setup. The only thing is it's only down 2 red bars, but looks like a buy setup to me. I might even buy Apple long term. I might just do it. Stop loss there, put our entry here. Targets, well, our targets would be the all-time highs, which is right here. But if this is a long-term position, obviously you're hoping that's going to break the all-time highs. Any questions so far? Can you look at Solana daily and weekly? Sure. Yeah, daily's up a lot. Up a lot, hitting resistance. Maybe might hit the 200-day moving average. Weekly. Yeah, okay, so this is a really great example of what not to play long. Look at this. We're up 3 huge green, 3 increasing green bars into the weekly, right into the declining 20 MA. This 20 MA is declining, and we are straight into it. That probably means that it might, be done moving higher. I'd probably say if it does go higher, it probably hits the 200 and then drops. Maybe even if it hits the 200 and then gives us a doji bar, we might even be able to short it. Does that make sense? Okay, very good. WMT. Okay, interesting. Okay, WMT. Guys, this is a really nice buy setup. Really nice buy setup. Really like this setup. And then this can answer your question, Syntax Geek. We have a pullback, but then we get 2 doji bars. You could play it over the doji bars and put your stop loss below like that. Boom. What are potential targets? Potential targets. Well, I do kind of see potential targets on the daily right here. Boom. This is our first target, which is literally about to hit that target. Actually, yeah, this is the target. These are targets right here. And it's about to actually hit the target. So this was a really, really, really nice setup that worked. Weekly, yeah, I mean, and then the next one's obviously here. Basically, it's like a triple top. It's about to challenge it too. Make sense? Yeah, I mean, the thing is, I wouldn't be watching it to break out because let's say it does break out, right? Let's say you buy it over the highs, over the breakout. So you're going to buy it up here, right? You're going to buy it right. Let's say another green bar. It breaks out. So you're telling me you're going to buy it after it's up 1, 2, 3, 4, 5, 6 green bars on the daily with this large of an extension from the 20-day moving average. Definitely don't do that. If anything, wait for it to break out, then wait for a pullback, and then you could play the pullback higher. Make sense? Did I answer your question, Syntax Geek, by the way? Web 200 Amazon. Yeah, Amazon, really large rally into resistance, kind of pulling back now. The thing about Amazon and Apple and Tesla is that they really depend on the market. They really depend on the cues. So these are market stocks. So you're going to have to be watching the market with Amazon as well. So if the market drops on come Monday, Amazon's probably also going to drop. Make sense? I'm a waste of time to large caps when you're trying to VIX. Watch VIX for large caps. Oh wow, that's down a lot. Down a lot. All right, guys, I'm probably gonna end this in around like 9 minutes. So maybe get a few more questions here. Maybe we can look at a few more stocks here. CNC, don't really see anything. Resistance right here, so I wouldn't even consider it. DocU, what I like about DocU is that maybe for a potential breakout over the highs right now, but the issue is that we have a lot of resistance above, so it makes it kind of hard for me to do it. What is going on, guys? Hope you're having a great day. Today we are going to start with the risk management section of the course, and this is going to be a very exciting lesson, and let's just hop right into it. Okay, so risk management, this is truly a key to your trading success. There isn't a single successful trader out there that doesn't know how to manage his or her risk. Okay, I don't care if you're able to find the best trading setups, you're able to find the best breakouts, the best buy setups, right? You're able to read charts perfectly. The fact is, if you can't manage your risk, you're never going to succeed, okay? So make sure you really pay attention to this. So why does it matter? Like I just mentioned, it doesn't matter even how much money you make, right? It doesn't matter how many winning trades you have. If you can't manage your risk and limit your losses, you're never going to succeed, okay? And let me kind of give you guys a story of my personal trading journey. I remember when I first started trading, my father, of course, he's a professional trader, so he was the one that was mentoring me in the beginning. And he told me, your first goal in trading shouldn't be to make money. Right? And that sounds kind of crazy. Like we're that's why we're doing this. We're here to make money. But he said, no, your first goal should be to break even consistently. Because by breaking even consistently, what does that mean? That means you're not losing money consistently, right? And once you're able to limit your losses and be able to not lose money every single day, you're already 80% there to actually making money, okay? So the goal here, your first priority as a trader is, how can I manage my risk? How can I limit my losses? The wins and the profits will come, but make sure at first you really take care of your risk. That's what you want to focus on. The last thing that you want to do as a beginner trader is start trading in the markets, and because of your inability to manage your risk, you end up blowing up your entire account before you even gain any sort of experience, right? So your win rate does not have to be very high to make money. A lot of people talk about, oh, I have such a high win rate. Oh, I win 80% of my trades. That's great. You could have a high win rate and lose money, believe it or not. And you really don't need a high win rate to make money. Okay, and we're going to talk about that later. Your first thought when you enter a trade, and this is what your thought process has to be. Your first thought should not be, how much money can I make off this trade? How much can I profit? How lucrative can this be? No, that's not the mindset that you want to have. The mindset you want to have is, how much can I lose if this trade does not work out, right? If this trade hits my stop loss, how much am I going to lose, right? And if you enter every trade with that mindset, with how much am I actually going to lose if it doesn't work out, you're going to immediately start limiting your losses. And a lot of risk management, it's not really something you can physically do. It's not about physically finding setups or looking at the quality of certain trading setups. No, it's more about discipline. It's more about the mindset that you have. And you're going to notice that the road to profitability, right? You don't need to make more money to become more profitable. That's one way to become more profitable, is to make more money. But you can also be more profitable by limiting your losses. So just like you should be focusing on, making money on your trades, you should devote equal, mind space towards, figuring out, how do I limit my losses on all of these trades, okay? So number one, the first step that you have to do, is determine your risk. Sit down on your bed or wherever you want and think about, what is the maximum amount of money I am willing to lose per trade, okay? And what I mean by maximum amount of money you're willing to lose per trade, specifically, how much money can you lose without being psychologically or emotionally affected, right? Like, for example, for me, I usually risk anywhere between $100 and $300 per trade, maybe a little more sometimes, right? If I lose $100, I'm not worrying about the next trade, right? That doesn't hurt me psychologically. I accepted that I'm okay with losing $100, and when, let's say, that loss occurs, when I do lose the 100, it doesn't affect me, right? It doesn't affect my psychology or my disposition. It doesn't make me make emotional decisions. But let's say, for example, if I lost $1,000, well, that's going to make me feel uncomfortable, right? That's going to make me feel a little emotional because I'm not really prepared emotionally and psychologically to lose that much money, right? And that sort of loss is going to affect my trading. It's going to affect my psychology. And maybe, you guys have taken a few trades, and if you've noticed, after some of your losses, you begin to, think, you're not thinking rationally anymore. Now you're starting to think emotionally. You're starting to think, oh, I have to make back that money that I lost. I can't believe I lost that much. Oh, and you start, making bad decisions. That's not what you want to do. You want to risk the exact amount that you're comfortable with risking, where if you lose that amount, it's no big deal, right? If you lose, like for me, if I lose $100, it's fine. I'm not worried about it. Big deal. It's okay. But if you're a beginner, right, and you don't know what risk you should go with, start with $10 or $20. I don't even care if you have thousands of dollars to trade with. You might have a $25,000 account, and I'll still recommend you to start with $10 to $20 risk, or maybe even less. Start with $5, right? Because in the beginning, right, your goal isn't to make money. It's to develop consistency and perfect your trading plan, and the money will come afterwards. Okay, so stop worrying about the money. I could tell you right now, if you're just starting to trade and you're taking this seriously, if your goal is to make money right away on the first couple trading days, it's not going to happen. Focus on the consistency in perfecting your plan, right? And practice. Don't worry about the money. And in general, if you're a beginner, you guys should be paper trading anyway. But this class is more about, once you're done paper trading and you're going into trading real money, okay? Because with real money comes real emotions, comes real human psychology, right? And your risk should be the absolute highest amount you're willing to lose per trade. If your risk is $100 per trade, the maximum amount you could lose is $100, okay? So let's say you've determined your risk. Let's say for our sake, it's $20, okay? That's our risk. Actually, no, let's not do $20. Let's do $100. Our risk is $100 because that's what we're using in this example. Your strategy should be this. On every single trade that you take, right? If you're risking $100, you have to make sure, or you have to pick trades that give you the opportunity to make at least $200 or more, right? So if our risk unit, our R is $100, your return to risk has to be 2 to 1. 2 R's to 1 R, right? 2 R's is $200. 1 R is $100, right? So step one, figure out your entry price, right? Whether it's a base breakout, a buy setup, a breakdown, a climactic pattern or exhaustion play, or a sell setup, or a 1, 2, 3. You guys should know how to find your entries for each one of those setups by now. Find your entry price. Number 2, find your stop loss price, right? You guys should be able to know how to do that as well by now. And step 3, figure out your target price. And we're going to have classes in the course talking about figuring out your target price. And it usually comes down to checking your next resistance or support levels, okay? And step 4, ask yourself, based on my entry and the size of my stop loss and the next target, right, your target price, is there 2 to 1 return on risk, right? Do I have the potential to make at least twice the amount that I am risking, okay? And if yes, then go ahead and take the trade. And if it's a no, then pass on the trade, right? If this only if you find a trade and you're seeing that it only really has the potential to make you $100, well, why would you risk $100 to make $100? That doesn't make sense. We want to risk $100 to make $200 or $300 or $400. And over time, if you keep taking setups that give you at least 2 to 1 risk to reward, you're going to notice that you don't need a high win rate to make money. So let's say we take 10 trades and only 4 of these trades are winning trades, right? If you're following this risk management strategy where you're making at least 2 to 1 return on risk, right? If you're winning trades make 2x what you're risking, you're going to make money, okay? So we have our first 6 trades, let's say, they're all losing trades, right? And we know that our risk is $100. So we lose the maximum amount that we can per trade, which is $100. So we lose 100, 100, 100, 100, 100, 100, right? We're down 600. But then we have 4 winning trades that make us at least 2 to 1 return on risk. So we make 200 on 4. What's our profit? Well, it's going to be 800 minus 600. We have a profit of $200, right? So even with a 40% win rate, as long as you're following this strategy, you're going to make money, okay? And imagine some of these winners, right? Like we talked about 2 to 1 return on risk. What if some of your winners are actually, huge winners, right? Let's say you make 3 to 1. Let's say this is a $300 trade. This is a $300 trade, right? Then that's when you see your profits go up, up, and up. But the point here, guys, is as long as you're making 2x on your winning trades and then on your losing trades, right, then you're going to make money even if you don't have a high win rate, even if you're not winning 60% of your trades, okay? Hopefully that makes sense. So keys to understanding risk management. It's important to understand how to share size. Your share size depends on the size of your stop loss. You guys should already have some experience looking at and understanding share size through our strategy videos, right? But to remind you guys, share size equals your risk, right? Your dollar amount risk divided by the size of your stop loss, okay? So let's give an example. Let's say your risk is $100, Your entry price is $6. Your stop loss price is at $5.90. Let's say this is a breakout, right? That's a 10-cent stop. Your stop size equals 6 minus $5.90. That means the size of your stop is 10 cents. Let's say your target price is $6.40, right? How many shares should you buy to ensure you don't lose more than $100? How many shares should you buy? Well, if you're risking 10 cents, right, you don't want to lose more than 100. Well, that's 100 divided by 10 cents. You're going to be buying 1,000 shares. That's how many shares you can buy. At the end of the day, if you oversize your position and you buy or you short more shares than you want to, if that position becomes a loser, you're going to end up losing way more than you want to. That's why share sizing is so important to risk management. So make sure before every trade you take, calculate the correct amount of shares. Okay, make sure you calculate the correct amount of shares so you don't end up losing more than you want to. One simple mistake, and you buying more shares than you wanting to, you're going to end up losing way more money than you want to, and then that's going to affect your trading psychology. We also have the percentage approach where, let's say you have $1,000 portfolio and you decide to risk 5% of your account per trade, right? So 5% of your account per trade. That's just an example. Usually, maybe it should even be 2 to 3%, but let's say you decide to risk 5% just to make it easier for us. How many shares should you get per position? Well, $1,000 portfolio, you're risking 5% of it. Let's find the dollar amount. 1,000 times 5%, 0.05 equals $50. So $50 is the amount that you're willing to risk, right? That's 5% of $1,000, right? Then your share sizing is going to be your risk, $50 divided by the size of our stop. Let's say for this example, the size of our stop is 5 cents. $50 divided by 5 cents, you're going to end up getting 1,000 shares. And if you're curious, how do we know the size of our stop? Well, that's why, when you're picking your trading setups, whether it's a buy setup or a sell setup or a breakout, you're going to know the exact entry, the exact stop loss. And then stop size equals entry price minus stop loss price. Okay, golden rule. Here's a golden rule. When you are in doubt, lower your risk. If you're in doubt, lower your risk. If you're not feeling comfortable, lower your risk. Okay. It never hurts to lower your risk. If something is going on, if you're not feeling yourself, if you're kind of compromised psychologically, just lower your risk. Okay, that's a golden rule. Okay, if things aren't going well, lower your risk. You guys get the idea. Whenever there's anything that's going bad in trading, the last thing you want to do is have a huge loss. So lower your risk. That's what I personally do. Sometimes when I have a few losing trades in a row, what do? I lower my risk. Keys to success here. As you guys know, the tighter the stop loss, the better reward to risk. So that's why you want to find trades that have tight patterns, that have tight stop losses. At the end of the day, guys, risk management is all about discipline. Everything that I taught you today, this isn't anything that difficult. It's nothing that you have to, aside from maybe that formula. But none of this stuff is difficult. This is all just discipline, making sure that you're disciplined with your stops, you're disciplined with your risk, and just always keep in mind that, you don't want to take on bad losers. Okay, so be disciplined when it comes to your risk. Make sure you're never oversizing your positions. And by limiting your losses through risk management, you will become more profitable. We talked about that. And guys, just understand, now that you guys are traders, you're also risk managers. You are managing the risk of your personal account. Okay? And we talked about the psychological aspect of it. But if you're not comfortable with losing X amount per trade, what's the golden rule? Lower your risk. If you're feeling sad or uncomfortable after taking a trade, golden rule, lower your risk. Losses can emotionally and psychologically affect you. Don't let your need to make money affect the amount you risk. I understand you want to make money. We all want to make money. We all want to profit. But don't let that need to win and that need to be profitable end up being your downfall. because that might happen, okay? And you're going to become profitable and more. You're going to make more and more money over time, okay? Understand this might take time, okay? But that shouldn't discourage you. Anything in life that's, makes money or that's worth anything, it usually takes time to acquire those skills or to acquire that accomplishment. So understand that this is all going to take time. It's not a problem. You will become profitable over time as long as you manage your risk and you don't blow your account on some stupid trade because you completely oversized your position, okay? And understand that as a trader, your psychology and your confidence is everything. Taking bad losses for no reasons will affect you. I can tell you that personally. It will affect your confidence. And without your confidence, without that psychological composure, you're not going to be able to take advantage of really good trades. Okay, so please, guys, manage your risk. Be disciplined with it. Don't, try to go for huge winners. Always think about how much money can I lose if this doesn't work out. Okay, and that's really it for risk management. I might include another little motivational risk management clip, but that should make sense, guys. Let me know if you have any questions. Thanks a lot. Hey guys, how's it going? Thanks for tuning into this video. The whole topic of this video is going to be share sizing. How many shares should you be purchasing per trade? And before I go into it, this concept is very important. It is a critical part of managing your risk. If you guys end up buying too many shares on a trade, you're going to end up losing, way more money than you intended to if the trade goes south. Of course, on the flip side, you're probably going to make way more than you intended to if the trade, ends up working out. However, share sizing, it's important because you need to minimize your risk and you need to buy or short the amount of shares that you're comfortable with, because trading is not really about how much money can you make. Of course, we're all in the game to make money, but a critical question really is how much money are you willing to lose? Okay, managing your risk is probably one of the most, if not the most important, elements of trading. Okay, and share sizing is a huge factor in that. So let's get right into it. Step one, and before I actually go into the steps, it's extremely simple. This is something, if you guys know basic math, which all of you do, this is extremely simple. All right. Step one, you're going to want to ask yourself, what is the maximum amount, dollar amount I am willing to lose on this trade? So if you're comfortable with losing $100 per trade, then that's your answer. It's whatever you're comfortable with. Personally, I do anywhere from 100 to 300. Sometimes I risk a little bit more depending on how I'm feeling or depending where my confidence is at. But that is what I'm comfortable with. That is known as your risk for the trade. Okay, so ask yourself, what am I comfortable with losing, and figure that number out. And the whole idea behind this is that if you lose more than you're comfortable with losing, then that's going to affect you psychologically. It's going to, hurt your psyche in a way. It's going to make you feel uncomfortable. It's going to be like, wow, I lost way more than I wanted to. It's going to hurt your confidence. You don't want that to happen. When you have a losing trade, it shouldn't affect you. And the key to that is you have to make sure you're losing the amount that you're willing to lose, or that you can lose, that you're comfortable with losing. Step two, calculate the size of your stop loss for the trade. Some examples is a 10-cent stop or a dollar stop, etc. And in order to correctly identify the stop loss for the trade, you have to make sure you know exactly what strategy you're playing. Different strategies call for different stop losses, or different stop loss placement, I should say. So I would definitely look into the buy setup, which is a video that's posted in the server, the breakout, another video posted in the server, and the 1, 2, 3 pattern. I don't think I posted that yet. However, I'm going to do a class on that shortly. Okay. And make sure you know what strategy you're playing, because if you know what strategy you're playing, you know exactly where to put your stop loss. So that won't be an issue. In step three, you're going to apply the formula. What is the formula I'm talking about? It's really simple. It's share size equals your risk divided by your stop loss. Okay, so whenever you are going into a trade, I don't care if it's equities or crypto or Forex, and you're buying shares or you're buying cryptos, you have to ask yourself, what's my share size going to be? Okay? And it's really simple. Let's say your risk is $200. That's the most you're willing to lose on this trade. And your stop loss happens to be, you calculate it, it's 10 cents. Then you do $200 divided by 10 cents equals 2,000 shares. So there you go. You know exactly how many shares to buy. And if you buy, let's say, those 2,000 shares and the stock does hit your stop loss, meaning, it doesn't work and the trade doesn't work in your favor and it drops by 10 cents, the most you're going to lose is $200, which is the number you agreed. You kind of have made an agreement with yourself that that's the most you're willing to lose. Okay, you lost it, but at least you're comfortable with losing that amount. Same thing here. Your risk is $100. Your stop loss is $1. Risk divided by stop loss, $100 divided by $1 is 100 shares. So if you buy it, right, 100 shares, if it drops $1, you're gonna lose $100. And it drops $1, you're gonna lose $100. Okay, it's super simple, guys. Again, share size equals risk divided by stop loss. And I'm to the point, where this is kind of automatic in my head. I'm automatically doing the math every time I'm looking or considering a trade. I'm just immediately doing this calculation in my head to really figure out what my stop loss, or not what my stop loss, what my share sizing is going to be. Because again, I personally don't want to lose more money than I'm willing to on that trade. That's why share sizing is extremely important. It's a critical part of risk management. And guys, never buy or short more shares than you're comfortable with doing. Because trust me, if it doesn't work out and the trade goes south, it will psychologically affect you. Okay, well, not only that, it might just drain your account. You might lose way more than you intended to. But anyway, guys, let me know if you have any questions about this concept. It's super simple, and the formula is super simple, but it's extremely, extremely important. Please direct message me, Emmanuel Trades, or type in the premium chat tagging my name if you have any questions regarding share sizing. Thanks, guys, and have a good day. What's going on, guys? Hope you're having a great day. In today's class, I'm going to give you guys a quick little overview of what leverage is. Okay, so if you're a crypto trader or if you're an aspiring crypto trader, you've probably heard the term leverage quite often because a lot of exchanges, they give you guys the option to use up to 200x leverage, which is a tremendous amount. And if you don't understand what that means, that's the whole point of this video. When you're trading stocks, most brokers don't give you anything more than 2x leverage, okay? And that's why, using leverage is a lot more popular in the crypto space. So let's kind of talk about what it is. When you use leverage, you increase your position size. By increasing your position size, you, number one, increase your overall risk of the trade, and you also increase the reward as well. So that's why people use leverage, ultimately to have a larger reward, to make more money, okay? But how does using leverage actually work? So let me give you guys an example. Let's say you have $5,000, right? That is your own money. You have $5,000, okay? So you can enter a trade with $5,000. Let's say the trade goes up 10%. Well, you're gonna make 500. If it goes down 10%, you're gonna lose 500, right? Seems pretty easy. Now, when you use leverage, what you'll do is you'll take your, and let's say we're doing 2x leverage. You'll take your $5,000 and then you'll also borrow $5,000 from the crypto exchange. So now, since you're using 2x leverage, right? Your overall position size is $10,000. $5,000 of your own money and $5,000 of the exchange's money, right? So you're technically borrowing money to enlarge, to increase your position size, okay? And now, if you have $10,000 now, right? 5,000 of your own money, 5,000 of the exchange's money. If it goes up 10%, now you're going to make $1,000. If it goes down 10%, you're going to make, or you're going to lose $1,000, right? So you can quickly see by using 2x leverage, you double your position size. So instead of 5K in a position, you're going to have 10,000 in the position. And as you can see, it does increase the reward, right? If it goes up 10%, you're going to make double. But now if it drops 10%, you're also going to lose double. And that's only 2x. If you do, let's say 4x leverage, in that case, you're going to, put $5,000 of your own money, and then you're also going to take $15,000 of the exchange's money, right, to fund your position. Now you have $20,000. And as you can see, the more and more leveraged you are, the larger the risk. However, with large risk, you also get large reward. Okay, so that's a really beginner's idea of how leverage works. You're basically increasing your position size by borrowing money from the exchange. So just to give you a little bit more details, guys, let's say you guys might have heard the term margin call or getting liquidated by the broker. Let's say hypothetically you did 2x leverage, right? So now you have $10,000 in the position, 5,000 of your own money, 5,000 of the exchange's money. As soon as that position or that crypto drops to the point where it risks the exchange's money, the exchange will actually automatically liquidate the position, and liquidate just means exit the position. It will exit the position for you, right? So let's say you're in the position, it's 10,000, and it starts dropping, right? It starts dropping, and let's say it drops to the point where your 5,000 is gone, right? Your 5,000 is gone. But as soon as it hits the point where their 5,000 is now at risk, the exchange will exit the trade for you, liquidating the position, closing the position, and at that point you just lost the $5,000. Okay? Hopefully that makes sense. So whenever you hear the word liquidate, it means you get out of the position or you exit the position, you close it. Okay? So as you can see, the more and more leveraged you are, the greater liquidation risk you're going to have, right? Because at that point, if you're 20, 50, 100x leveraged, it's really easy for the position to get to the point where it's starting to risk the exchange's money. And the exchange is not going to have that, right? As soon as they're at risk at losing money, they're going to close the position, and you're going to lose really everything that you put into that position. Okay, hopefully that makes sense. That's what leverage is. You are increasing your overall position in order to have a larger reward. However, you also increase the risk. So if you're a beginner crypto trader, my biggest recommendation is don't go crazy with the leverage, right? If you want to use 2x, fine. 5x, 10x, okay, fine. Just make sure you really understand the risk involved, and make sure you calculate the risk, right? And we're going to talk about calculating risk and calculating share size and risk management later in the course. But just keep in mind, that's what leverage is. And just keep in mind, you got to really think about the risk, because you're risking a lot more with more leverage. Okay? Thanks, guys. What is going on, guys? Hope you're having a great day. Today, we're going to be talking about managing your position, right? Trading management. And I got a cup of coffee with me, and we're going to be learning some amazing stuff. So let me get a quick sip before we actually begin. Okay. So I know a lot of people struggle with this topic, where they enter into a trade and let's say they begin making money, right? They're profiting, and they don't know exactly what to do, right? They don't know whether to just take profits, or they don't know how to exactly manage that position. And you guys have to understand that managing your position is an art. It's not a science, okay? There isn't one way to do it. In fact, every trader is going to have sort of a different trading management system, right? Something that suits, himself, and you kind of find that out over time through experience. You're going to learn what suits your personality and what sort of trading management works for your type of positions. But let's just get right into the presentation here, okay? We got how to manage your trades. Let's go. So let us consider two different possibilities here. We have outcome number one. So let's assume you just opened a new position. You have already identified your entry, your stop loss, and targets for the position, right? So if it's a buy setup, if it's a breakout, if it's a breakdown, maybe it's a 1, 2, 3, whatever it is, you should already know exactly what your entry price is, stop loss price, and what your target price is, or approximate target price. Now, let's say the trade doesn't work out in your favor, and the trade actually hits your stop loss. You're going to exit the position and take the loss. There's really no confusion here. If it hits your stop loss, you exit the position, okay? There's only really one outcome. If the trade doesn't work in your favor and it hits your stop loss, there's really no management necessary. You've already identified your stop loss prior to you even taking the trade. So if it hits your stop loss, you're out of the position, no questions asked, no confusion, okay? Now let us consider another outcome. Let's say the trade that you took is a winner, right? You get into the trade and it starts going in your favor and it's a winner. The trade, which it doesn't matter what security it is, whether it's stocks, crypto, forex, whatever. Let's say it's approaching target, right? And this is assuming you chose a target prior to the trade. There's going to be certain situations where, before you enter a trade, you're not going to be able to identify a target, right? And I don't really want to get into that too heavy. We're going to be talking about that during the, picking targets class. But let's say, the security is approaching target, or it's approaching the point where you want to start taking profits. What do? Are you just going to exit the position once it hits target completely? What if the position continues more in your favor and you actually miss out on some profits, right? Like let's say it hits your target, you completely exit the position, but then the stock or crypto and your trade, it continues going in your favor. And then you end up missing out on all those additional profits. You really don't want that to happen to you. You don't want to miss out on more potential profits by exiting the trade too early, okay? And that's where trading management comes in. That's when, your distinct management system will come into play and you'll know exactly what to do once your position actually hits target, all right? So before we go into it, I just want to clarify a specific topic because I use this phrase a lot and I think you guys should know what it means. So I usually call it just getting shaken out of a position. So if I ever say getting shaken out of a position, this is what it means. So let's say you enter a position and you set your stop loss. Before the stock or crypto in your trade goes in your favor and it eventually hits target, let's say it hits your stop loss first, forcing you out of the position and therefore missing the move, right? So let's say you get into a trade, right? The trade hits your stop loss. And right after it hits your stop loss, it immediately starts going in your favor, and and you would have made money on the trade for the fact if it didn't hit your stop loss, right? So that's what's getting shaken out. That's what that means, okay? Where it hits your stop loss, and then it ends up continuing in your favor anyway. So how do you eliminate getting shaken out of a position? Well, number one, it's don't set too tight of stop losses. And I know that's kind of contradictory, right? We talked about in the risk management videos that you want to look for tight stop losses, right? And now all of a sudden I'm saying, oh, you can't have too tight of stop losses because you might get shaken out of the position, right? And it's kind of like a conflict. You kind of have to pick the perfect stop loss, right? And my recommendation is just pick the correct stop loss for that setup, right? If it's a base breakout, we know that we always place the stop loss under the base, right? If it's a buy setup, we always place the stop loss under our entry bar, right? So I would say just stick to the basics, like stick to what I've taught you guys. But this is kind of an issue. It's kind of they're kind of like butting heads where you don't want to get shaken out of the position, but you also don't want to have too large of a stop loss, because then you're not going to really have all that much reward to risk. Okay, hopefully that makes sense. And so how to eliminate it? Yeah, don't set too tight of stop losses. Give the stock or crypto some room to fluctuate. Okay, worst case, if you'll set a larger stop loss, it may mean less reward to risk, but at least you're not going to get stopped out and be forced to enter again or miss the opportunity altogether, right? So you might have to set a little bit larger of a stop loss, therefore making your stop larger, right? Therefore, you're going to have a worse reward to risk because you're not going to be able to buy or short as many shares, right? But that sucks or whatever, but at least you're not going to get shaken out and see that trade end up going in your favor anyway. So keep this concept in mind, that you never want to get shaken out of a trade. You never want it to hit your stop loss and then have it go in your favor anyway. So let's take a look at this example here. It kind of looks a little confusing, but I'm going to walk you guys through it. We have a rally and we start to get a base, right? And we know what setup this is. This is a base breakout, right? And let's say your entry is right here, right? Your entry is over the base, right? So you're going to get triggered into the position right here with this green bar. So it hits your entry and now you're in the position, right? And let's say for this position, you end up placing your stop loss right here, right? Under these candlesticks. And remember, according to, the textbook theoretical version that I taught you guys, you should always be placing your stop loss under the lows of the base, right? So the correct way to place your stop loss would be under the lows of the base, which is this bar. So this right here is the correct stop loss. But let's say you wanted to have a higher reward to risk, so you ended up putting your stop loss up here instead of here, right? So you place your stop loss here instead of under the absolute lows of the base because you wanted to improve your reward to risk. Now let's say you get triggered into the position and all of a sudden the next bar is a red bar and we get a drop and it actually hits your stop loss that you placed here, right? It hits your stop loss here. It liquidates you out of the position before, on the next bar completely explodes and it goes right back up and makes new highs, right? But unfortunately, you're not in this play anymore because it hit your stop loss here, right? How to avoid this? Well, you should have placed your stop loss correctly in the beginning and put it underneath the absolute lows of the base. So as a result of you having your stop loss here, you got shaken out of the position before the trade actually went into your favor and would have produced very nice profits. So what's the conclusion here? Because you decided to use a tighter stop loss, right? Use this stop loss instead of this one. You got liquidated and you missed this move higher. Okay, so the theme here, guys, is place correct stop losses. Don't try to place too tight of stop losses. Otherwise, you'll have the risk of getting shaken out of the position before it ends up continuing in your favor anyway. Hopefully this makes sense, guys. I know I kind of repeated myself a bunch of times, but it's important that you guys understand this. And hopefully this all makes sense. If it doesn't, either go ahead and ask me in the server or just rewatch this video. Okay, so how do you manage positions that reach target, right? So let's say your trade has reached your target price, right? You were in it from down here and all of a sudden it hit your target price. What do you do from here? Well, you really have two options. Option number one, you take profits. You just exit the position as it hits target and you take your profits and it's a winning trade, Perfect. Or number two, you trail your position and you raise your stop. Okay, and we're going to talk about this in a second, but this for the second option, that's where the trading management comes in. So let's talk about option number one. Let's talk about the take profit option first. So take profit. You can either, number one, exit your entire position, right, where you just liquidate your entire position, you're completely out of the trade. Or number two, you take some profit here and you leave the rest of the position open in case it continues higher in your favor, right? So by doing option number two here, you're securing profit, right? At that point, it's 100% a profitable trade. You're securing profits, and then you're allowing, that other half of your position or the other, however much you left in the position, you let that run and hopefully make you more profits. So that ends up, and by the way, you might be thinking, okay, but how much of the position should I take, right? Like if you want to take some profit, how much profit should I take? My recommendation is take at least 50% of your profits. If you made $200, secure at least 100, or even do 75% where you secure, let's say like $150. Right, out of 200, and you let the other $50 kind of run. In worst case, if you lose that $50, well, you secured 150 already. It's for sure a winning trade. But when we're talking about leaving the rest of the position open, right? We take some profits and we leave the rest of the position open. Well, that begs the question: how do we manage the rest of the shares that you left? How do you manage those shares that you left in the position? What do you do with them? When do you take profits for them? For those shares, where do you place your stop loss for those shares? Okay, so let's get into it. I'm gonna take a sip of my coffee real quick. So 1 second. Okay, perfect. So your first option in trailing your position, right? So the stock reached target. However, you still think this can continue higher. Right, so let's say it hits your target. Let's say this is a buy setup, right? It pulled back. This is a buy setup, and the buy setup hits your target, right? But you think this still has potential to move higher. What do you do? So what you could do is wait for the pullback to complete, right? I'm talking about this pullback, and raise your stop to the new pivot low. And this doesn't only apply to a pullback. Let's say it ends up basing as well. You could also raise your stop loss to right under the lows of the base. So, like I said, you wait for the pullback to complete and you raise your stop to the new pivot low. So this is your original stop loss, right? We have a buy setup here, and your stop loss is under this entry bar. What you could do, as soon as it hits target, let's say it pulls back or it bases, you raise your stop loss to that new pivot or the new lows of the base, okay? So by raising your stop loss, what you've done here is you have 100% secured profits. Because remember, your entry is right here, right? Your entry is right here. By raising your stop, you have secured profits, right? Because let's say you raise your stop here and let's say it attempts to go higher, but then it fails and then it hits your new stop. Well, if it hits your new stop, at the end of the day, you're still making money because, this stop is over your entry. So what are the pros of this? Well, number one, you give yourself the ability to aim for a larger target while securing profits with this new stop loss. What are the cons? Well, the cons is the pullback can continue and you can give back your profits. And it's talking about this pullback, right? Where let's say you hit target right here, and you think this can continue higher, and you're waiting for this pullback or you're waiting for that base so you could raise your stop loss. But instead, this pullback just continues dropping and dropping and dropping, and it ends up hitting your original stop. That might happen. And then you end up having a winning trade go negative and hit your original stop loss. You definitely don't really want that to happen either. So at the end of the day, guys, it's kind of up to you. You know what I mean? I'm kind of giving you guys the different strategies that exist, but it's up to you for what you actually want to do. But in general, guys, you always want to raise your stop loss. It's a very good way of securing profits while allowing the position to continue higher. So this is one way of doing it, where you're raising it to the new pivot low, or you're raising it to the new low of the base. Now, let's talk about another way you can trail your position. So let's say the stock, right? This is a buy setup, right? We get a pullback. You have a buy setup. You enter here. Your stop loss is right here. Let's say the stock or crypto has reached your initial, it's reached your initial target, right? However, you still think this can continue higher. What do? What you can do is trail the position bar by bar. Okay, what does that mean? So as soon as the target is reached, you trail the position to the prior bar's low, right? So let's say you have, this is the bar that hits target, right? This is the bar that hits target. What you can do is raise your original stop to this bar's low, okay? You raise your original stop to this bar's low. So in that case, if it goes against you, well, it's going to hit your stop loss and you've secured profits, right? And once, let's say this bar has finished forming, then you're going to raise this stop to under this bar lows. And then as soon as this bar finishes forming, you raise it to that bar's lows. So as you can see, as each bar is moving higher and higher and higher, you're continuously raising your stop loss to each bar's low. And by doing that, you're giving the stock or crypto room to fluctuate, right? Let's say that you raise your stop loss here and this bar is already forming. It gives this bar the opportunity to go up and down a little bit before it continues higher. Remember, stocks and crypto, they don't just go infinitely up. Sometimes they go up, sometimes they go down. By continuously raising your stop, you're giving that stock or crypto room to fluctuate while also, having a tight enough stop loss where you're able to secure profits, okay? So what's the pros here? Well, you give the trade some room to continue higher while you're maximizing profits. However, a con of this is if you're thinking to yourself, okay, cool, I get the theory of this, right? I get the idea. When it hits target, you're raising your stop loss to the bar's low. But which time frames am I going to use? Which candlesticks am I going to use? That's where the difficulty comes in. It's kind of difficult to decide which time frame you're going to use. But guys, by either trailing your position this way or by trailing your position this way, what you're doing is you're allowing the trade to continue earning you more and more money, even though it already hit your target, right? So by doing this, you're giving yourself the opportunity to still have stop losses securing profit, but also giving the stock or crypto the opportunity to make really big gains, right? It gives you the opportunity to have huge winners, right? Because you're constantly raising your stop loss as the stock or crypto continues higher. Okay, hopefully that makes sense. So trailing bar by bar timeframes. Let's talk about the different timeframes you could use, right? So if you're swing trading, right? Remember swing trading, that's, you're looking at the daily chart and the weekly charts, and then you're using the hourly charts for entries. If you're swing trading, you can trail your position bar by bar on either the hourly or daily time frame. Okay, hourly or daily time frame. So I can actually go ahead and show you guys an example of that. Let's see, I don't have my charts up actually, my trading view charts up at the moment, but I can show you guys an example in a different class, showing you guys how to apply this. But right, so you're gonna trail it bar by bar on the hourly or daily time frame if you're swing trading. If you're day trading, it becomes a lot trickier because you can either choose to trail it on either the 1 minute or the 2 minute chart, or you could also use the 5, 15, or hourly time frame. You have a lot of options when it comes to trailing it on trailing it if you're day trading, right? If you're looking for a tighter trail, right, and what that means is you're looking for, tight stop losses, it's more likely to secure profits as soon as possible without giving the trade as much room to operate by using, lower time frames, right? Because on lower time frames, the candlesticks are a lot smaller, there are a lot more of them, right? It's a lot more likely that that's going to hit your new stop loss if you're trailing it on the 1 or 2 minute time frames. Okay, but if you want to secure profits as soon as possible without giving the trade, right, room to fluctuate, then use lower time frames. However, if you do want to, like, let's say you found a stock or crypto and you're extremely confident that it will continue higher, but you also don't want to get shaken out easily. If you're really, really confident that it's going to continue higher, then use larger time frames to trail, where you could even use the hourly or perhaps the 15-minute time frame, okay, if you're day trading. Okay. Also, let's talk about this concept here. The speed that it hits target matters, right? Like, let's say you have a base breakout. You have a base and you're playing a base breakout. If this immediately pops into your target, right, as opposed to, putting in a gradual move to your target, you're going to want to take at least 50% of the profits that you made in that trade, right? If this immediately pops really fast to your target, you either want to take at least 50% of your profits, or honestly, you might want to just take all your profits and don't even trail the position. Just take all of your profits, right? Because quick, large, and sudden moves higher could also lead to quick and sudden moves lower. Okay, and the last thing you want to do is have the position immediately reach target, right, really fast, and then you're like, oh, but maybe I want to go for a higher target or whatever. You want to keep this trade because you think it's going to go higher. The last thing you want to do is the last thing you want to do is stay in and have this stock completely fail and go right back down. Okay, so if it's a really fast acceleration into your target, take profits, right? At least 50% of your profits, okay? And understand that context matters. And this doesn't only apply to trailing, this also applies to setting stop losses from the beginning of your trade. When determining how to manage your positions, make sure you look at how the overall stock or crypto is moving, right? If it's whippy or if it's sloppy or if there's a lot of tails, right? Whether it's bottoming tails or topping tails, make sure you give that trade more room to fluctuate. In other words, set a little bit larger of a stop loss, okay? And yeah, you might minimize your reward to risk, but at least you won't get shaken out. The last thing you want to do is get shaken out of a position that makes a huge move in your favor. And understand, guys, like I mentioned earlier, trading management is difficult. It's an art, not a science. Once a trade is working in your favor and it's hit your target or you're making good money on it, and you want to start managing that position and making sure you maximize your profits while securing some profits in case the trade ends up failing after all, then you got to really kind of try to master what works for you, what trade management style works for you, okay? And over time of developing experience, like I say, you're going to find different trading management strategies that work best for you. Every trader is different and unique, okay, guys? So hopefully this makes sense, all right? I'm going to have one last sip of my coffee, so cheers to you guys. Okay. So if you're kind of confused on this, understand that it's normal, okay? This is kind of a difficult concept. So make sure you come to my live streams. Make sure you ask me questions on how you can master this. But the general idea here, just to give you guys an overall summary of what's going on, if a winning trade, right, hits your target, you could either take all the profits, right, and just take the position, liquidate the position, take your profits, or you could trail the position, right? And by trailing, you're going to be raising your stop loss to either a new pivot low or maybe under the lows of the new base that was forming. Or perhaps you're going to trail it bar by bar, where as soon as it hits target, you place your stop loss under the most recent candlestick. Okay, so whichever way you do it, make sure that you're kind of experimenting with it, because you kind of, like I said, you have to find something that works for you. And last thing I want to emphasize here, last thing I definitely want you guys to really get this. If you enter a position and it fails and it goes against you and it hits your stop loss, exit every time. Always respect your stop loss. And if you're share sizing correctly, right, by calculating, right, risk dollar amount divided by the size of your stop, right, that will give you your share size. If you're share sizing correctly and you're respecting your stop losses, you're never going to lose more money than you intend on losing, right? If you're the maximum amount you could lose is $100, then through share sizing, through risk management, and through following and being disciplined with your stop losses, you're never going to lose more money than you intend on losing. So this should be a rule. This should be like a golden rule. If it hits your stop loss, exit the position. Don't let it go more and more against you. And to do that, honestly, my recommendation is as soon as you place a trade, don't do mental stops. Just put a hard physical stop into your broker, into your exchange. Just place the order where, once you're in the position, place your sell stop loss order at whatever the price it is. And if it hits your stop loss, the system, your broker, your exchange will immediately take you out of the trade. In that case, you're not going to lose more money than you intend on losing, therefore limiting your losses. I know this was a lot of information. I know I'm talking a lot, guys, but I understand this stuff is difficult. That's why I'm really trying to, give you guys enough context and really explain everything very thoroughly. Okay, I hope this makes sense. See you guys in the next class. What's going on, guys? Hope you're having a great day. We are approaching the end of the course, and now our goal is to create a trading plan. Okay, every trader needs a plan, and this doesn't really only apply to trading. If you want to be successful in anything, you need to approach it in a systematic way. You can't have random decision making. You have to have a plan, and you have to execute that plan. After you execute that plan, you have to review it and refine the plan and continue forward. Okay. Everyone's trading plan evolves over time. All right. So today I'm going to be helping you create your own trading plan. And I'm going to be talking about how I created my trading plan back when I started trading. And even though I have 3 years of experience now, I make money basically every single day, I still don't deviate from my plan, and I still refine my plan over time, even though I'm already profitable and I'm already, experienced. So this isn't just for beginners. Even if you're, a profitable trader already, you could still find value in this class. So let's go ahead and begin. So building a trading plan. Why do you need a trading plan? So like I said, guys, to succeed in any endeavor, especially trading, you need to have a plan. You need to have a list of actions that you have to take, and a list of rules that govern your behavior. And with a plan, you're going to be trading in a consistent and systematic way with no random decisions. As traders, we want consistent profits. We're not going to be able to make consistent profits unless we're operating in a consistent way, right? If we're consistently doing the same things, then we're going to have some sort of repetitiveness in our trading. And especially if we're doing the right things consistently, we're oftentimes going to make money consistently, okay? But how can you expect to develop or develop as a consistent trader, consistently profitable trader, that is, if you're doing random things every day? You have to remove the randomness from your trading. And as soon as you remove that randomness and you're trading in a predefined way, you're going to notice your consistency and your results start to improve almost immediately. So over time, you're going to be adjusting your plan based on what's working, and you're going to eliminate from your plan what's not working. Okay? So in the beginning, I would really suggest to start with conservative, smaller goals and create strict rules. Create strict but easy to follow rules, I should say, right? And with a plan, guys, you're going to be accountable for your actions. And there's going to be times in your trading career where you go against your plan. It's happened to me. It's happened to every trader where you have developed a plan, but then you go against it and you lose money, or perhaps, you don't do the right thing. And that's going to be an ego hit. You're going to say to yourself, wow, why did I lose this money? It completely went against my plan. It completely went against what I planned for, yet I still did it, and I lost money because of it. And, it's going to feel bad. You're going to have an ego hit, but that's a part of the journey. You're inevitably going to, kind of go away from your plan and take stupid trades and make stupid decisions, but that's a part of the growth process. But with the plan now, you're going to be accountable. You're going to have some sense of responsibility where you don't want to disappoint yourself and take trades that go against your plan and go against your predefined reasoning. Okay? So what we have to understand now is every trader is different. Every trader must trade to his or her own personality. So what that means is you could take 10 successful traders, put them in a room, 10 random really successful traders. And if you look at each of their strategies, right, and how they make money, you're going to notice that they all make money in completely different ways, right? And they trade based on what works for his or her own personality. Everyone's going to have a different style. What I like to trade, excuse me, you're probably not going to have an affinity for that sort of trading. Just like what makes sense to you, what trading setups work for you and how you like to trade, that's not going to work for me. So your goal through this entire learning process is to slowly figure out what works for you. What style do you want to adopt? It's totally okay in the beginning to kind of copy someone else's style as you're learning, but you're going to quickly notice that if you don't resonate with someone's style, right, it's the trades are not going to make sense to you. And you have to find maybe one of our analysts, find what analyst style works for you, what resonates with you, what makes sense for you, and start taking his trades. And then over time, you're going to be taking your own trades that work for you. So play onto your individual strengths. So let me give you an example, and I'll give you my own example. When I started trading, I was going through the process of figuring out what works for me, what I like to trade, what's my own style. And knowing my personality, I'm a very high energy, I don't want to say I'm impatient, but I'm high energy. I don't like to lose money, right? Like I know losing money affects my psychology. Sitting and seeing myself losing money affects my psychology. I know that, for example, like I said, I'm high energy. I'm kind of like a twitchy guy. I'm always moving, right? And I've developed a trading style that kind of fits my own personality where, excuse me, I'm less of a patient trader and I'm more of a scalper. I'm more, kind of get in and out of positions. I go for quicker profits than most, but I do that a lot of times, right? And you might be thinking and hearing, myself talking about it, and you're like, oh, I'm actually a patient person. I would never want to just take profits right away. Well, there you go. Now you know what style, you have to adopt. But for me, that's what works for me. And I was able to figure out that very early in my trading and then play on to my strength, right? Develop that strength of mine because I'm really good in high pressure, quick situations where other people are better in, very low pressure, letting the trade play out over time, giving it the room to play out. For me, I like to do high share size in high pressure environments where it's really quick in and out scalps, right? Quick in and out, getting in the trades, getting in, entering really fast, exiting really fast. That's just what I prefer. It's what fits me, and I play to that strength. So building a trading plan, the first thing you want to do, guys, and we've talked about this before, is figure out your risk, determine your risk. Figure out what risk you're comfortable with losing. If you're a beginner, even if you're like an intermediate trader, my recommendation is risk low amounts, focus on consistency, okay? And I can't emphasize this enough, but even if you're paper trading, use the same risk and try to make it as realistic as possible. I paper traded for 4 to 5 months before I started trading with real money, but I didn't play around with paper trading, right? Like I didn't just treat it like a video game. I really tried to, go into it and paper trade as if it was real money. And because of that, and when I lost paper trading money, I felt bad about it. I kind of had the same reaction as if I lost real money, right? And I had to force myself to really I want to think about it like it's real money, because that will actually prepare me for what I'm actually trading with real money later down the road. So even if you're risking $10 to $20, right? Like if you're just beginning, risk $5 a trade, $10 a trade. And that risk, that's the maximum amount you could lose on that trade. Risk a low amount, $5, $10, even $1, like who cares, right? Just start developing the right habits with low amounts of money. And my recommendation is paper trade, okay? Paper trade. And when you're paper trading, they're going to give you, like in your account, since it's fake money, they'll probably give you like $1 million to paper trade, right? Don't use that. Make it realistic. Think about how much you're actually going to be trading with when you're trading with real money, and then paper trade to that account size, right? Like if you're only going to have a $1,000 account size, when you're paper trading, assume you only have $1,000 to paper trade and practice realistically, risking realistic amounts of money. Like if you risk $200,000 and you make $100,000 on paper trading, you're like, oh wow, I made $100,000. Like imagine if it was real money. You would have never done that if it was real money, because with real money it comes to risk, right? And that's going to affect you. You're not going to be risking $200,000 on a random trade, right? So take it seriously. Rule: never deviate from your risk. Never deviate from your risk. Never increase your risk randomly. Never just, if you set $10 as your risk, don't randomly increase it to $20 or to $30. Okay. So let's talk about strategy requirements. You should only be trading when you see a distinct strategy that we learned here. Don't trade random setups. Don't make random decisions. For each strategy, what you want to do is create a little template of requirements of what the stock or crypto must have. So here's just an example. You want to have the pattern. I chose the buy setup. You want to have a must have and a cannot have. And this is just an example, okay? So must have, if it's a buy setup, established uptrend, okay? Rising 20-day moving average, multiple time frame alignment, 40 to 60% retracement. Your must-haves might be different than mine. Maybe you're a lot more of a strict trader and you want to include all the other conditions we talked about for the buy setup, right? If you don't remember, go back to the buy setup class. But this is just an example. So this is what you want to have. Must-haves, right? And then cannot haves, where if it's, let's say there's no market alignment, don't trade it. If it's a deep or shallow pullback on the buy setup, don't trade it. If there's large amounts of resistance above the buy setup, meaning there's limited targets, don't trade it, right? So this is a little template you want to have for every setup. All right, guys, sorry, the stream actually cut off, so we're going to continue on here. So the whole point of what we're doing here is we're creating a template where we have must-haves and cannot-haves. So what you do is once you have your template created, you can go back to my classes to figure out the exact requirements. What you do is, you write this either on your computer or on a notebook. And whenever you're, finding a trade, let's say you're on your charts and you see a buy setup, right? You see a buy setup or a potential buy setup, and you go to your charts and you say, okay, does this have an established uptrend on multiple time frames? Okay, it does, check mark. Does this have a rising 20-day moving average that's trending under price? Okay, it does. Check mark. Does this have multiple time frame alignment? Do we have confirmation on the other time frames that everything looks bullish? Okay, we do. Check mark. How's the retracement looking? Okay, check mark. Very good. How's the pullback looking? Do we have an entry bar? Check mark. Okay, great. Do we have a tight stop loss with good reward to risk? We do. Check mark. Okay. Does it have, now let's see what it cannot have. Does it have a deep pullback? No. Do we have good targets? Or do we have bad targets? No, we have pretty good targets, right? And you're going to go down the list like that. And if the buy setup matches all of your requirements, or most of them at least, right? Like it kind of depends on you how picky you want to be, then you take the trade. And if it's let's say a breakout, you do the same thing. You look at your template, right? And if you're wondering what should I have in my must-haves, what should I have in my cannot-haves, well, you have to look at the class, look at my classes, and create a plan. And just look at the requirements and make a template like that, okay? So that's kind of the work that you guys have to do. Let's talk about entry requirements. Only enter a trade that has a distinct entry point based off what strategy you're trading, right? If it's a buy setup, you know where the entry is. It's above the entry bar. If it's a breakout, it's above the highs of the base. If it's a climactic move, then it's above or below the entry bar, right? So make sure you have a distinct entry and maybe put that in your trading plan. I have to have a distinct entry. I'm not entering randomly. I have a distinct entry. Place the stop loss exactly where you should for the strategy you're playing, right? You know where to set your stop losses for each strategy. Make sure you have an exact price that you're setting it. It's not random, okay? It's distinct. You know what price. You put it into the system, right? You're setting your stop losses in the system. If it hits that stop loss, you're out of the trade. No questions asked, right? And you can make that a rule where if it hits your stop loss, you're out of the position. Right, you're not going to allow it to go against you more than where you placed your stop loss, right? If it approaches target, you look to take profits or you trail the position, right? So building a trading plan, let's talk about protecting profits. So this is a really important idea. And this, I've seen successful traders completely lose their confidence and lose their mojo just because they fail to do this. Let me give you an example, right? Let's say I made $1,000 on the day, or let's say you made $1,000, right? So you're up $1,000. You have to ask yourself, how much am I willing to risk now, right? Like if you're already $1,000 in the profit, are you willing to lose all of that $1,000? Where you're going to end up finishing with zero? Like you want to protect some of the money you made on the day, right? So let's say you have $1,000 and you say to yourself, okay, I want to protect at least 800. I can't lose more than $200 on this trade. I have to protect 800, right? If you're at 1,000, I have to protect 800. I'm not willing to lose more than $200. Okay, because 1,000 minus 200 is 800. Okay, so in that case, you put that in your plan, right? You have to protect 80% of the profits you made on the day once you hit a certain target or something. So if you risk $50 per trade, $50 is one risk unit or 1R. So one risk unit is whatever your maximum risk is. That's 1R. In this case, it's $50. Remember, we talked about that we always want to have 2-to-1 reward to risk. In other words, two R's to 1R, or $100 profit at least for $50 risk. So here's one strategy you could do. If you're up 5 R's in the day, you have to protect at least 4 R's. In other words, if you're up $250 in the day, right, because 5 times R, 1R is $50, that's $250. You must protect 4 R's, which is 4 times 50 is 200. So you have to protect $200 if you made $250. This is one strategy. And let's say you're in an open position, you're in an open trade, and you are up 2 R's. You have to either trail to break even or trail to secure some profit with the management strategies we've already discussed. So the whole point of this is, let's say, it hits your target, you're up already 2 Rs on the position, which is, that's what we want. We want at least 2-to-1 reward to risk. You can't lose money on that trade. Either trail it to break even or trail it in a way where you could secure 100% some profits, right? With the management strategies that we've discussed, or just take profits completely, right? It depends on you. So let's talk about some rules that you have in your trading plan. At the end of the day, guys, it's all about the rules. It's all about the discipline, right? It's all about following these rules, staying disciplined, okay? That's in each rule, everyone's list of rules is going to be different based on your own psychological flaws. You have to figure out what is standing in the way of your trading from really taking the next step, what psychological flaw specifically, and then create rules addressing that flaw. So I kind of listed a whole list of examples. So if you lose X number of consecutive trades, you step away or lower your risk. If you lose 5 trades in a row, lower your risk from $50 to $25 until you gain your confidence back. Or just step away from trading completely for the day. If you lose 4 Rs after being up 5 Rs, stop trading for the day. So let's go back to this example. Let's say you're up 250. If all of a sudden you lose 4 Rs, so you lose $200, and now you're only up $50 on the day, you lost 4 Rs, step away, okay? You don't want to snowball the losing. I think a lot of traders, actually, I'm going to make this point after we get through all the rules real quick, because it's kind of an important one. But so predefine your risk and reward for each trade. Before you enter each trade, make sure you know what your risk is, where the stop loss is, where the entry is, what target you're looking for, and make sure it's predefined. You know the exact prices of your target, your entry, and your stop loss. Another rule, and this is more of like a guideline, you're trading to acquire skill, not to make money, okay? Don't worry about the money. Worry about you acquiring the skill. If you focus on acquiring the skill, the money will come, I promise you. I can guarantee you, if you're focusing on the skills and learning how to become the best trader you can, the money will come. I guarantee you, and it will come in spades. Okay, you will make a ton of money. The fact is, trading is not a linear process. Success is often not a linear process, right? You're usually kind of, I can't really draw it, but usually your success is kind of flat, flat, flat until it goes exponential. Okay, so just focus on developing consistency, focus on becoming a better trader. I promise you the money will come, and a lot of it will come as well. If you feel emotionally compromised, step away and lower your risk. If you're trading and you start to feel that you're trading off emotion, step away. Okay, that's a big rule for me. Don't make random decisions. Every decision should happen for a reason that you could justify. Okay, don't have any outside beliefs. You only listen what the charts are telling you. That's a big point. I'm probably going to make a separate class on that, just to listen what the charts are telling you. Understand, like I said, you guys are going to have different rules based on your psychological flaws. Every trader is going to have different rules. You have to figure out what set of rules fits you. Okay, so that's really key. Okay, and guys, you have to understand that in the beginning, don't be focusing on creating a perfect trading plan. There's no such thing. Your plan is inevitably going to evolve over time. So what your goal is create a plan, right? First, determine your risk. Then make a little template like this for every trading strategy you're looking to play. Then create some management rules, right? When are you going to take profits, right? How much profits are you willing to get to sacrifice if you're in a trade, right? How are you going to protect your profits, right? All this stuff. Create a plan in the beginning and make it simple, right? Just make a beginner's plan. Then execute. Go in for 2 to 3 days or 4 days, maybe a week. Execute that plan. record every single trade you take. And at the end of the week, you're going to go back and review every single trade that you took, or maybe you could do this on a daily day basis as well. Review every single trade that you take and see where are my mistakes, right? Where do I need to improve? What am I really actually doing wrong, right? And if it's a question on, okay, I'm taking bad setups, then review and be like, okay, what makes this a bad setup? What would a manual say, right? And if you're confused, that's what the live streams are for. Come to my live streams and ask me questions, right? And I'm sure you could I could help you a lot with helping you evolve your trading plan, right? And after you review, right, you're seeing what you're doing wrong, you refine, you fix up your plan, you change your plan, you make some adjustments. And then what do? The next week or the next day, you execute again. Then you review, then you refine, then you execute again. You review, you refine. And this is a process that will take time. And you're going to notice all of your negative habits from your trading are slowly going to go away. And guys, in trading, it's really it's not about what you are doing in trading. A lot of the times it's about what you're not doing in trading, what you don't do in trading, right? Like if you minimize all of your stupid mistakes, all of your psychological flaws that are leading to unnecessary losses, if you eliminate all the garbage that you do in your trading, right, you're going to become more profitable. Like for me, guys, personally, when I was first starting out, my number one goal wasn't to make money. It was just to figure out what I shouldn't be doing. What should I stay away from in trading? And once you understand what you should stay away from in trading, what setups to stay away from, what charts to stay away from, right? What maybe psychological mindsets you should stay away from, right? Once you know what not to do, it's really easy to flourish in what you're supposed to do, if that makes sense. Just focus on what not to do, eliminate all the stupid garbage from your trading, and you're going to see your trading go to the next level. Okay, that's really it for the presentation, guys. Just understand that this is an evolving plan. And I think we talked about, guys, just go step by step here, follow everything. I really want to emphasize that at the end of the day, everyone's different. Okay, everyone is completely different. Your plan is going to be different from someone else's plan, but always create a plan. Do not procrastinate. Put it pen to paper, write it down, and think it through. Stop trading randomly. Make this plan and execute off your plan. Okay? Don't procrastinate. Write it. After this class, take out a piece of a notebook, get a pencil or a pen, write down your plan. Okay? And once you do that, you're ahead of the 95% of traders, the 95% of all the amateurs who don't know what they're doing. You're going to be ahead of them because none of those guys have a plan. They're trading randomly. They are effectively gambling like at the casino. Why? Because they're not doing anything consistently. They don't have a plan of execution. They just do randomness. And I can guarantee you, if you're just going to be a random individual, a random trader, you're not going to ever consistently make money, which is the goal. All right, guys, hope this makes sense. Please come to my streams if you have any questions. What's going on, guys? Today I'm going to be talking about one of the biggest mistakes and one of the biggest misconceptions that exist in trading, okay? And that misconception is following and listening to the news, okay? And this kind of touches a more broader concept of you don't want to allow outside beliefs and outside opinions to affect your objectivity and your trading, okay? So once you are a competent trader, once you understand how to read charts, how to read price action, right? You should be able to trust your own ability to read the price action and see what it's telling you, okay? I want you to forget about the news, right? Because at the end of the day, guys, all the news that we hear is already priced into the stock or the security. we as the public are the last ones to hear about any news or any recent developments. We're the last ones to hear about that. All the shareholders of big companies, all of the big whales who are trading crypto, they already know about what's going on. They've already traded, based on that news. So stop listening to news. Stop listening to outside information when you're trading. The charts and price action, they give you all the facts. They let you know exactly what's going on. So when you're reading the charts, if it's telling you that it's bullish and you have some news, or maybe your grandmother told you that, oh, this is actually bearish, you should be shorting this stock or crypto, don't listen to her, okay? Not to, no offense to grandma, but listen to the news. Listen to the charts. Jeez, now I got myself all messed up. Listen to the charts. Listen to what the price action is telling you. Don't allow what your friend Billy told you about this stock. Oh, you should buy this stock. My friend told me that it's going to go up. Don't listen to that. It's all garbage. Listen to the price action that the charts are telling you. Listen to the facts. Don't let outside information affect the way that you are looking at the charts and your decision making. Because at the end of the day, the charts, they tell us what's actually happening right now, what the bias is right now, okay? So when you're trading, guys, don't let any outside noise or any outside opinions change your thought process and affect your objectivity. Ignore all of it. I have been trading for 3 years. I have not once looked at the company that I'm trading, what they do, what financial state that they're in, what news came out about them. Like, I never look at that. It doesn't matter. I only look at price. I only look at what's going on at the ground level. What are the facts telling me? And the charts tell you everything you need to know. So don't make the mistake of listening to outside information. Only focus on the charts and what price action is telling you, okay? The news oftentimes is completely useless. And unless you're an insider who's very close to the company and you're the first one to hear about the news and you trade on it, and honestly, usually that's insider trading. So, you can't really do that either. But just focus on the facts, guys. Don't listen to the news. Don't listen to outside information. Hope this helps. Don't make that habit. Okay, guys. Thanks. What is going on, guys? Hope you're having a terrific day. I'm very happy to finally teach this session of the course. And today we're going to be doing a very practical overview of the charts. We're going to actually look at some charts and review everything that we've learned so far in this course. So just as a review, we learned candlesticks, how to read candlesticks, right? How to identify different looking candlesticks and what they mean. And we've also learned about the 20-day moving average and the 200-day moving average. Now that you guys have learned these three concepts, we are able to now actually look at charts and begin understanding how to read charts. So before I continue with the strategy section of the course or looking at risk management, I just want to look at some charts together and help you guys just evaluate them and point out different candlesticks, point out what the different moving averages mean on the charts. So hopefully this is going to be really, really helpful for you guys to solidify that information that you've already learned earlier in the course. Okay, and my goal was to make this course as practical as possible. So that's what I want to do for you guys. So let's look at some charts. Take away my camera. So we are on tradingview.com, right? And first off, let's just review how to actually, create your charts. So number one, you want to make sure you have candles selected. You go to this tab, candles selected, right? And once you have candles selected, go to moving average, go to indicators and write moving average. Just click on it twice. So one just appeared right there. Click on it again, another one just appeared. And by the way, guys, you can do this on any single broker that you're trading on. This isn't just exclusive for TradingView. You could do this on any broker, any crypto exchange. So once you have the moving averages up, go to the settings, change the length to 20. Okay. And I'm gonna make mine white. That's just a personal preference. And change the other one for up to 200. And I'm going to keep that one blue. Perfect. So now that we've done this, we're able to read charts. And so as you can see, we have the 200-day moving average here, the 20-day moving average here, and our candlesticks. We are ready to begin reading charts. Now, let me quickly talk about looking at multiple time frames when you're beginning to analyze charts. And we have a separate section later in the course really going over which time frames you should be focusing on. So I'm not going to get into that too much now. I just want to give you guys the idea and give you guys, just kind of the background information when you're looking at time frames. So usually, guys, I always start with the daily chart. So the daily chart, every single one of these candlesticks represents 1 day's worth of price action, right? So for this day, let's say for this day right here, that's Friday, January 13th, price opened at 18,666. So you can see there on the right, and it closed at 19,860. Okay, so that's just an example. This represents 1 day's worth of price action, right? Now, if I go to, let's say, the hour chart, now every single one of these candlesticks represents 1 hour's worth of price action. So the last 24 candlesticks on this hourly chart represent 1 candlestick on the daily time frame. Okay, I think that makes sense, right? If this is a candlestick, this is a daily candle, then if you go to the hourly chart, right, 24 hourly, the previous 24 hourly candles are going to make up that 1 daily candle. Okay, so hopefully that makes sense. Now, I always like to start on the daily chart. I like to look at the larger time frames, meaning the daily and the weekly chart first. And the reason I like to do that, and I'm going to discuss this later in the course, but the reason I like to do that is because I like to look at what the overall context is of that stock or crypto. I like to see what it's doing on the larger time frames. How is it trending? How is the overall context of the stock or crypto trending? And then I like to go into the lower time frames, and then where I like to find entries and look for my specific strategies that I do. Okay, so we're looking at Bitcoin here on the daily chart. So I think actually let's go ahead and go to the hourly. We're going to be able to see a lot more price action here. So right off the bat, how am I analyzing this chart? Well, number one, from here all the way to down here, we see we have a declining 20-day moving average, right? It's trending lower. And right here, the slope of it changes and it becomes a lot more kind of steeper going lower. You could see how well price has respected, right, the 20-day moving average. Basically, every time it retraces into it, it drops. Okay. So every time we get a drop and we retrace back into the 20, we drop again. Right here we broke it, but we immediately dropped back down, and here we based into it, declining right here, perfect short, right? So quickly you're seeing that, in real life examples, when the 20-day moving average is trending, and in this case it's trending lower, you could see how well price respects it. You could see how well price is retracing back to it during this downtrend specifically. Okay. Another example here is we have the 20-day moving average going through price right here. So, I'm not seeing any significance here. I kind of ignore it while it's doing that. But here I see, we have the 20-day moving average trending higher. Right here, I see the moving average kind of halting prices from continuing lower. You could see, right, that price is respecting the 20, and eventually we actually get a breakout, right? We have a rising and trending 20, and then we get the breakout. So this is actually a strategy that I would play. This would be called the breakout, right? And we're going to be looking at strategies a little bit later in the course. Okay? We could see that as soon as Bitcoin hit the 200-day moving average, right? Like I said, the 200 acts as resistance. It immediately dropped. So in this case, it was acting as perfect resistance, and we dropped. So you could see quickly how these moving averages are affecting the charts and how they're affecting the price action of Bitcoin, okay? You could see here, the moving average is moving through price and it's flat, right? The 20-day moving average is flat. It's not trending. And we don't have any really, significant price movement. But as soon as the 20-day moving average starts trending lower, right? Because we always want a trending 20-day moving average. That's when we see price retracing back to it and respecting it. Okay. If we go further back, let's identify some candlesticks. So give a second to yourself and try to identify what this one is, right? That's a topping tail, obviously, right? And we could see what does a topping tail mean? It means that the sellers have taken control. So we rally, the sellers have taken control, and then we end up continuing lower. Okay, so that's an example. Right here, this is kind of an igniting red bar, right? We didn't end up continuing lower, but nevertheless, it is an igniting red bar. This, of course, is an igniting red bar as well. Let's take a look at what else we got here. By the way, guys, I'm doing this absolutely candidly. I did not set up these charts beforehand. We're just analyzing right off the top of my head. Okay. Okay, this is a really good example right here of we talked about the squeeze play, the pinch play, where we have the 200-day moving average breakout, right? We could see here that basically starting from right here, the 20-day moving average starts trending higher. We also see the 200-day moving average kind of flat, right? It's not perfectly flat, but it's flat. And we could see that as soon as the 20-day moving average starts trending into the flat 200, we could see price begins oscillating between the two, right? The 200 is acting as resistance, while the 20-day moving average is acting as support, right? Price is going to the 200 and dropping, retracing back to the 20. And then eventually, as soon as we intersect, we get that breakout that we talked about. And notice that during the breakout, and during this huge rally, we have the rising 20-day moving average, right? And if you guys really think about it, we talked about how the slope matters, right? The slope, the degree of steepness. You could see that right around right here, the degree of steepness of the 20-day moving average started increasing, it started getting much, much steeper, right? And eventually, we ended up, because it was so steep, the move was unsustainable, and we ended up having that big drop, okay? And also right here, we could see that price perfectly retraced, right here, perfectly retraced to the 20-day moving average, and then we had a kind of a buy setup. We're going to learn about that later. We have a rally. We don't actually follow through with this rally. We rally and then immediately drop, but nevertheless, you could see that how well price is respecting the 20-day moving average. Okay, hopefully that makes sense, right? If we look back, again, we could see it's trending lower here. We could see how well price is respecting it, okay? So the main idea here, guys, is what I've been trying to emphasize. We want the 20-day moving average to be trending, right? We don't want it to be flat. We want it to either be trending higher or trending lower. And we can also see the usefulness of the 200-day moving average. Okay. So when you're analyzing these charts, you never want to give too much emphasis on one particular candlestick, right? So just because, let's say you look at, you don't want to judge the entire chart off one candle. You want to kind of look at all of the candles and how all of the candles are moving before you come to a conclusion about what's going on. Okay. So let's continue looking. Let's go actually on a different time frame now. Let's go ahead and look at the 15-minute chart. And the 15-minute chart, right, it is, every single one of these candlesticks represents 15 minutes worth of time. And right off the bat, you could see the 20-day moving average. As soon as it becomes flat and it moves through price, we don't get any movement, right? We're kind of just fluctuating back and forth. But as soon as the moving average begins trending higher and curling under price right here, that's when we get the breakout. And we also have significant extension from the 20-day moving average here, which led to a drop, right? So we're going to talk about finding different short setups when we have that extension from the 20-day moving average. And remember, extension from the 20, it just means distance from the 20-day moving average. So right here, there's plenty of distance from the 20. We could look for a short here, but we're going to be discussing strategies like that a little bit later. Okay, hopefully that makes sense. Let's go ahead and look at the weekly chart. Okay, so now we're looking at the weekly chart. Every single candlestick represents 1 week's worth of price action. So one of these weekly charts, let's say this weekly bar, that represents 7 days worth of price action. Meaning, if you go to the daily chart, the last 7 days of price action represents this one weekly candle. Hopefully that makes sense. So looking at the weekly candlesticks or the weekly charts, we could see that once again, when the moving average, specifically when the 20-day moving average is trending lower, you could see how well price is respecting it, right? You could see that it retraces back to price, or price retraces back to the 20, right? You could see how well it respects it. Even during this uptrend here, we could see here the moving average halted prices from continuing lower, started trending higher and under price. We went to a breakout. So guys, I'm constantly talking about the 20-day moving average, especially here. I mean, check this out, guys. Check this out. During this uptrend, every time price dropped to the rising 20-day moving average, we continued higher. And this is Bitcoin. This is the Bitcoin weekly chart, right? Every time you could see when the moving average is trending, you could see how well price and how well Bitcoin is respecting it, right? And we could see this obvious solid uptrend. We can also see the 20-day moving average becoming steeper and steeper and steeper until the point we have some extension, and that's when we drop. Okay? Hopefully this makes sense, right? And so now that we understand how the 20-day moving average works, right? It works when it's trending either higher or lower, right? And we understand the slope, and we understand the 200-day moving average and how to read some of these candlesticks. Now we can begin to formulate strategies from it, right? So that's what we're going to be doing soon, is forming strategies, right? And my biggest recommendation is to put the 20-day moving average on your charts, put the 200-day moving average on your charts, and begin looking at price action and begin trying to find different patterns and trends that are occurring. And you're going to notice whenever the 20 is trending higher and under price tends to bounce off of it. It tends to retrace to it when it's in an uptrend. And just like if it's going lower, right here it's going lower, and the 20-day moving average is declining lower and trending lower, you can see price retraces back to the 20, right? Even during a downtrend. Okay? So hopefully this all makes sense, guys. Hopefully you have an innate understanding of how to use the 20 now, right? And you have some idea of how to look at different time frames, right? We know that we have to be looking at several time frames. We have to be looking at the daily, the weekly chart, the hourly chart. And don't worry if you don't understand which time frames to use yet. We're going to be going over that later in the course. All right, guys. So hopefully that gives you some insight on how to practically look at the charts. Okay, I might actually make one more video for you guys to look at over some charts just to really solidify that understanding. Okay, but at the end of the day, guys, this isn't hard. Okay, using the 20-day moving average isn't that difficult. Using the 200-day moving average, not that difficult, right? Understanding what candlesticks mean what, it's not that difficult. It's all about memorizing and just being able to recognize what you're looking at. This isn't hard stuff, guys. It's all about applying it in the correct ways. And I think the hardest thing about this is really trying to apply it on several time frames. And I'm gonna, cover that later in the course. So hopefully this helps you. And I'll actually probably create one more for you before we continue on with the rest of the course. All right, guys, thanks so much. Hopefully this made a lot of sense. Let me know if you guys have any questions, and see you on the next module. What's going on, guys? Today, we are finally going to test our knowledge and test everything that we've learned so far in the course. So I'm really excited to kind of go through some questions for you guys. It's going to be kind of like a quiz type presentation. So my recommendation is really take this seriously. Try to actually do the quiz yourself, and I'll just show you guys what it looks like. So quiz time. I'm going to give you guys a bunch of these sort of diagrams with different numbers, right? With what's this, what's that, what's this, and you guys just have to identify it. So my biggest recommendation, guys, is to take out a pencil or a pen, get a piece of paper, and pause the video. Okay, pause the video whenever you get to this point. Pause it and write down 1, 2, and 3. Write down exactly what it is and write down some qualities of it. For example, if you find hypothetically a buy setup or a breakout or whatever strategy is a 1, 2, 3, write down what makes that buy setup or breakout good, right? Like we talked about all of the qualities that we're looking for in these setups. Try to, write down why it's a quality setup. What are some deficiencies in that setup, okay? And then I'm gonna show you guys the exact, what we're identifying here, and I'll give you guys my explanation of it, okay? So just pause it right now. Go ahead and tell me what 1, 2, and 3 are. Write as much information as you can, and I'll, we'll go over it in a sec. So pause it, and we're gonna carry on here in 3, 2, 1. So first off, we have a buy setup, number 1, right? We rally, we pull back, we have a really nice entry bar to the rising 20-day moving average. It wasn't quite that successful of a buy setup because it didn't reach the previous high, which is target, but nevertheless, it's a buy setup. So hopefully you guys spotted that. Number 2, what do we have here? We have another buy setup. Rally, pull back. We kind of get this little entry bar. It's not the best entry bar. We have a rising 20-day moving average, which ends up being number 3. 3 is a rising 20-day moving average. Here we become a little bit climactic, and we're a little bit, we have an exhaustion pattern similar here because of the distance between price and the 20-day moving average. We also here have another buy setup here, right? Rally, we pull back to the rising 20-day moving average. I don't know if I would have played this buy setup. That's why I didn't put it as one of the identification. I didn't put a number here. So hopefully that makes sense. Let's continue. Okay, guys, so I want you guys to identify 1, 2, 3, 4, and 5. Go ahead and try to identify everything that you see here. Pause the video. Okay. And hopefully you guys did that. We're going to go ahead and start here. So number 1, we have a base breakdown, right? We kind of have a sloppy base. We have a declining 20-day moving average. We begin to break down. We drop. What do we have here? We have a sell setup. We have a drop, retracement to the declining 20-day moving average, sell setup. Number 3, well, this is the declining 20-day moving average that is overpriced. 4, we have another sell setup, right? Retracement to the 20-day moving average that's trending lower, sell setup. Number 5, we have a climactic buy setup. And this isn't a pure, if you didn't get this one, no problem. It's not a perfect climactic buy setup by any means, but it is a little bit climactic. It's a little bit extended. Okay. So hopefully you guys got all those. If you did, perfect. Let's continue. All right, guys, go ahead and pause the video now and try to identify 1 through 7. Okay. And let's go ahead and look at it. Number 1, we have a base breakout. We have a rising 20-day moving average. We have a breakout over this base, over that resistance. We continue higher. What do? We kind of pull back a little bit beneath the 20-day moving average. So this is not an ideal buy setup by any means. It's not that high quality, but nevertheless, you guys should have spotted that and said, hey, this is a buy setup. Or you could have even called it a base breakout in a way. However, it's not a good quality buy setup because it's, you know, the 20-day, it went below the 20-day moving average. The 20-day moving average right now is kind of flat. We don't have a clean pullback. We do have an entry bar, but it's not a clean buy setup by any means. Number 3, we break out of this. So this is a breakout of this resistance level. 4 is we broke out, then we pulled back, right? This resistance is becoming support for the stock now, or crypto. So 4 is a buy setup. We retrace to the rising 20-day moving average. It's a buy setup. We start to rally. 6 is obviously rising 20-day moving average under price. 5 is obviously the 200-day moving average. And 7 as well is a buy setup. We rally, pull back, really nice entry bar. Not quite to the 20-day moving average. It didn't quite reach it. However, it's still a buy setup. Okay, hopefully that makes sense. Let's see here. So go ahead, guys, and try to identify 1 through 5. Go ahead and pause the video. Okay, let's continue. So number 1, we have a wide range igniting bar. Hopefully you guys got that. We rally, then we have a pullback. So this is a buy setup. We have a rising 20-day moving average that's under price. 4 is a retest of this support level. And we also kind of double bottomed, right, leading to this rally. And 5 is the 200-day moving average. Okay, let's continue. Try to identify 1 through 3. Okay. So pause the video. Let's continue. Rally, we actually have a breakout right here because we broke out of this base. I kind of missed that. We also have a buy setup right here, breakout right here. Rising 20-day moving average, which is number 2. Rising, it's underpriced. We have a buy setup right here. Rally, we pulled back. Bottoming tail. So we have bottoming tail. The buyers have taken control. Buy setup, triggers higher. Perfect. Number 2, we also have a breakout right here. This is a base breakout, right? We rally, we base at the highs. We kind of based right into the decline, right into the trending 20-day moving average. That's underpriced. So this is a breakout. We have a pullback here. So this is kind of a bottoming tail and also kind of a buy setup / breakout. So, you know, this is, whether you want to say this is a pullback, you could say that, or you want to say this is a breakout here. No problem. We have a bottoming tail saying that the buyers have taken control. Okay. Let's continue here. This is a little, you know, looks a little different. Can you guys identify 1 through 7? Go ahead and pause the video. Try to identify all of the characteristics about it. Okay, let's continue. Step 1, we have a breakout, right? We have a base it's basing into the trending 20-day moving average. You could see the 20-day moving average starting to curl higher here, forcing prices higher. That's when we get the breakout. So nice base breakout. We have a rally. What do? We pull back into the rising 20-day moving average. This is a buy setup, right? This is a pullback pattern, and we have a couple of entry bars here into the rising 20-day moving average. We rally, then we kind of base. Number 3, this is a topping tail. So we actually broke out and failed. And then we, you know, dropped further into the rising 20-day moving average right here. This is kind of like a buy setup. So buy setup right here. We rallied. Here we have a climactic sell setup because we have extension and acceleration from the 20-day moving average. We have extension, we have the acceleration. We kind of have a base breakdown too, right? This is a sell setup, but it's also kind of it's basing up here, and we fell after the base, right? So kind of also a base breakdown as well. Then nothing really happens. The 20-day moving average is moving through price, nothing happens. And then the 20-day moving average starts curling higher, trending higher. Here we have a base breakout. We also have an igniting bar. Notice how the 20 is under price and trending and curling higher, igniting bar. Then we pull back and we have a buy setup here. Okay, so pullback pattern, buy setup right here, trending 20-day moving average. Hopefully you guys got all that. Let's look at the next one. Okay, pause your video. Okay, hopefully you guys got all of these. So let's take a look at what they are. So all of these are basically, I mean, number one, guys, the overall, bias here is that this is an excellent downtrend. We are downtrending. We're making lower highs, lower lows. We have a sell setup, drop. We have a sell setup, drop. Remember, sell setup is when it retraces to the declining 20-day moving average. So you could see how many sell setups we have here, right? We drop base into the 20-day moving average, breakdown or sell setup, retrace, right? We base into it, we drop. As soon as it touches the 20 here, sell setup, drop. We broke through here. We tried to continue higher. We didn't continue higher. So this breakout failure, we have a breakout failure here. Bases, this is a base breakdown right here at 6. So base breakdown, we drop. Right here, we're kind of at the 20-day moving average. So declining 20-day moving average, we drop. Another sell setup, we drop. Sell setup here as well. Okay. So you're seeing that during this downtrend, you could see how well price is respecting the 20-day moving average and how many sell setups we have. Let's continue. Right here, let's try to identify 1, 2, 3, 4. What do we have here? Pause the video. Okay. So number one is a failed buy setup. This one was a little bit challenging. We have a rally and then we retrace, right? We retrace right here. This is a buy setup. However, it never ended up triggering. So this buy setup failed. We based kind of sloppy here, broke out. Now we're basing at resistance, right? This is a resistance point right here. So this is a resistance point. And number two is a base breakout. So base breakout. 3 is a rising 20-day moving average that's curling higher and under price. And here we have a base breakdown and we're a little bit climactic. Climactic because we have that extension. We kind of have that acceleration as well. So this is a base breakdown. And usually I would say don't play base breakdowns when a stock or crypto is uptrending, but we are a little bit climactic here. So that's why. Let's look at this one. Pause the video and try to identify 1, 2, 3, 4, 5, 6, 7, and 8. Okay, pause the video. Number one, we have a rally, retracement. We have a buy setup, rising 20-day moving average that's underpriced. Here we have a topping tail. Okay, we tried to break out and failed. We continued to base, right? So this breakout, it wasn't quite ready to go higher. We still needed to further base and correct in price. So topping tail, the sellers have taken control. We continue to base into the rising 20-day moving average right here. That's when we have the breakout, when it's at or near the 20-day moving average. We break out, right? Now we kind of are basing at the highs. It looks higher here, but this ends up being a base breakdown. We continue lower. We have another base breakdown here because we drop, we base. Then we have a huge igniting bar going lower. Right here, we have a sell setup because we drop. Then we kind of retrace right here. Sell setup. We have a declining 20-day moving average. And yeah, hopefully you guys got all of that. Okay. So those were 51. You had to identify 51 points. Go ahead and, keep score. Try to see how many you got. And if you got anything under 47 out of 51 points, so if you got more than 47 correct, you're in great shape and you're in really good shape. If you have under 47 correct, you're fine. Like if you're between like 40 and 47, you're still fine. But if you're really under 40, I would say go back and review because these are really easy questions. These are basic. You guys should all have gotten all of these, the buy setups, the bottoming tails. And if you didn't get them, you should have at least like understood exactly what it is and what your mistake was. But if you're looking at all of these and you're confused with what it is, then you have some serious review to do. So hopefully you got all of these. If this is easy, guys, then you're well on your way towards being a really, really good chart reader and really good at identifying different setups and what's really going on with the charts and price action. So good job, guys. I hope you got these correct. I'm going to try to post another chart session and review, kind of like a quiz type review in the next video. So hopefully you guys found value out of this. Thanks a lot. This class is the first class in our psychology or our trading psychology series, where we are going to address how to deal with your own psychology and the way you guys should be thinking in order to become successful traders, right? And to be honest, I would say trading psychology and understanding your own psychology is maybe 60 to 70% of your success in trading. It's really that significant. And people, they don't really think about it. They don't really like address it, right? They think it's just the charts, just the technicals. Obviously, that's a huge part, but the way, you know, at the end of the day, we're trading with real money, our real capital, right? And sometimes, especially when it's our own money, we can get quite emotional. And one of the emotions, one of the, you know, most powerful emotions that we feel is FOMO. And for anyone who doesn't know what that is, it is the fear of missing out. Okay, so let's get started. If we look up the Google definition, it is an anxiety that an exciting or interesting event may currently be happening elsewhere, right? So in trading purposes, where it really applies is that people tend to fear or develop anxiety when they feel like they're missing out on a really potentially lucrative trade, right? They tend to, you know, and what they do is they base their entries and they base their how do I say this? Not the understanding. They base their reasoning of entering a trade based off their emotions, based off just fearing to miss out, right? So we're gonna try to help you with this. And before I continue, I want to ask you guys, and guys, what I want you to do is be honest with yourselves, right? Like the point here is to improve. Be honest with yourselves. Who here has experienced the fear of missing out? Where you enter a trade because you're genuinely worried that sometime, like, you're gonna miss it. Oh, this is the next big move. I'm gonna miss it. It's a very common, you know, feeling. It's a common emotion, right? So, and I think a lot of people, what they don't realize is that these emotions, for example, like FOMO, are stopping them from becoming successful. I'm sure a lot of you guys already have the education, already the skill set, you know, to trade more profitably or make more money in the markets, right? But your own psyche, your own emotions are in the way. So, you know, our job is to break through those emotions. Okay, I still have it sometimes. It's the fear of entering incorrectly. Okay, I'm quite procedural, my entries and exits. It's okay. Okay, got you. Okay, interesting. But let's continue with this. So let's understand, why does this happen in trading, right? And honestly, I think a lot of it is because of the constant bombardment of trading success videos and posts that we see on social media. When you're scrolling on Facebook, on Instagram, on Twitter, and you're seeing hundreds of people posting their profits, right? 200% gains, 1,000% gains, them trying to, you know, convince you to join their program, and then, or just seeing people doing really well, right? But we have to understand that isn't the majority of people. That is literally, first of all, most of them are lying. Just know that, right? And these posts on social media, and this doesn't even only apply to trading, this is just in general, they tend to alter our ways of actually interpreting the world, right? So when we're seeing all this trading information on social media, we're interpreting it as, oh my God, everybody is successful but me. Where it's really not the case. 95% of traders lose money. 70% don't last for more than a year. 6% of people who attempt to become professional traders succeed, right? And you might be thinking to yourself, wow, like those statistics are, you know, they make, okay, those statistics, and why should I even become a trader, right? If 95% traders lose money. And what we have to understand is that a huge percentage of those people do extremely silly mistakes. that lead to them failing, like trading off news, like not educating themselves, like trading because they're off their emotions or because their friend told them to buy a company, right? Like, we have to understand that a lot of people are dumb, right? And what's the statistics that I want to see is, what is the statistics of success when you're actually committing yourself to educating them, to learning the material, to actually learning risk management, to actually learning trading psychology, to be fully committed and practicing every day, right? And I'm sure the success rate is much higher if you're fully committed into, how do I say this? Fully committed into practicing the habits that create a successful trader. I think truly 95% of people just don't have the right habits. That's why they fail, right? And what we have to understand is, don't let social media, don't let news, don't let any external pressures affect your trading. Okay? You have to trade with objectivity. Focus on the charts. The charts tell you everything. Everything you need to know. Okay? The charts and price action, price data. Okay? And stop listening to other people. Like, you're on your own road to success. You're on your own road to making money trading, right? So who cares what other people tell you about what you're doing, right? Or tell you, oh, you have to do it this way, right? For example, even for me, when I was learning how to trade, I had family members that doubted me. Basically everyone except like my dad, because he trades, right? But everyone else, oh, trading, you're going to lose money. Everyone loses money in trading. Don't do it. Oh, try this, try that. It's like, yeah, you got to block all that out, because all of that is noise. That's noise. That's just going to affect your psyche. Block it out. Be in your tunnel, right? You guys know what it takes to be successful, and I'm helping you guys get there, right? You just got to continue on the path. Don't let anybody, any social media, anything affect you, okay? Anyway, and honestly, part of the other reason why we're experiencing FOMO is just the nature of trading. It's a very fast-paced environment, and the emotional impacts of trading can very much lead to FOMO, and most of those emotional impacts are stemming from the fact that you're trading with real money. These are real results. Like, this is your money that you worked hard for, and the fact that you can lose it, it's kind of terrifying in a way. Wow, like, I might lose money on this. Right? And it like really screws up with a lot of people's heads, right? And what we have to understand too is, as human beings, we experience emotions. We're not robots. Anybody, any trader, any person who says, oh, you have to trade like a robot, yeah, you are full of shit. Excuse my French, but it's true. You are, because we're not robots, right? We have to deal with emotions. The people who tell you to trade like a robot are the people who probably don't have their stuff figured out, who don't have their emotions in check, because it's such a default answer. It's like an easy answer to everything. Oh, just trade like a robot. Okay, like, that's not how it works, right? Like, we have emotions. We deal with them, right? It's not about blocking your emotions. It's about taking your emotions and figuring them out, right? Trying to, like, compromise with them almost, right? And another really interesting thing, aside from the fact that it's fast-paced, there's a lot of emotional impacts, we experience so many different types of emotions in trading. Like, think about it. Greed, right? We all want to make money, so of course there's greed. There's hope. We're all hoping our losses or our gains, right, will become, or our losses will become less, or our gains will become more, right? Or there's fear, jealousy of other people making money, impatience when your trade is not going your way, frustration when you just can't seem to get anything right. We experience all of these, and these are affecting your trading. These are in the way of your success, okay? So what do? We learn to deal with them. That's the answer. And that might not be the magic answer. You know, a lot of people, oh, trust this one-step process. It's not, and it takes time. And I'm telling you that honestly. And I'm not telling you that because I think it's because I've had my psychological demons for months. But what do? You learn to deal with it. You learn how to embrace them. Okay? And the other thing I really want to bring up about FOMO, and in general, every single trader out there, I don't care if you are the best trader of all time, you are missing out on 99% of every single trade out there. It's impossible to catch them all. Accept that, right? It is literally impossible to catch all the trades, right? So instead, what do? We focus on the trades that we're actually doing, the ones that we're actually taking. Focus on the management, right? Your entries, whether you're picking the right plays in the first place, right? And the actual facts. And where do the facts stem from? Price action and charts, which I've been teaching you guys how to do that. So that shouldn't be a problem anymore, right? So focus, instead of thinking about all the trades that you missed that day, focus on the trades that you made. Ask yourself, right? Well, ask yourself, why did I choose this trade? Was it because the charts looked good? Or was it because of my own emotions? Right? Ask yourself when you're in a trade, or let's say, when the day is over and you're reviewing all your trades, ask yourself this. Okay, I understand that I definitely missed some opportunities. I'm okay with that. Say to yourself, I'm okay with that, right? However, let me look at the trades that I did take. Did I play them correctly? Did I get the right entry, the right stops, the right everything, right? And if the answer is no, then okay, work on that part of your trading. Stop worrying about all the other trades that you missed. What's the point of it? And this is something that I'm guilty of. Literally almost every day. There's always these opportunities and I'm like, oh my God, how did I miss that? Right? And most of the time I get upset with myself because I would find the stock, right? I find a setup that I really like. I'm like, wow, like this is amazing. And then I'm watching it and boom, it randomly goes without me. It randomly pops up, right? And it sucks. I get upset about it, right? So of course I'm not, like, nobody's perfect here. Like the same thing happens to me. But I've learned how to not let it affect me in the future. It doesn't affect me anymore. The thing is, it's a part of the profession, okay? It's a part of what we do. Like, for example, let's say you become a dentist. This is maybe a strange analogy. You become a dentist and you get spit on your hands or perhaps even on your face. Do you get upset? No, it's a part of the profession. You signed up for that when you became a dentist. It's the same idea. You're signing up for all of these feelings when you're becoming a trader. Accept it and learn how to deal with it. Okay? Oh, whoops. And another thing that you guys, don't ever worry about not taking the right plays or missing out, because being selective is literally probably the number one reason of why I am successful. I am extremely selective with my trades. I'm very good with limiting my losses, and as a result, sometimes my gains aren't as huge, but, I take that because I'm very good at selecting which stocks, or not even which stocks, which setups to play. It doesn't look good enough for me. I don't settle for bad setups, right? If there's not a good setup, I don't do it, period. And yeah, you're going to miss on some really huge moves, but being a picky trader will save you more money than you can imagine, right? It's not, and oftentimes with trading, right, it's not about being more profitable. It's about limiting your risk more, or saving more money per se, right? Like, you don't need to make more money to be profitable. You could learn how to limit your risk better, and as a result, you'll be more profitable, right? I think a lot of people, they're focused on, wow, catching the big plays, making the big money, when in reality, if you just learn how to contain your losses and limit them, you'll be much more profitable, right? And guys, lost opportunity is much, much more ideal than trading losses. Remember that. And ask yourself this question. You guys are here to become professionals, right? We're not amateurs here. I'm trying to teach you guys how to approach trading in a professional way. Because why? Because professionals are the ones that make money, not the amateurs. And that's with that's anything, regardless of what industry. Professionals are the ones who make money, right? The professional trader, do you think he is basing his decisions off social media, off other people's decisions, off the crowd? No. What is he basing his decisions on? His own objectivity, his own knowledge, and his own experience. And you guys are becoming more knowledgeable, becoming more experienced. Trust yourself, right? Learn to be a professional. We have to approach this in a professional way, okay? And it's really, really important because, a lot of people who lose money, they're the amateurs. They're the, oh, I'm just going to get into trading. I think I can make money right away. Like, no, okay? That's the end of the presentation, guys. I kind of talked a lot there, but let's talk about some questions. Or are there any questions? Was that helpful for you guys? I hope that was helpful. I hope you guys took something from that, though. Because, like, truly, people always say you change your mindset, you change your life. It really applies like that for trading. Change your mindset, and you will change your trading. It's really that simple. Seriously. Like, you guys are, a lot of you have shown incredible improvement, right? But if you're still struggling, like Syntax Geek, we could talk about your situation, right? If you don't mind, like, change the way you're approaching trading, and you'll succeed. Seriously. I hate when I see profits post where someone made 1K, but they use 30K to do so. To me, that's terrible risk to reward. Always just post tiny 100 PS, but I'd rather see percent of gains on money use profits. Yeah, I mean, that's true, Syntax Geek, but in my case, that's how I make money. Like, I don't have huge gains. I don't have huge percent gains. What I do is I go for small percent gains a lot, like 100 times, 200 times. I literally do between 200 to 300 trades every day, or I would say 1 to 300 trades every single day. So it depends on your strategy. It really depends on your strategy. My strategy, which works, and realistically, I do need more capital, but I do have a slightly larger account, but I would be able to do what I'm doing with the bare minimum to have to be able to day trade, which is 25K. You give me 25K, I could do exactly what I'm doing now. However, I do need 25K because I get margin, and I do need margin for my strategy. Yeah, exactly. How long did it take you to get to the point you're at now? It took me like 2 years, two and a half years or so. To where I'm at now, yeah. Which is actually kind of like really optimistic for you guys, because 2 years is not that much. Like, think about it. Think about learning a complete, people go to college for 4 years. Think about it like this. People go to college for 4 years to maybe, if you're lucky, depending on what school and what you study, to get a job. And you're telling me 2 years to invest in yourself and trading is a lot? And honestly, I was profitable 7 months in. I paper traded for 5 to 6 months, right? I paper traded for 5 to 6 months. And as soon as I got into trading with real money, I was immediately profitable. Like, I've never had a losing stretch in my career, except I would say in Sweden. When I was in Sweden, I was trading on delayed data. Over a 3-month period, I broke even, I think, or maybe I made like $1,000 over 3 months, and that was like horrible for me. Like, that was like, I was like questioning my entire everything. Like, it was really stressful, but you overcome it. See, you've earned the title of Professor E. I think I might change my name to that. Listen, I'm trying to help you. You can do it. Like, guys, I'm serious. Like, this information, all these classes, like, I'm doing all of them. Like, this is everything you need to know. Seriously, like, from a technical analysis perspective, like, this is everything. All right, seriously. Like, this is gonna be complete. Like, hopefully by the time I'm done with all of this whole series of videos, which I don't even think I'll ever be done because there's always something to be made. But, like, you can get a beginner and they'll learn almost. You combine that with experience, and y'all will be profitable. Great, was helpful for recording. Yeah, so true. I've experienced everything you said. That gave me strength to learn how to do it. Yeah, very good. How long did it take you? Okay, yes, I worry a lot about losing momentum, but I'll keep in mind that reducing losses is also gaining. New investing model unlocked. Yep. Do you compound profits? Start small and go bigger? Yeah. I mean, it's not even about compounding profits. I start the day risking a little bit to get comfortable, right? If I'm trading a brand new stock, I'm going to start risking just a little bit, just to get comfortable with the stock, and then I go with larger size. I use TD Ameritrade, Jeremiah. That one's really, really good. They kind of are in order, Krulex. Like, they basically are in order from top down. Like, it doesn't matter which strategies you learn first. Like, technical analysis, that's 1. Candlesticks, that's 2. 20 MA, that's 3. They're basically in order. Like, yeah, they're basically in order, so I wouldn't worry about that. Really, the only big thing is you got the Candlestick Mastery is really, like, that's important. Like, you can't do the other ones without that one. Are you using Thinkorswim to find plays based under specific criteria? Yeah, I do use a Thinkorswim scanner. I do use it. I find a lot of gapping stocks. I'm a gap trader. I like gaps. Today was kind of slow though, not gonna lie. Like a lot of the Chinese, I don't know if you guys are subscribed to my stock alerts, but I kind of post little morning watch lists, and I post my swing trades and some day trades in there. So definitely subscribe, or not subscribe, but like pick that signal. No. I use TD Ameritrade to buy and view charts. So like everything is done through Thinkorswim. TD Ameritrade, Thinkorswim. But yeah, I posted a whole watch list today of all of the Chinese stocks that were gapping up. I thought they would be really interesting to scalp, and a lot of them actually rallied like big time. You know, and I'm gonna show you guys quickly. Let me see. I need to. Let me get my charts up. One sec. Where are my charts at? There you go. Okay. Nice. Let me get my charts up. We can look at it together. Just what I posted today. I didn't post trades because a lot of them kind of went without me. But like, I think, which one was it? TME went up. Let's look at TME. Yeah, definitely pay attention to the watch list because there's a lot of really nice watches sometimes. TME, did it rally? Oh no, why is this happening? This always happens. I'm probably going to stop the recording here as well.